those shares is because the medical care ratio, or that's the ratio of medical cost to premium revenue, that was 85% compared with expectations of 84.1%. So the costs were a little higher than had been anticipated, and even though the company is beating expectations, people are focusing on that issue. The stock now off by about 3.5%.
Like the inverse of margin, profit margin. Coming up, bank earnings on deck. We're going to hear from Bank of America, JP Morgan, Wells Fargo, and Citigroup all in the next 90 minutes. Hard to imagine. People at home must be, obviously they're canceling plans to see these. And a reminder, get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back.
Oh, mama, I'm excited. I'm almost out of breath.
Viciously.
Goldman Sachs is out with its market outlook for 2024. This year, the thesis is titled America Powers On. Last year, Goldman, it said investors should be positioned neutrally. And for details on how investors should be positioned this year and insights on the market, we're joined in an exclusive interview with Charmaine Mosavar Ramani. And she is Ramani, Chief Investment Officer of the Investment Strategy
Get it right,
Group,
Joe.
At Goldman Sachs. Neutral?
Well,
Last
actually,
year.
you said last year it wasn't neutral. In fact, last time you tortured me.
This
about
girl looks stoned, man.
I won't torture you this time, but it was a good year.
What has she been smoking?
We had a 50% probability of 13% for the S&P 500 and 20% probability for 27%.
Who is this person?
So actually, we had told our clients to be fully invested.
Well, why call it neutral then?
We didn't say it was neutral.
Well, that's just what I read at the
Oh,
beginning of last year. So you did not, is that, that's not true. You did not have a neutral
Well, it depends
position
on-
at the beginning of 2020.
Maybe it depends on what you mean by neutral.
Oh,
We
what the
actually
meaning of the
had
word
a
is
full allocation
Okay.
to U.S. equities,
This
and
year
we're overweight U.S. equities
Okay.
strategically for the long run. Actually, since the beginning of the global financial crisis, we have told clients to be overweight U.S. equities relative to market capitalization weights, and we have told clients to stay invested at that overweight.
On a scale of 1 to 10, how bullish would you say you were last year at the beginning of the year?
Oh, I would say on a scale of 1 to 10, with
Take your
a
word for it.
70% probability of 13% or higher returns, I would
Okay.
say that's more like an 8 or 9. I wouldn't say that's neutral.
Okay. And so this year,
Neutral would be a
give me the same numbers
6%
for
return.
this year.
Our base case for this year,
Yeah.
60% probability of a 6% return, and we have a 20% probability of a 13% return. So you look at those together, we're saying 18% probability of 6% or higher.
Is there a
downside.
real probability for
Always.
And what is that?
We always have a probability down. Last year it was down 4% probability, and this year it's down about 10%.
Okay.
God, that's neutral,
In a
dumbass.
moment, I guess things are happening, and Leslie Picker is going to bring us some numbers. Leslie, what happened?
Hey, Joe. Yeah, Bank of America reporting fourth quarter earnings. It was a beat on the bottom line and a near match on the top, but a bit of a noisy quarter.
Woo!
Bear with me, guys. Adjusted EPS coming in at 70 cents per share in the quarter, with adjusted revenue of 23.7 billion.
Irrational
on a fully
exuberance.
taxable equivalent basis, but B of A had two items that impacted the quarter, including the 2.1 billion pre-tax charge for that FDIC special assessment related to the regional bank turmoil last spring, and then there was also a $1.6 billion charge to revenue from dedesignating certain interest rate swaps. So adding back in those two items, B of A reported EPS of 35 cents per share and revenue of 22.1 billion. Net interest income, that's the profitability metric from loan making here, that was down 5% to 14.1 billion due to higher deposit costs and lower balances offset by higher asset yields. CEO Brian Moynihan has said last month that NII would trough in the near term and then go back up in the middle of the year. So we are seeing that occur. Much of that has to do with the trajectory of yields, which have pressured B of A's stock price throughout much of 2023 due to the size of unrealized losses on the balance sheet. That figure actually came down to $98 billion in the quarter from $132 billion last quarter. So a $34 billion improvement as, of course, bond prices gained during the course of the fourth quarter. Average deposit balances, loans each grew sequentially, and credit card loss rate also ticked higher to 3.07%. That's comparable to pre-pandemic 2019 levels. And Bank of America did report a full year sales and trading revenue of $17.6 billion and said it had 0 days of trading losses in 2023 for the first time since
It's hard to find a
2017, guys.
stair
Hey,
step.
Leslie, the stock, I don't know if you can see it, it's reacting. It's down by about
Triple top
4.5%.
would
It
be
was
my
down
solid
5.5%
support.
earlier. A lot of the news you just reported was pretty good. What do you think the standout is in terms of why the stock would be trading off like that?
Yeah, I think a lot of it has to do with what the net interest income figure might be. I mean, this is just first glance here, but any tick down in NII, that's been such a big tailwind throughout the course of 2023. So that was down 5% in the quarter. That is indicative of obviously a new interest rate regime. We're seeing, we saw a pretty sizable pivot, at least in terms of market rates during the fourth quarter. So we're seeing the effects of that in NII, and of course, Bank of America is the first one to report this morning. So it's kind of the guinea pig, so to speak, with regard to what NII looks like amid this new rate regime. So upon first glance, that could be it. But I'm going to dig a little deeper and see if there's anything else relative to estimates that may be spooking the market a bit.
So far, we've had two bad reactions, United Healthcare and Bank of America. Now, these people are very bullish on CNBC. I mean, they're always last to admit it. And they're always trying to look for the bright spot in any trade and walking over the illness. We've had irrational exuberance, so all we're doing is pulling back to a rational state of mind. These people aren't rational. They won't be rational because they're getting paid to pump.
Well over 15 years. So the idea is clients should have more equity exposure than market cap benchmarks would suggest. So we start with the premise.
It's all con job.
Be overweight U.S. equities relative to developed markets.
Today's going to be a great day for
markets,
scalping.
And relative to China specifically. We generally have had that view, and that has served our clients very well. If you think of U.S. equity performance versus other markets since the trough of the global financial crisis, you're looking at U.S. equities up 16%, developed non-U.S. up 10%, emerging markets 8% annualized, and China 6%. So if you had 100 million, you'd have just under $1 billion today if you'd invested in U.S. equities. If you had invested in China,
100 million,
you wouldn't
okay,
even
who's going to
a
have?
quarter of that. So the main theme.
How many people are
is
going to invest
invest
$100
in
million
the US
in a
because
year?
of its ability to generate incredibly strong earnings growth and incredibly consistent.
If I had $100 million, I wouldn't be investing
That's
at all.
what differentiates it because it's such a big, diverse economy.
What goes into your bullish thesis this year? It's an election year. That's pretty good.
I'll go buy me a
Last
go
year
buy
was
me an
surprising for a lot of
island.
people. Maybe
About
maybe
such
you were
Jeffrey
more
Epstein
bullish than
Island.
most of the street, but almost across the board, it surprised people how strong it was. Would you be surprised if we equaled that performance in the United States in 2024?
If we had a market that was up 26%, it would be very surprising. Our good case is up 13%. Our base case is up 6%. Last year, our base case was up 13%. Our good case was up 27%. So clearly, if we reach the kind of numbers we had last year, it would be an incredibly positive surprise.
What would be the fundamentals that would drive that? I mean, obviously, there's technicals like an election year, but would it be 6 rate cuts? What if we only get 3? Would it be no recession? What if we do get a mild recession? Would it be earnings growth of 10% plus? What if we don't get that? Would any of those things cause you to think we could have a flat year?
Our base case is that earnings grow about 6 to 7%.
6 to 7.
So that's the
How many
anchor.
Fed cuts?
And we have 4 Fed cuts.
4.
A little bit earlier, before the Fed pivot, we were at 3 cuts.
Okay.
So we've increased by only 1 cut. There were people who increased by a lot more. Our base case and our view was 3 cuts and now 4.
Sounds like Larry Fink's on the other side of that if you were just listening to him.
I was listening to some of the things he said, but I
Right,
was
I mean-
in your studio in the back.
I mean, he was making the argument effectively that there might be even less.
Less than that.
Less than 3.
Right.
Well, I think if you agree that the inflation trajectory is downward and PCE is going to
I can't believe a word this woman says. The fact that she works at Goldman Sachs is enough good enough explanation, and she's saying just the opposite of what others are saying from Goldman. So they're going to confront her.
to 3 from where we are today is a lot of cuts.
Right.
How do we get to 3 if they don't cut a lot, right? So I'm not sure the logic.
Right.
I mean, I didn't listen to everything he said, so leaving that aside, but you have to get down by a number of cuts to get to 3. Maybe he meant 3 is the long-term
No,
neutral
I mean,
rate.
Oh, no, on inflation.
Oh, and then he doesn't think we're going to get below
Right.
3.
Right. He doesn't think we're going to get below 3, so there's not going to be a need to be cutting.
Well, I think if you look at the goods component, you're seeing that inflation come down. So what held up the latest
Another
CPI
lie.
number? A bit of housing. All the more current, latest indicators on housing, whether you're looking at rental, whether you're looking at Zillow rates, is headed downwards. And we know that's a very big part of CPI. So one has to have a very compelling argument why you think inflation will be higher. And so then the question becomes, do you think we're going to have a much faster growth than about 2% growth in the U.S.? So
I love all your percentages and probabilities. Do you have any probability for any black swan events or terrible geopolitical events?
There is a good question.
i.e.
Joe, good job.
No, I'm kidding. That's what some people would think that would be the end of the world. But I'm just talking about the actual end of the world with what we're seeing in Ukraine, what we're seeing in Iran proxies, Gaza. It is a dangerous world right now. There's Taiwanese elections this weekend that could cause, I don't know, even more instability in that region. Do you have a 10% that something geopolitically could really go wrong? A pandemic, a spreading Middle East war, anything like that?
So when we go through the risks to our outlook, we basically go through a series of items. The number one risk that we have this year is an escalation in the Middle East. So we have the Israel-Hamas war, and we're saying we're already seeing some regional escalation, and we published the report.
I just can't take it. Now she comes out and says number one risk, and I've been saying it for months. That's why I'm being very, very restrained on how I'm trading. I don't want to get caught on a black swan event. If somebody gets nuked, I mean, it don't take much for someone to push the wrong button accidentally or just people's personalities have changed here in the last 10, 15, 20 years, especially in the last 3. There's a lot of, and I understand what Larry Flint's saying about hope, but you also got to be realistic and smart. And I've been through these crises where we've had Middle East issues, where we've had wars, and we always pull back. Always. Always. I can name one after another, all of them. From Kuwait to the Empire State Buildings getting blown down. That can happen in 1 minute. With open borders, we're not checking these people out. We've got a lot of people that haven't even, that are snuck in through the cartel. I think there's a coup going on in Yugoslavia. We got just a lot of bad news going around, and that guides my way of trading. So I want to be very cautious. I don't want to take too much risk. It takes just a few headlines to bring the market down because it's run on algorithms. It don't run like it used to run when we didn't have these algorithms and AI trading the market for you.
At all these big banks. Another 20 cents goes for severance expenses for this bank. And then they've got a gain of about 17 cents for tax benefits that come through this. So you strip it all out. A little tough to say. Revenue did come in slightly above expectations, $20.48 billion versus the 20.3 cents the street was expecting. And net interest income that
so that's 3 bad earnings.
Was just pointing out was a problem potentially for Bank of America. Net interest income coming in at $12.77 billion. Street account was looking for around that level, $12.74 billion, so not necessarily out of line.
I can't express. I've never seen a run like this ever in 20 years. In 2 months. I've never seen it. Never. Greed. We could pull back easily on WFC. I mean, this is an irrational exuberance. 6 rate hike cuts, they don't even know if we're going to have one. We could just stop the rate increases and let it consolidate. So a lot of businesses, it takes like two years, maybe 4 years to start to even be profitable. And then all of a sudden you decide you want to have a makeover, and then you start all over again. $47.13 is where my support would be to catch this knife. Look at there. You go back to the previous high, and that's the best way to catch a knife, or at least to try to find a support on a trade on the daily candle. And I'm not even saying that's going to hold. We could drop down to the 51. This is just too much, too fast. There's no way we'll get down to 43, but maybe this here bunch of moving averages right here. I'd short it definitely to 47. So earnings is going to be my catalyst on how I want to trade these dips and knives. And right now I have no positions because I'm day trading and scalping. I don't want to swing trade when we're at an all-time high. And we got so much bad shit going on in the world. We hit a head and shoulders right here. Hit the shoulder line. So it can definitely come back to this triple top and hold. And that's off the 9. So I'd use the 9 on the weekly. That's Wells Fargo wagon. Bank of America still has a lot of room to run. But man, if we get down to 3106, maybe back down here to the 50 SMA, right at $30, I'd probably load the boat. Load the boat and then run it back up to the 200 and then stop. Take your profit. Here's Stephanie. I know I know I'm a Debbie Downer, but you got to be.
But the quarters overall, they're kind of.
No, this chick will be a pumper.
It was expected to be like steady to down a couple of percent for the group. Fees really disappointing on investment banking and trading, offset by strong credit cards. Kind of seeing that. But very good expense control. So the bottom line number is coming in better than expected. I think the asset quality so far of what I've seen, fine. And the deposit flow is actually a little bit better. Bank of America, I don't think that net interest income number is a surprise at all. In fact, 14.1 billion is a little bit better than the 14 billion that the consensus was looking for. And Brian Moynihan, the CEO, has talked about the net interest income. We're in the process of seeing a trough, and I think that's right for the group. But again, I think
Stephanie,
it's just
to emphasize that the market is agreeing with you at this point too. Bank of America was down 5.4% at one point. Right now, it's only down by 20 cents. That's a decline of about 0.7%. So it's come back from what the knee-jerk reaction was. J.P. Morgan Chase is now up by better than 2.1%. Wells Fargo is now up by almost 1% too. So this could be a knee-jerk reaction to a very noisy and messy quarter with a lot of moving pieces in this. Joe, what are you saying?
They're now saying that so JP Morgan, I guess, earned 357 last year, and this was down, it said 302, which would have been a down year. Now, excluding one-time items, it's 397,
so
which
it is up.
is above the consensus estimate of 335. They took, it's kind of interesting, we forget, but JP Morgan, the other big banks, did have to pony up for some of the problems at the regional banks. $16 billion and $3 billion is going back into that fund. JP Morgan, I guess, earmarked that to go back in, which was one of the reasons it was down from 357 last year to I guess a gap number of $3.
Look, some of these numbers were already explained. Bank of America explained in December at that Goldman Sachs conference, but because there's so much noise, I think it's just taking some time for people to roll through all of this and try and figure out what they really think about some of the numbers. But Steph, go ahead. What are your thoughts?
Yeah, and I would totally agree. Again, really messy. We have to dig into more of the numbers, but I think they kind of are as expected. The question is, again, these stocks rallied so much from the lows, from the October lows, so maybe just a little bit of give back. Becky, these stocks are really cheap. I mean, you're getting Bank of America for 1x book. I mean, that's to me, and Wells Fargo 1x book. And even JP Morgan, which always trades at a premium, is at 1.6x book. I mean, typically that has been over 2x. And so you get pretty good yields. The capital levels are really great. I'm just looking through some of these things. The CET1 ratios are all better than expected. And so you feel pretty good about that. And so, look, if you think that the net interest income is at a trough, and you think that capital markets is also improving, which I do, and that wealth management throughout the year should be better, then I think these stocks, the setup into the year, pretty good.
Let me tell you right now the forecast on some counts from JP Morgan, because this has probably been more important than what the numbers are that we're just digesting from what's already happened. They're looking for 2024 expense outlook of about $90 billion. They expect fiscal year 2024 net interest income of about $90 billion, market dependent. They're looking for $88 billion in net interest income ex markets for 2024. And they're expecting 2024 card services NCO rate of less than 3.5%. What does that tell you?
Well, I think I always care about the expense line because they can really rein it in when they need to. But they also like to spend, obviously, on investments in technology, and that's what they should be doing. I think $90 billion guide is pretty good.
Yeah.
Yeah, that's pretty good. Yeah, I think that's fine. They probably this year did about 85 billion. So it's not runaway expenses, and I think that's really good. Yeah, no, I think that's fine.
Okay, and
I also think,
go ahead.
I was just going to say on Wells Fargo, want to listen to what they have to say with regards to net interest income. Remember this year, Wells Fargo raised net interest income 3 times. So the expectations were high. They guided lower for 2024, but I think it's not as bad as expected. So we're going to hear a little bit more of the inputs there.
Okay, Stephanie, thank you for bravely getting on and running through this as we're digesting the numbers. We always appreciate it. Great to see you, Stephanie. Definitely.
Okay, we got Delta Airlines shares are under pressure after reporting, and CEO Ed Bastian will join us next in an exclusive interview and a programming note. We got a big lineup next week from the World Economic Forum in Davos. Anyone looked at the weather?
Super cold. I did look. If you need to bring heaters, everything, there is one day, I think Tuesday at the moment, that's looking potentially in the teens. Then it gets up into the 20s, and maybe by Thursday, we might be in the 30s. That's the hope. Welcome back to Squawk Box. Delta Airlines reporting results just in the last hour, as we've gotten a bevy of results from others as well. Phil LeBeau joins us now with a very special guest this morning. Phil.
Thank you, Andrew. Ed Bastian, CEO of Delta Airlines, beat on the top and the bottom line. Let's talk about the end of last year, but more importantly, what's going on in 24. Strong end to the year, but it was a clean quarter, and that's what you expected if you had a clean quarter, right?
That's exactly right. Thank you for coming down, Phil. I know you've had a busy week, so appreciate seeing you down here in Atlanta. I want to thank our team. Our team did an amazing job all through the fourth quarter, and we did deliver a great set of results. Starts with the operations. Our operational reliability was best in class across the industry all through the quarter. The holiday periods, Christmas, New Year's, that's our Super Bowl. We show up that 15-day period during that stretch. we served a record 9 million customers on 60,000 flights, 90% on time, and less than 40 cancellations in aggregate over 2 weeks. So that speaks to the health of the business. The demand set is following through accordingly. We set a record this year again on revenues, 20% above pre-pandemic levels already in 23, and 24 is starting off in a good spot. Just earlier this week, we set an all-time high sales day in our history on Tuesday.
So let's talk about 24. 23, transatlantic was booming, and you had strong domestically. When you look at this year, where do you see the strongest growth?
I think the strongest growth will continue to be international. That's where you see a lot of the carriers, both U.S. as well as international, continue to play to. Last year, particularly Europe was on fire. I don't think one busy season is going to quench the desire, particularly for Americans, to go over to Europe. So I think Europe will still be a very healthy environment for us. Latin America is picking up, and that also is a strong market. We'll continue to see what's happening in China. China is a bit limited, but other parts of Asia are doing well. But the most interesting thing of all is what we see happening in the domestic system. Our domestic market, particularly in the lower end markets in the back half of the year, where a lot of the challenges are in the budget carriers and the low end.
Yep, a lot of capacity.
That capacity is getting rationalized. Supply and demand are coming into better balance. We expect to see an inflection point in the first part of this new year in terms of our domestic unit revenues turning positive. And also corporate travel is up. Again, it finished the year strong and it's picking up again. So we're now probably back almost 90% of where we were pre-pandemic levels and continuing to build.
You announced an order this morning for buying 20 Airbus A350s. You're not starting deliveries until 2026, but this speaks to adding that capacity, especially for the long-haul flights.
Yeah. Long-term, our future is international, right? I mean, the domestic system is largely congested. We continue to grow, we continue to build, but it's bigger planes, not new runways that are being created. The skies are congested. I don't expect that changing anytime soon. So the growth in our business has to be international, and we're using this position of strength that we have together with our partners to grow that book of business. And the Airbus 350 is a great product, and we're going to expand. That is our flagship, and we're going to be expanding that with the 1,000 coming in.
You do not have any Boeing MAX 9s in your fleet, but you do have MAX 10s on order. Mm-hmm. And you have Boeing planes within your fleet. Have you lost confidence in them as a manufacturer? Are you more concerned about future aircraft you may take from them?
I've not lost confidence in Boeing. Boeing is a great company. Boeing is so pivotal to our industry. It's pivotal to our economy, and they will figure this thing out. We don't operate the MAX, so I can't tell you anything specific to the MAX that you probably know more than I do, Phil. But when you look at Boeing, I think the issue is certainly isolated to the MAX. We fly over 500 Boeing airplanes every single day, day in and day out, with magnificent performance. I expect they will solve the issue, and when they do, that's when we'll take the 10.
Quickly, I want to ask you about what you said with regard to demand and corporate demand, up to 90% pre-pandemic levels. Is it just a steady increase in terms of the number of companies saying, you got to get back out on the road?
I think as people saying that, getting back out on the road, I think as businesses continuing to open and mandate that people be in the office, because if you're not in the office, there's no one to go visit in that respect, particularly with the consultancies. The tech companies are the area we're starting to see growth. And the other thing that hit us towards the back half of last year were the strikes, both in Detroit as well as LA with the writers.
Yep,
and
two hubs.
Those are our two hubs. We're the biggest providers in both those markets. Now that they're back, that business is coming back strongly as well.
Ed Bastian, CEO of Delta Airlines, on a day where they beat on the top and the bottom lines. Guys, we're going to be back. I will be back in about a half hour. We're going to be talking with Mike Whitaker, the FAA administrator. We'll discuss the situation with Boeing, and that's coming up at 7:40. Guys, back to you.
Okay, Phil LeBeau, we really appreciate it. Thank you very, very much. We will see you in just a little bit, as you just said. In the last hour, we spoke to BlackRock CEO Larry Fink about the SEC's approval of the Spot Bitcoin ETF. This is what he had to say.
These are just stepping stones towards tokenization. And I really do believe this is where we're going to be going. We have the technology to tokenize today. If you want to think about this. If you had a tokenized security and you have a tokenized identity, you, Andrew, the moment you buy or sell an instrument, it is known. It's on a general ledger that is all created together. You want to talk about issues around money laundering and all that. This eliminates all corruption by having a tokenized system.
Coming up, but right after this, we're going to talk to SEC Chairman Gary Gensler on his big decision this week. Despite his caution about Bitcoin and crypto, he will join us right after the break. It's something you do not want to miss. And then at 8 a.m. Eastern Time, a first on CNBC interview, hedge fund billionaire Bill Ackman joining us for an exclusive. First time he's spoken out on television about his battle against anti-Semitism, Harvard, DEI, and his big battle now over plagiarism accusations against his wife. All of that and more as Squawk Box returns after this.
Muddings.com.
Welcome back to Squawk Box. On Wednesday, the SEC approving 11 spot Bitcoin ETFs, nearly $5 billion worth of shares traded across these ETFs on one day. Joining us right now, first on CNBC, following that decision that some have described as historic, is SEC Chair Gary Gensler. Chair Gensler, we appreciate you being with us. Let me start by asking you this. Do you consider the decision historic? And it appears that it's a decision that you made either reluctantly or perhaps even begrudgingly.
Well, look, Andrew, this has been considered for a long time. As you know, starting under Chair Clayton, we had disapproved a number of these over the years, and something had changed. I'm a deep believer in the rule of law and a respect for the courts, and taking a new court decision into consideration, we move forward. I think this is the most sustainable path forward.
So it appears, though, from what you're saying and reading through the decision as well, that what changed is not necessarily something inherent to crypto or Bitcoin per se, but what changed was what the courts did. Is that the way to think about this?
Well, again, I mean, we do everything here at the Securities and Exchange Commission within the law and within how the courts interpret those laws. And that's what the American people expect, and that's what we do here.
What is your message to investors about Bitcoin now? Because we're going to have all sorts of public investors now potentially have access to Bitcoin in a way that they didn't before. We were just talking to Larry Fink. He said that he got a huge wave of new investors getting into Bitcoin through this ETF. You have still suggested to be cautious about it, and I'm trying to understand how you think about those cross currents in terms of the message you're telling investors.
Well, look, Bitcoin itself we did not approve, we do not endorse. This is a product called an exchange-traded product, a way that investors can invest in that underlying non-security commodity called Bitcoin. But yes, investors, I think, should be aware that the underlying asset is a highly speculative, volatile asset, and amongst its use cases is really for illicit activity, money laundering and sanctions and ransomware and the like. And I know that you've asked other people over the last few days, is it being used as a store of value? It's a speculative, volatile store of value. Is it being used as a payment anywhere? Are we buying cups of coffee with it? Not really. The only payment mechanism it's being used for, in a primary sense, is illicit activity. So I think you've been spot on about that, Andrew.
So, just on that note, Mr. Chairman, this is out, and I'm not going to take either side on the whole thing, and it's kind of funny. But these are, I don't know the exact units, but if you look since 2017, what's been used to launder money, 20,000 is the unit for, 20,000 is the unit for $1. 33 is the unit for Bitcoin. So that's a multiple of I don't know how much for dollars being used for money laundering versus Bitcoin. But now I could see Bitcoin bears saying, really? Well, it's not even good for money laundering. Then it has zero value. I could just see that as another arrow in the quiver for the bear case. But the question I wanted to ask you was this: let's take the continuum. Let's take the rat poison, Beanie Baby, Jamie Dimon, Charlie Munger versus we had yesterday on our Coinbase CEO. Did you hear him make the case for Bitcoin? I mean, it was almost like a symphony to Bitcoin bulls, Chair Gensler. The proof of work, akin to gold. Every monetary aspect we've had for thousands of years is represented perfectly. And Tom Lee, there's never been a mistake on the blockchain out of trillions of transactions. You understand it. You taught at MIT. Which is it? Is it a Beanie Baby in your view, or is it something that has inherent value that's going to be part of the financial system decades from now? Which is it?
Look, no doubt there are innovations within this field, and those innovations which I taught about at MIT around a ledger system. It's just an accounting system called the blockchain technology. But there's an irony in the midst of this. Satoshi Nakamoto said this was going to be a decentralized system, and finance, this has led to centralization. Think about the irony of those who say this week is historic. This was about centralization and traditional means of finance that investors who could already express themselves in Bitcoin, you could already, before this week, buy it through major brokerage houses, but now you can buy it through this thing called an exchange-traded product as well, centralized.
The underlying asset still has the decentralized, distributed ledger, all those characters. That sounds like a, I don't know, that sounds like
No, Andrew, with all respect, there's a lot of centralization here, and even the underlying ledger is largely, the Bitcoin's produced by a handful of mining companies and the like. And so I'm just saying, now in terms of monetary history, we have a dollar, we have a yen, we have a euro, we have the renminbi, and there's a reason for it because we do have a common economy that relies on those currencies.
Chair Gensler, let me ask you this though. Is there a possibility, despite the fact that this has been now approved, that this spot ETF has been approved, that you could see a day where Bitcoin itself in some way would be outlawed? I asked because if you recall, and now there's a lawsuit taking place between Coinbase and the SEC. They went public and they've now made You've come back and said there are certain unregistered securities and the like that are on their platform. They say, well, if you approved us the first time, how can you come back and say that this is not kosher? And so I think there is this other question about, and I know you're not endorsing Bitcoin, does that still open up the possibility that Bitcoin could somehow come under fire from the SEC or some other agency?
Look, let me talk about this field more broadly, and the American public is aware of this. It's rife with conflicts, it's rife with fraud and abuse, without prejudging any one token. Many of these tokens, I would suggest a majority of these tokens are actually securities under the securities law. And so the platforms, the various places that you might buy or sell these crypto security tokens need to come into compliance with the federal laws.
What did you make of what Elizabeth Warren, who was very supportive of you taking this role originally, coming out and saying the SEC is wrong on the law and wrong on the policy?
I have deep respect for those who may have been on the other side of this, but again, I have a deep respect for the law and how courts interpret the law. We had the DC Circuit, a three-judge panel rule on this. We looked at it, and I thought this was the most sustainable path forward.
How do you think about other cryptocurrencies? People are now talking about whether there should be an Ethereum ETF and the like. Is that something you think you would take on proactively? Is that something that ultimately, in the same way that Grayscale had to go to court, does the court decision around Bitcoin to you act as a precedent on other currencies?
I look at what we did this week as it's cabined to one non-security commodity called Bitcoin. Like we've had gold, spot, exchange-traded products, and silver exchange-traded products in the past and approved in the past, this is cabined just to that one non-security commodity token.
Larry Fink made a fascinating point earlier this morning that the industry, including BlackRock, had campaigned to you to ask for the ability for those who owned Bitcoin through, for example, a Grayscale, that fund, to be able to transfer those assets to others, a Fidelity, a BlackRock, an ARK, some of the others who have gotten these approved ETFs, and to do so without effectively selling that and creating a tax at that moment. You have said that is not allowed, but however, when it comes to stocks, and I believe in most commodities, you could move those from different funds to funds, no? What was the decision process and thought process around that?
Look, of course, I think your public can understand we're not going to get behind like any discussions between one registrant asking staff for guidance about these things. But what we did this week was cabin just to these filings from the stock exchanges about listing these exchange-traded products. I would note that one of them, the largest, as you said, Grayscale, it was already trading in the over-the-counter market. So in essence, you get the added investor protection of the stock exchanges surveilling the market and surveilling them for fraud and manipulation and trying to help and protect the public in what otherwise is a highly speculative, volatile asset that's by and large been trading in the spot market on non-compliant, conflicted exchanges.
You emphasize that a lot, Jurgen, so that's the thing. You've said it 3 or 4 times, highly speculative, very volatile, and you make the point that the court decision is really paramount in your decision, and that you still, it just gives me the impression that you think investors really, really need to be protected, and you're unable to do what you'd like to do because of the rule of law, which is to not allow for a spot ETF. And then you mentioned gold spot ETFs. Do you think there's the same protection needed for investors that invest in gold ETFs? Or do you think that Bitcoin is completely different in terms of the risk and the amount of warning that investors should get if they tread here?
Look, each have their risk, and we're, by statute, we're merit neutral, but we also have an investor education perspective. And I would say broker dealers and investment advisors have obligations. The investment advisors have fiduciary duties, and broker dealers have a rule on the books called looking out for people's best interest. And so that's why I'm raising some of these risks.
Chair Gensler, want to thank you. It is a longer conversation, and we hope to be able to have that with you in person at some point soon. We very much appreciate you joining us first here on CNBC after what, as I said, some people have seen as an historic decision. I think you may differ on that, but we will talk about it again, I'm sure, with you very soon. Thanks again.
I think the volatility is key too, because he did point that out at the conversation.
But there are a lot of things that are very volatile. It seems like when we say drag kicking and screaming, that's really what is it. If it goes badly, the SEC can say we didn't want to do this, right?
Sure.
I think he's been very public about
That's
this.
what I mean. But that seems to be the.
Well, the other question which we didn't have enough time to talk to is, could have you taken this to the Supreme Court? Could have you actually, from a legal perspective, if you felt so strongly about it? But I think they saw the writing on the hand.
But isn't it amazing that people can look at this? People can look at the same math, and he's part of MIT and come up with.
He's got a course on this.
Totally, that's what I mean. Totally
he's
different.
as concerned as
Think of an orange or
but
whatever.
as we said,
I
I think Jamie Dimon is one of the smartest people in finance, and he has a very particular.
And then
view
you
of
got
this.
everybody on the
Gary,
other side.
no, and Gary, not everybody else. Gary Gensler.
No, we've got a lot of other. Paul Tudor, Stan, Andreessen, Peter Thiel, the Winklevi.
Bye. We'll be right back.
Time now for today's Aflac trivia question. What golf course was founded in 1891 and is said to be the first American golf club to admit women members? The answer when Squawk Box returns. Golf course was founded in 1891 and is said to be the first American golf club to admit women members. The answer, Shinnecock Hills Golf Club in Southampton, New York.
All right, right, still to come this morning, the markets will have more inflation data to deal with today. Yesterday was the CPI. Today we get the producer price index for December. That's hitting at 8:30 a.m. Eastern time, less than an hour away. But will this data and future reports push the Fed to start cutting rates by March? Our next guest says yes. We'll hear that case next. And later, I'll have an exclusive interview with Bank of America CEO Brian Moynihan. That is live at 2:10 p.m. Eastern time. Bank of America shares right now, let's take a look. They bounced around a little bit this morning. Initially, we're under some pressure. Right now, off by about 1.5%. That company reported just in the last hour, beat on the bottom line, but we'll talk about a lot of the moving pieces there. Squawk Box will be right back. Welcome back, everybody. Our next guest says that she expects the Fed to begin cutting rates in March. That's in direct contrast to Cleveland Fed President Loretta Mester, who will vote on interest rate decisions this year. Mester said yesterday that March is likely too early for a rate cut. Ann Walsh is the Chief Investment Officer of Guggenheim Partners Asset Management. And first of all, thanks for being here this morning.
Thank you very much for having me.
So yesterday, the CPI came out. It was a little hotter than had been anticipated, and when you look through some of the lines. Today we get PPI, and obviously we're all trying to figure out what the Fed does next. Where do you think we are on track with this economy? What do you think the Fed will do?
So, as was introduced, we do believe that the economy is continuing to slow down. Inflation is also on a disinflationary track. Yes, the CPI print at a headline level came out pretty hot, particularly as regards owner equivalent rent. But if you look through to the component parts of the report, that really still indicates that PCE, core PCE, which is what the Fed really looks at, is still on track to be right around 2%. And I think that's critical. Additionally, what we're seeing evolve in the economy is kind of a bifurcated economy, and that is there's those companies that are doing pretty well, and then there's sections of the economy that are really slowing down significantly. For example, manufacturing has been in a bit of a slowdown, maybe a recession, if even over the last, say, 18 to 22 months. And so as a result, what we're seeing is this sort of bifurcation happening, and the economy is continuing to slow down. We remain in the camp of believing that we are still seeing a recession, although mild. It's always been our expectation that it would be a mild recession. And, you know, I tend to refer to it as a rolling recession. Depending on where you are in the economy is how you're going to feel about the economy. And what's coming next is really commercial real estate, office properties in particular. And so we're still in this sort of evolution, if you will, of slowing parts of the economy down. We think this leads to the Fed being more in line with historical precedent in terms of recessionary environments, where they will be lowering rates, and a little sooner than market participants now believe.
What you're saying about the economy makes a lot of sense, where you're seeing the rolling recession work its way through, but what we're seeing coming down the pike could be concerning too. Oil prices up 4.5% today after the U.S. and its allies made these strikes on the Houthi rebels on land. I mean, that's a big provocation, and it is a huge issue to see shipping costs start to climb up too. You wonder if that's going to work, all of it's going to work its way through the supply chain. Increasing inflation, at which point I think the Fed would come down on the side of fighting inflation rather than saving the economy from a downturn.
Well, agreed, except they're already still keeping conditions relatively tight. Remember, they're still reducing the balance sheet, and quantitative tightening is occurring sort of in the background. A lot of people aren't necessarily paying attention to it because they're really thinking about rates. And by the way, the market does a really poor job of pricing in geopolitical risk and the expanding geopolitical risk. It's one of our macro themes for 2024. Is the evolution of the hotspot around the globe, and so yes, that is still a risk to the downside.
Well, Mohammed El-Arab was with us yesterday, and he pointed out that the Chicago Federal Reserve has this argument going that conditions are actually a lot looser now. Monetary conditions are looser, and you're seeing this activity. So even without that, the Fed may be having this internal argument about what to do.
Absolutely, and what we're seeing though is real rates are really still elevated. If inflation, particularly core PCE, is running around 2%, and you're looking at a 5.25% essentially, or 5.30 on Fed funds and SOFR, then you're looking at a pretty tight real rate of interest for borrowers, and so that has a very significant slowing impact as well for the future.
What are you telling clients to do this year? You like fixed income, especially high quality fixed income?
High quality fixed income has performed very well in periods of time where the Fed goes on pause or starts their easing cycle. And so we think that's going to continue to be a very good place. We anticipate rates to continue to come down. The 10-year hanging around 4%. Our target is it will evolve down to about 3.5% as, again, inflation continues to decline and the economy slows. And that's very well positioned for investment grade fixed income. Corporate credit does well, structured credit does well in this environment. So we really think that that's the best place to play the market.
And thank you very much. Good to see you.
Thank you.
Let's get back to Phil LeBeau with some breaking news on the Boeing 737 MAX 9 investigation and another special guest. Hey, Phil.
Thank you, Joe. Let's bring in Mike Whitaker, the FAA administrator, who this morning is announcing that he would like to see greater oversight of Boeing's MAX 9 production, including the delegated authority, which is the process for reviewing the aircraft as they're coming off the assembly line. Mike, thanks for joining us. Explain exactly what you would like to see increased in terms of FAA oversight.
Thanks, Phil. Thanks for having me. So what we're doing is we're increasing oversight of the manufacturing process. So we know there are problems with manufacturing. There have been problems in the past, but these are continuing. And the aircraft that was involved in the accident last week in Alaska was less than 3 months old. So this is a brand new aircraft. It has just come off the line and it had significant problems. And we believe there are other manufacturing problems as well. So this is all about finding where the risks are, identifying the risks and mitigating them. So we're going to increase oversight by auditing the production process at Boeing and at Spirit, increasing our oversight on the ground, but also our oversight of data. And frankly, as you mentioned, I think we need to look at who's got authority to make approvals and how that works, this delegation of authority. We want to commission a review of that and see if that's a risk in the system as well.
Should there be a third party, Mike? Should there be somebody independent of Boeing on the floor in the Boeing plant saying, yes, this is good to go, or no, there's a problem here?
Well, I think it's an option we should look at, and there's been a lot of debate around delegation. It used to be FAA that did quite a bit more. That was moved by legislation to the private sector. That works great in a lot of instances, but sometimes it doesn't. And so rather than debating whether it should move back to FAA, I think we should also look, is there a third-party option? Could we get a technical nonprofit organization that provides that approval or oversight, and then we oversee that organization? So it's just an option. It may not be the right option, but I think we need to have that debate.
Mike, I want to ask you about the discussions with Boeing on an inspection protocol for the MAX 9s that are grounded. When do you think that you'll have that worked out so that they can start these inspections and potentially get those planes back in the air?
We think it'll be worked out when we're sure that it's going to be safe. So we need to make sure these aircraft are all inspected and they're all returned to the condition that meets the certification requirements. There's been a huge amount of work, as you can imagine, this last week, really around the clock, by FAA safety teams, by Boeing, by the carriers, and we're working on an engineering solution. So when we're satisfied that that's safe, that will be issued.
Just to be clear here, no time frame. In other words, it's not something you're expecting in the next day or two.
I think you can count on me to never give you a time frame for when something's going to happen if it involves a safety review. So we're going to go with it when it's safe.
Mike Whitaker, FAA Administrator. Mike, we have to keep this a short interview, busy day. We appreciate you joining us exclusively on Squawk Box. I know we'll be talking more in the future. Joe, I'm going to send it back to you.
Thank you, Phil. Coming up, U.S. and British forces conducting retaliatory airstrikes on more than a dozen Houthi rebel targets in Yemen after weeks of attacks on ships in the Red Sea. Former Deputy Assistant Secretary of Defense Elbridge Colby is going to give us his reaction to the latest escalation in the Middle East. And we're going to talk about those Taiwanese elections. The favored candidate would not make China very pleased if that were to pass. And we'll find out what the chances are with Elbridge Colby in just a minute. A U.S.-led coalition launched airstrikes on the Iran-backed Houthi rebels in Yemen in response to the shipping attacks in the Red Sea. For more on this, let's bring in Bridge Colby, a former Pentagon official in the Trump administration. He's also author of The Strategy of Denial, American Defense in an Age of Great Power Conflict. Bridge, it's good to see you. We were on a panel together with our friend Ro, who is out. I can start in Ro Khanna, Congressman. I can start with his comments this morning. He thinks that President Biden, and Ro's a Democrat, he thinks that President Biden needed to clear this with Congress. I see that every once in a while when a president does something. That wasn't going to happen, right?
Right, I think that was unlikely. It was great to be with you again. And no, Congressman Khan is out early saying that the president, and some Republicans like Senator Mike Lee from Utah, saying that he needed a congressional authorization. But as you said, I think like pretty much most presidents in the modern era, President Biden has moved forward with what he thinks is the right course.
And do you think it was the right course? And we didn't have much choice.
Well, look, I think we're in a really bad situation here. We're getting sucked into a Middle East conflict. I mean, I think stepping back, you see geopolitical factors popping up all around the world, more than popping up, becoming worse in Europe, now in the Middle East. And of course, there's the looming confrontation with China potentially in the Pacific, and we're not prepared for it. Our military is not capable of handling multiple theaters. The last thing we need is to get drawn into a Middle East conflict, and that's not just because we're tired of it, but because our military doesn't have the capacity. And unfortunately, I don't think the strikes last night are going to make a fundamental difference. The administration itself is already saying that they're anticipating a Houthi reaction and possibly escalation and a continuation of the strikes against shipping in the Red Sea.
Then what do you think would be the proper course for us? So we don't have great options.
We don't have great options. Look, I think that we have a set of bad options. The least bad options is to get local partners, like the Israelis, like the Saudis, who we frankly have kind of alienated over the last few years and are now in a pretty bad way, to take more responsibility for security. Our European partners, I mean, Europe is more exposed to what's going on in the Red Sea than the United States. We are as well, indirectly, given the shipping implications and inflation and so forth. But I think we really need to push this around. And this is fundamentally inconsistent with what I think President Biden and frankly some Republicans as well saying, look, we're the global policemen, we're everywhere, we're America, we can do everything. That's not the right attitude, and it's becoming more and more sort of glitches in the matrix are appearing here again. I mean, the idea of getting involved in a war in Yemen, in addition to our active involvement, although possibly quite a bit less, in Ukraine, the potential for something breaking out in the Korean Peninsula, and of course Taiwan. I think 2024 is going to have a lot more geopolitical intensity and possibly surprises, unfortunately.
We've had people come on and say, yeah, there's some important elections coming up, and God, I don't know how loudly or I don't know how to say it to where it really gives it enough import for people to sit up and take notice. But let's focus on Taiwan, which a lot of people have no idea what's happening. Can you handicap? I think there are three possible outcomes, and the most likely could be significant in that China really wouldn't like it and would leave it with only really military options at that point.
I think that's right. I mean, basically, there's an election coming up over the weekend. The DPP is the ruling party, has been for 8 years, is traditionally leans towards independence. The candidate of that party, named William Lai, at least in English, is leading. There's a Kuomintang candidate who's not pro-PRC, but is considered a little less offensive from Beijing's point of view. There's a third-party candidate who isn't expected to do as well. The handicapped outcome is that Lai, the DPP candidate, will win the presidency, but the KMT might have, if not a majority, maybe a plurality or something in the legislative yuan, so split government. I think the key point for markets here is the election is a significant point, but fundamentally, it's very, very clear, the Journal was reporting this the other day, that there's no path for peaceful unification to China. Ma Ying-jeou, the former president of the KMT, was saying, oh, we need to be nice to listen to Xi Jinping. That has no traction on Taiwan. So if you're in Beijing, you know that. You know there's no peaceful unification scenario. Xi Jinping has pledged to resolve this issue. And in addition, Xi Jinping and his leadership believe that the United States is trying to strangle them. So there's been a lot of attempt by the administration and by China to downplay the risk of confrontation over this decade. But China's acting in a way, don't look at what their lips are saying, look at what they're doing. They are preparing for confrontation, including economically. They are not changing economic course despite the economic headwinds they're facing. And that's a costly signal of what the future holds. And this year, you see the United States, by its own admission, administration officials admitting that they are too tied down in Europe, the Middle East, and with the re-election campaign. This is a very dangerous situation. We haven't even seen what might happen on the Korean Peninsula, where the leader there, North Korea's Kim Jong-un, has said, I'm giving up prospects of peaceful reunification, more or less. So it could be very bumpy. And of course, if Lai is elected, Beijing has signaled that that's a potential predicate for much more forceful action. What that is, I can't say, but I think we buckle up.
So we'll know in all likelihood that is going to be the outcome. So this could start happening as early as next week. And you said, it's a non-zero probability that someday there is some type of armed conflict with China.
I'm not an investor, but I think if you are, I think it's hard to imagine getting out of the 2020s without either a major war or think of the Cuban Missile Crisis kind of crisis.
Yeah. Okay.
They're preparing for it. They have a timeline. They have a sense of urgency, and they're acting to prepare for it. Whether it happens this year, I don't know. That might be a little bit early, but there are a number of factors that could make that more attractive. And I think an invasion is what you would see. And here's the key point. They need to act with surprise or relative surprise, so people are not going to get a long runway of warning about it.
Rich, thank you. Great having you on. Hope to see you again soon on this and other matters. Thanks.
Joe, when we come back, we're moving around the city with lots of big exclusive news and interviews all morning. We've got another big one right after this. Billionaire hedge fund manager Bill Ackman is going to be our very special guest as we get into so many headlines he's been making over the past several weeks and months. His battles against anti-Semitism, Harvard, DEI, and the plagiarism allegations against his wife. We'll talk about activism and everything and more in the next hour after this. Good morning. Earnings kicking off with the big banks. We're standing by for Citi's fourth quarter results and breaking inflation data following CPI yesterday. We're due to get producer prices in just 30 minutes. And Bill Ackman on the rise of anti-Semitism leadership at top American universities and the debate that's flared up over what actually constitutes plagiarism. He's going to join us live for an extended conversation exclusively as the final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. U.S. equity futures at this hour. Take a quick look. Not a whole lot of action. We do have 173 points though down on the Dow. Some of that's United Healthcare. I haven't looked at JP Morgan recently. That had been trading higher.
We'll see it.
That Dow component, but there's some weakness this morning. Whether it's Fed related, we can look at
JP Morgan's still up. Yeah.
It is. Treasury yields, take a quick look down. 399 now on the 10-year. Probably ought to look at Bitcoin. I don't know how closely you watched it yesterday, but it did look like it was off to the races briefly. It was above 49,000 at one point, and I think this morning it's down below 46 at this point, 45,845. So not a little bit of give back today, but compared to the highs yesterday, it's about over $3,000 or 8 or 9% lower than after the initial excitement about the spot ETF.
You did see a big buildup in the weeks and months leading up.
That's it. We wondered about that. Whether my view, I said yesterday. It was hard to buy a Bitcoin institutionally. Now everyone can buy it. Is everybody going to get rich right away? Made a lot of, or some of the people that already got rich from it, are they going to be offloading? I don't know. The holders never sell, but some people sell.
That's right.
Yeah.
In the meantime, Citigroup out with its fourth quarter results. Leslie Picker has those numbers. Leslie, take it away.
Hey, Becky. Yeah. Noisy quarter here for Citigroup. Shares declining at the first read here. I'm going to avoid comparing estimates for now because the firm put out an 8K 2 days ago with several $1 billion worth of charges that aren't reflected necessarily in the full consensus. But here's what I do see in the fourth quarter. Citi is reporting a net loss of $1.8 billion and a net loss per diluted share of $1.16. So excluding those 8K items, which include a reserve build, the FDIC special assessment, pressure from Argentina's currency devaluation, and restructuring and severance charges. Excluding those, Citi would have earned 84 cents per share or positive EPS. Top line declined by 3% to $17.4 billion when adjusting for those for the one 8K item that was contra to revenue. CEO Jane Fraser saying in the release, quote, "While the fourth quarter was very disappointing due to the impact of notable items, we made substantial progress simplifying Citi and executing our strategy in 2023. The quarter saw pressure in fixed income, currencies, and commodities trading. That division saw revenue slump 25%. The wealth business was down by 3%. Bright spots as you go kind of business by business were services and personal banking, its two largest groups by revenue, which were up 6% and 12% respectively. Investment banking also did surprisingly well in the quarter with gains of 27% to $669 million. Now, this is the first time Citi is reporting under its new 5-division organizational structure, so investors sifting through today's release will be comparing businesses a little bit differently than they had in the past. We'll be sitting down with CFO Mark Mason later today on Closing Bell, guys.
Leslie, congratulations. 4 banks made it through the first couple of hours of the first the kickoff of the big bank earnings season. Leslie Picker, thank you. We'll see you a little later today. In the meantime, let's get a check on all those big banks that have reported so far this morning. Bank of America off right now by about 2.5%. JP Morgan Chase up by the same amount. You've got Wells Fargo down by 1.5%, and now Citigroup, knee-jerk reaction, up by 2.3%. As Leslie mentioned, there's a lot of noise in this quarter with the special assessment coming from the FDIC and other one-time charges and gains with every one of these banks. So we will dig through all of it. get a bigger picture about what to anticipate from the economy from these companies too. And a programming note for you, we're going to be speaking with a slate at the big bank and financial executives next week from the World Economic Forum in Davos, Switzerland. Bank of America's Brian Moynihan, JP Morgan's Jamie Dimon, Blackstone's Steve Schwarzman, Goldman's David Solomon, and Morgan Stanley's Ted Pick. Coverage starts Tuesday at 6 a.m. Eastern Time, but today I'll be speaking a little later exclusively with Brian Moynihan. That's coming up at 2:05 Eastern Time. We'll talk to him about today's results too. Andrew?
Thanks, Becky, and we're looking forward to that interview. Now to the news that broke earlier this morning. I want to show you BlackRock announcing it's buying Global Infrastructure Partners for $12.5 billion in cash and stock. The acquisition, part of BlackRock's increased focus on infrastructure, which CEO Larry Fink saying is now one of the most exciting long-term investments, he says, in terms of opportunities, he says, coming ahead. Here's Fink on Squawk Box when that news broke.
The world's capital markets are going to become a larger and larger component of economic activity across countries, across the globe. And as I said, if we are going to really elevate our infrastructure as a world and the need for stronger, better airport power grids, infrastructure as an asset class must grow, and we believe that we are seeing that. And so we are making a large statement that we believe in the private markets, the future growth in infrastructure is going to be faster than almost any other.
And BlackRock also reporting fourth quarter earnings this morning. The firm beating analyst profit estimates and matching revenue forecast just over $4.6 billion. When we come back, a very big news-making interview, this time with Pershing Square CEO Bill Ackman. So much to talk to him about: the battle over plagiarism, what happened at Harvard, and so much more. You do not want to miss this. Squawk Box returns in just a moment. Squawk Box. Our next guest is Pershing Square CEO Bill Ackman. He has been one of the most outspoken voices against anti-Semitism on college campuses in America. He's also pushed for 3 university presidents to resign since that Capitol Hill hearing early last month, during which those leaders were widely seen as not defending their Jewish student populations. 2 university presidents did resign. One of them, now former Harvard leader Claudine Gay, became embroiled in a plagiarism scandal, a topic which has now touched on Ackman's own family. Bill Ackman is here, and this is your first major television interview since this all began. We did talk once briefly on Squawk. I think you had called in to talk about what was happening, but in the past couple of weeks...
That was about DEI, though.
That was about DEI, but of the past couple of weeks, you have been active throughout on X, outspoken on all of these issues, especially as there have now been attacks against your wife around the idea of plagiarism. I want to sort of just untangle all of this, because I think people are trying to understand what is motivating you, how this all began, what you're trying to do. There are issues about DEI and free speech and other things as well. But you have become one of the most influential, provocative, and polarizing voices in this debate. So let's start with where this began back in October for you.
It actually began before October, and it began in this room. You know, this is our boardroom at Pershing Square. It also happens to be the place we host our Pershing Square Foundation board meetings, a board that my father was a member of. And literally every meeting, my dad would say, "Bill, you're just not doing enough about anti-Semitism. I think it's a really important problem. You need to focus on it." And I was very dismissive of my dad. I love my father. He passed away in May.
You dismissed your dad?
I said, look, the Jews are doing great. I'm not experiencing, I don't see Jews experiencing a lot of anti-Semitism. And we focus on economic empowerment. We focus on, enhancing people's ability to, 1-acre farmers in Kenya, things like this. And then Dad had heart surgery coming up, and he was very concerned about it because it was kind of life or death. And he wrote me 3 letters. One was, here are my instructions. If I die, memorial service, etc. This is what I want you to do with your mom, financial estate planning. The third one was like a long letter about anti-Semitism. He said, look, Bill, I want my last words to you to be, this is something you need to focus on. And I didn't do anything, to be honest. And then October 7th happened. And it was really October 8th. And it was when 30-odd Harvard student organizations, my alma mater, came out and said, the morning after the most horrendous, barbaric terrorist acts in history, at least in modern history for sure, they came out and said, you know what, it's Israel's fault. Israel's solely responsible for these horrendous, heinous acts. And then that was the beginning of this journey.
And you have taken, dare I say, an activist approach to this.
Yes.
You've also been criticized for the activist approach. There's been some who have been very praiseworthy of what you have done in terms of pushing on these issues. But at the same time, there has also been a remarkable backlash. And we're now seeing that backlash manifest itself in the attack on your wife as it relates to accusations of plagiarism.
Yes.
How has that made you feel? And has it changed your view about how to approach these things? Because there's some who say this was really great, what you were doing. But there's others who say that you have taken it to some degree too far. And in fact, by being such a big figure in this conversation, that it actually has made it harder to get what you want.
I disagree. Actually, I think, first of all, if you're going to go out there in the public eye and you're going to make statements, strong ones, about issues that are controversial, you're going to be criticized. Hopefully you're going to be applauded as well. When they go after your wife, you know that you're making some progress. I mean, I feel very, the worst of this is for Neri, who did no wrong, who said nothing really publicly. But it means we kind of hit a chord, if you will. Like I talked about it, it started with anti-Semitism on campus. Then I got concerned about governance at Harvard. Not just the president, but when the board, in my view, didn't do the right thing. Then I broader concerns about higher education generally. And then, the origins of anti-Semitism on campus, I think, which are result from the so-called DEI movement. I think these are very important issues, and these are issues that will require resources to be focused upon. And I would say, I was extraordinarily committed before. I'm undeterred, and actually I'm standing up an organization very shortly to focus on precisely this.
What's that organization going to do?
It's going to be, I would say,
the problem with think tanks, they write a bunch of papers, nothing happens. I would say it's going to be a think and do tank. It's going to be an activist. We're going to study these issues, and we're going to come up with solutions to problems, and we're going to implement.
And what are those issues as you see? This is about anti-Semitism, or this is about free speech, or this is about DEI, or this is about governance, or
all the above.
plagiarism?
All the above. All the above. So, I have a day job, Pershing Square, my job I love. And at the early days of Pershing Square, I paid my own bills. But you know what? That's not a good use of my time, so I hired some people to do that. I used to do all of my own philanthropy, but that started to become a bigger responsibility, so I set up a foundation, a board of directors, hired a team. This, I've done other initiatives like this. You and I were on TV to talk about child sex trafficking and visas, providing the payment rails, if you will, for pornography sites, YouPorn. And it was a 30-minute interview and a few tweets.
Yep.
This is a bigger project, and it's now, this kind of activism now requires, sort of a serious team. We've got some extra space. I'll rent some space. I'll hire some people, hire a CEO, put together a board of directors, and we're going to go after these issues in a very aggressive way.
I think there's a lot of people who are watching you write on X, almost by the hour, constantly. Can you just take us inside both your own head on this, your home, what this has felt like? Because there's an interesting dynamic at play, which is you have long been somebody who has attacked others in the context of activism. And now, in some cases, arguably you are being attacked, and your family's being attacked.
I was attacked before. Remember, if you're an activist short seller, you undergo the most aggressive attacks. So I'm kind of a battle-hardened person, right? MBIA tried to put me out of business and did a pretty good job. Sicking Elliot Spitzer on me years ago, if you remember that one. Mm-hmm. And then, of course, Herbalife was a, to the end of the earth campaign, I would say on both sides.
Is this different?
Yes. It's much more important. Much more profound. It affects many more people. It's not just about a company, right? It's about society. It's about education. It's about free speech. It's about, not just higher education. It's about nursery school to K through 12 education.
But take us inside your home, because part of this is about your wife.
Yes.
And about these allegations of plagiarism.
Yes.
One of the things that you did in the context of going after Claudine Gay was, originally it was about anti-Semitism, then turned into an argument about governance and plagiarism on her side.
Sure. Actually, it was always about, I would say, leadership. And its lack of leadership, in my opinion, led to what started out as protests against Israel, then became protests that turned into anti-Semitic activity on campus. I think that really that transformation happened because of the lack of leadership, the lack of enforcement of rules, and that's really ultimately lack of moral clarity. The catalytic moment where I said she should resign, by the way, I said she should resign, I said President McGill should resign, President Kornbluth from MIT should resign, and I'll point out, one of them is black, one is Jewish, Christian, this was a diverse collection of people, although they were all women.
But there have been people that have accused you of being racist in the context of Claudine Gay.
Unfortunately today, if you criticize a person of color, regardless of the credibility of your accusations, you're going to be accused of being racist, and that's not right, right? I'm an equal opportunity criticizer, but I do want to get to the topic of, let me explain. So that was the catalytic moment, and then that was December 10th, December 9th, that congressional hearing. And 2 days later, the Harvard board said, we're unanimously in support of President Gay. And then this whole plagiarism thing kind of erupted. It was sort of out there, and then more and more findings were found. And I reposted these findings, because at that point, I was happy for her to leave for any reason, right? I had failed to convince this board on leadership, on moral clarity, on anti-Semitism on campus. And then this plagiarism thing started to get some legs. And it's not like I discouraged it. It was not I didn't look for it. It was found by others. But in fact, I thought it was disappointing that what the perception that the catalyst for the resignation was plagiarism, as opposed to a failure to address anti-Semitism.
Well, let me ask you about the plagiarism charge, though, however.
Sure.
Which is now that you have been on the other side and your wife is being accused of plagiarism herself.
Sure.
And you have disputed that it is plagiarism. You've argued around the idea and the definition of plagiarism. What does it mean to be able to cite somebody but not necessarily put quote marks around it? This is something that Business Insider has accused your wife of. But Business Insider has also tried to argue that effectively it's very similar to what Claudine Gay had been doing. Do you have a different view now of this?
Sure. So plagiarism is fraud in an academic context. It's the most aggressive, the most damaging thing you can do to a professor, other than accusing them of some kind of, rape or some kind of sexual harassment or some kind of violent crime. So it's maybe slightly better than that. So it's a very serious crime. And it is, for that reason, when a professor is accused of plagiarism, it's a very serious process that goes underway to determine whether or not it's plagiarism. Now, it doesn't take 6 months, which is the typical period for assessing whether a professor has committed plagiarism, to determine whether they had a footnote or quotation marks. It's about intent. Did the professor intentionally steal someone else's ideas? And one of the indicia, if you will, of plagiarism is, where they're using someone else's words or they're not putting a footnote. The question is that an oversight or is that intentionally theft? And the things that you want to look at in determining whether or not it was intentional or not, you're trying to get into the mind of the person, is how pervasive is it, right? And I don't know today whether Claudine Gay committed plagiarism or not, because I haven't done a 6-month assessment of.
But you were out there on Twitter saying she plagiarized. She shouldn't. Not only should she not be the president of the university, when in fact she stepped down and they made her a member of the faculty. You raised questions about that based on the plagiarism accusation itself.
What I said was, in light of what has been revealed about her academic record and what we've learned about plagiarism, I don't think she's qualified to serve on the faculty. And one of the things that came out, which I had never focused on Claudine Gay's academic record or plagiarism. But what I learned sort of after the fact is that she published 11 articles, not a dissertation, 11 articles in journals. And if you look at what's required to be a professor at Harvard, if you're in the field of social sciences, that's a very, very small, very limited academic record. 6 of those 11 papers had 51 missing quotations, if you will, words. Still, I would say that doesn't look good. And there was a point in which, her accusers were people who had been plagiarized from. This woman, Carol Swain, kind of a noted, member of a faculty professor, academic in her same field, said she took my work, right? So that's maybe and it was those words plus the record. I'm saying that you're rewarding her with a $900,000 a year professorship. I mean, the reality was that was a legal settlement. So I said so. But my activism on Claudine Gay, I don't want to distract from the fact that it was about, and just yesterday, and I just tweeted this out, there was a 73-page complaint kind of leveled at Harvard. I encourage everyone to read it, and it outlines some of the things I'd seen when I went up to campus and learned about, but basically 50 pages of anti-Semitic acts on campus. It's a bit like New York City. When New York City was a crime-infested place, and Giuliani showed up, the good version of Giuliani, he instituted what people called the kind of the broken windows of theory. He cracked down on even small violations like the squeegee guys. What happened at Harvard is the protesters kind of tested the administration. And then incrementally, they started violating more and more and more rules, and there were no consequences. And that's why they felt comfortable going into University Hall.
You are now planning to, if you haven't already begun, effectively scrubbing the records of professors everywhere, especially at MIT, because you believe that's where the accusations against your wife came from.
No, that's to make a point. Okay, so just briefly on plagiarism. So plagiarism is fraud. It depends on the intent and the degree to some extent. And getting back to Neri, right? So Neri's thesis, 330 pages. Business Insider found 4 paragraphs, okay, where she had used words and gave proper attribution without quotation marks, 4. And then 1 sentence where she missed an attribution. Right? By the way, the same person when she missed an attribution for, she referenced 8 other times and properly referenced that person. So again, stick with me, Andrew, it's important, it's my wife. Okay. So if I'm an academic panel assessing this, I would say, out of the 2,700, paragraphs, 4 she had attribution, clearly not theft of intellectual property. There's nothing special about those words. It's not like quoting Shakespeare, okay? And there was 1 sentence. No one's going to conclude that that's fraud. Fraud requires scienter, right? Intent, right? It's not even an important part of her thesis. right? So that's nary. The problem with plagiarism, though, and the point I was making, is it can be weaponized, right? We're going to know, once we finish this review, how many other members of the MIT faculty have this problem. And if it's plagiarism, because we find a dozen paragraphs without attribution and, 300 other members of the faculty, it makes no sense. So what has to happen, to be clear, one of the things our little institute kind of focus on, we should impanel a group of top scholars, and let's come up with a definition of plagiarism that's consistent with what makes sense. And we're proving a point by showing, the standard is we find a missed footnote, you're a plagiarizer. Again, what Business Insider said is we found 4 paragraphs and a footnote, so Neri Oxman's dissertation is marred by plagiarism. And then when Neri said, they're right, there were 4 paragraphs and 1 sentence, and the next story they wrote is Neri Oxman admits to plagiarism. She didn't admit to plagiarism. She admitted basically a few clerical errors in a 330-page document.
Are you going to sue Business Insider, which we should say is owned by KKR, Henry Kravis, and you made calls, given your stature in the world and your relationships with some of these people, that most people have no access to when an article is published about them that they don't like?
Well, the first thing I did was call someone I knew on the Business Insider board. But again, this is why we're going to stand up this organization, because unfortunately, I'm not the first person that Business Insider, or my wife is not the first person that they've gone after falsely accusing them of something criminal, okay, or fraud, accusing my wife of fraud. The Twitter, if you will, or X is littered with, everyone in the world has talked to me.
But they've accused you of being a racist, they've accused you of being a liar, people have accused you of fraud. You care about free speech.
I do, but let me just, first of all, accusing someone of fraud is a very serious thing, okay? But you're right. The average guy is not going to pick up the phone and call Henry Kravis on his cell phone or text him, which I did, okay? And it shouldn't have to be that I call Henry Kravis. It shouldn't have to be that
What did Henry Kravis tell you?
I didn't reach him, so I sent him a text. Okay. And I sent him a text saying, I'd like to talk to you about something. It's all outlined in my TikTok. Right. Read it. And then I spoke to a member of the board of Business Insider, and he calmed me down. He said, they're doing an investigation. I totally agree with you that plagiarism is not a series of clerical errors. In fact, I have this in text in my little TikTok. So I thought, okay. I said, look, my only request is either withdraw the stories or announce that you're investigating them. And he said, I'll get back to you. But let me get back to my point. Yes, I have the ability to reach out to a lot of people. I'm one person who moved, or I know them directly. But a lot of people's lives have been destroyed by media organizations writing a story that destroys their reputation, and they have no recourse. And that is a very, very bad way for the world to operate. And in a world where online media, the compensation for media is based on clicks, right? The more attention you get, the more you can sell your advertising for. And that model drives people to do sensationalist stories with high-profile people where they can say they commit crimes, or with the wives of high-profile.
What about the facts themselves? And I just want to read you. This is Axel Springer, spokesperson, talking to Puck yesterday, saying most people underestimated the way that Bill Ackman is completely losing it. That's what he said about you.
Yes.
And went on to say that the facts of the story stand. Their argument, I believe, is that the facts are the facts. There's a question potentially about the motivations which you've raised about the editors and the reporters who may have pursued that story.
I love that statement. Let me tell you why I love that statement. Business Insider is a wholly owned subsidiary of Axel Springer. It's probably a several $100 million entity. Axel Springer is a multi-billion-dollar entity. When Axel Springer says the facts in the Business Insider story are correct, after I put out my 6,000 word thing outlining why the facts are false, the most material is Neri Oxman admitted to plagiarism. Neri Oxman never admitted to plagiarism, okay? Axel Springer is now a recourse party if there is a lawsuit, which is where you started your question. I hope we don't end up there.
We're going to take a pause in this conversation because we have some data that's coming out, but we're going to come back to this conversation. We're going to continue to talk about the world of activism, the political prism I want to talk to you about, with which a lot of this is being looked at, DEI issues, and how you have thought about the shift in all of this. So stay where you are. I'm going to send it right now, if I could, back to Joe, and we'll come back with Bill Ackman in just a little bit. Joe?
Okay, Rick Santelli, we're going to go to now, standing by at the CME in Chicago. We saw what happened with the CPI data. Was it slightly too hot? We'll see what the PPI numbers bring in about 5 seconds. And remember, Rick, it's the rate of inflation rising now. All those previous rises we saw, we were still paying those, so I don't know what to think.
Oh, absolutely. It's like compound interest, except for inflation isn't nearly as much fun as compound interest. And here we go, the December read on the producer price index, the wholesale inflation gauge, down 0.1% on headline. That is lower than we expected. And if just to put it in perspective, if you look towards October of last year, we had down 0.4. So even though it's good news, been there, done that in a bigger way. Ex-food and energy unchanged. That's 0.2 lower than we expected, and that would end up being the third unchanged on core in a row. And the last time we had a number that was lower than unchanged or zero was April of 2020 when it was down 0.3. Ex-food, energy, and trade, it's up 0.2 exactly as expected. That's 1/10 hotter than the rear view mirror. And the last time we were over 1/10 was September when it was up 0.3. Now, I think the better numbers here that I like to pay attention to year over year. 1.8 on headline, 1.8, 0.2 less than expectations, 0.2 less than the rear view mirror, and 1.8, let's see how far back we have to go to get a lower number. 1.8, you're going all the way back to pre-January of 2021, which is where my database comes up with 1.9, and that is lower. So that is very, very good news. Ex-food and energy year over year, 2.5. That's the same as we were expecting. It was the same as the rear view mirror, but last month was moved down to 2.4%. And just to put a face on it, 2.4% is the lowest going back to February of 2021, but we moved one tick higher than that revision. Now, what's the aftermath of this? The market likes this number, Joe, better than it likes CPI, and I could see why. We've moved down a couple of basis points. We're at 399 prior. We're at 396, 397. We're down 6 on the week on 10s. We're down 11 on the week on 2s. And European maturities in gilts and in boons, they're actually higher on the week. So we're starting to see a dual speed with respect to central banks and how markets are trying to price slowing of the economy versus central bank activity. Back to you.
So if grocery prices are 30% higher than when Biden came into office, and they're still going up like 3.4, when are they going back down? They
Well, I
never
don't think
are.
they will, Joe. That's the whole
they
point.
never will.
That's the
Yeah.
whole point.
What about
Now,
energy
if
prices?
you look at
What
CPI,
was gas?
that
How much?
CPI energy, oh yeah, we're over 80. We're over 80 now. And what's the headline in the Journal today, Joe? Just as we get back on our feet, just as the Americans are LNGing and helping out the world, there's pushback now. The Biden administration's getting pushback that, we got to curtail some of this LNG natural gas activity. I certainly hope not. There's a lesson to learn here. I emailed you yesterday. I remember clearly in 21 when Mark Fields bought all those Teslas. And I remember looking at my compatriot that was in the room saying, boy, that's going to end up being a bad trade. That is going to be the poster child of why energy prices are going to remain sticky for a long time, and we're all going to be paying more for everything. That rent-a-car deal, you think that's going to translate into lower prices?
Yeah, that was something. Deciding what we're all going to be renting. What if they throw a war and nobody shows at a party and nobody shows up? That's the problem. Thanks, Rick. Steve Leisman joins us now. Thank you. Now with more, what's going on, Steve?
Well, you see yields are falling, stocks doing better. Let me just preface what I'm about to say by, if you're not confused, you're not paying attention. And here's what's happening right now, and this is what I think happened yesterday. This PPI number, which is really showing, again, deflation up the pipeline here. And I'll give you some numbers. Food down 0.9% on the wholesale level. Energy down 1.2%. That was up in yesterday's CPI. And the trade component, which tries to take a measure of profit margins down 0.8%. What happens now is the PPI, a lot of components feed into the PCE, which comes out in 2 weeks. What I think happened yesterday was people looked at the CPI and said, well, it's a little bit hotter. But let's just wait, because the wholesale price story has been one that's been positive, at least in terms of inflation improving, and that feeds into the PCE. So I think what's happening right now is, for example, we went into this number with Fed expectations for that March cut at 69%. Now they're at 78%. Of course, this moves around. It's very volatile, and that's for the March rate cut. So this is a reset from yesterday, and the market has gotten, Joe, very sophisticated now at looking at the PPI, how it feeds into the PCE, and then resetting inflation, or sorry, Fed expectations off of that. We didn't used to talk about the PPI. You used to cut me off minutes ago. Now it's more important. Look at how the market is moving. That's what's going on, Joe.
Yeah, well, I've been told to cut you off now. And the market's just getting
well,
like,
thank you.
Market's just getting like
thank
you,
you for that
Steve.
time.
Just getting like you, sophisticated. That's how that's the adjective
Right on,
that's what I always say. Thanks.
All right, when we return, much more with Pershing Square CEO Bill Ackman. That extended interview continues after a break. And later, an exclusive interview with Bank of America CEO Brian Moynihan. That is today at 2:10 p.m. Eastern Time. In the meantime, let's take a look at the moves in the banks that reported results this morning. Right now, you will see JP Morgan is up by 2.3%. Bank of America down by 2.4%. Citigroup up by close to 2%, and then Wells Fargo off by 1.3%. Stay tuned. Squawk Box will be right back.
Welcome back to Squawk Box. We're continuing our conversation with Pershing Square CEO Bill Ackman. Bill, thank you for being here. Want to just talk briefly, though, about the markets before we get back to the Henry Kravis and plagiarism and free speech and anti-Semitism issues. You just saw that data come across the tape.
Yes.
Where are you in terms of the markets right now and what you think is happening or not happening?
So on the bond markets, I don't know if you remember, I tweeted that at 5%, I thought the 30-year had kind of gone far enough. We actually reversed our position and went of being short the bond market, we went long the 5-year and the 1-year, again, through these sort of asymmetric instruments at that time. Rates have come in a lot. Right. We've kept that position on because we believe rates are going to come in further. I think the data point that came out this morning is sort of confirmatory.
There's 3 rate cuts in the offing now, 4. By the way, we had Larry Fink on in the 6 o'clock hour. He actually thought that we may not get those 3 rate cuts. Maybe it's 2.
Yeah, I think he's wrong. I think we have 3, or certainly, remember, 3 rate cuts is 75 basis points off of, call it 5.25, 5.5. That's not a significant move. 3 rate cuts would be like a 15% reduction in rates. Right now we're, with inflation, cooling very meaningfully, the real cost of money is very high right now. So I think they're going to have to move early, and I think they're going to have to move.
So what does that mean?
It could certainly do more than 3 cuts.
What does that mean both to equities but to the larger economy as we look? Remember, we're in a presidential election year.
Yeah, so I think it's good for equities as long as they bring rates down fast enough to avoid a meaningful recession.
By the way, talking just for a moment, because I mentioned the presidential election, you have been quite active online about the election. At one point you were supporting, or at least talking about Vivek Ramaswamy, who I Pierre is no longer in the game. But you've also talked, you've been a longtime Democrat, and you've been quite outspoken, it seems, against President Biden. And I think a lot of people are trying to understand your politics today, given sort of where things have moved here.
Sure. So one, I've always been a centrist, always believed in supporting who's ever best for the country, Republican, Independent, Democrat. I think it's really important that Biden steps aside, says he's going to step down. I think he's, just on the age past his prime issue. I think a good part of the reason why we have what's going on in the world geopolitically is he's perceived as a weak president, and he will be even weaker in a year.
Does that mean that you would vote for former President Trump against President Biden right now?
I'll make that decision when I have the choice. But I would say what I'm hugely in favor of, and actually coming here right after this interview, is Dean Phillips. He's going to meet with the whole organization. Dean, a lot of people know who Dean Phillips is. He's a 3-term congressman from Minnesota, considered one of the most bipartisan congressmen, super capable, entrepreneur, Belvedere vodka, that kind of high-end, what's it called, sorbet. But stick with me for a second. He's gone to 26% approval, or 26% of the vote poll in New Hampshire from nothing in a very short period of time. He's someone that people need to take a look at. If Biden steps away, I'd love a world in which, imagine a world in which we have a capable, young, great, motivated, energetic person on the Democratic ticket, and we had something, something similar on the Republican ticket, and you went to the polls and you weren't sure who to vote for both outstanding candidates. I think Phillips can be very interesting on the Democratic side, and my hope for Vivek was he was going to be that person on the Republican side. I expect he might surprise people. People think he's out of the race, maybe, but I think Haley is someone. What's interesting, I think, about Haley, what I think is interesting about Phillips, is that I think Democrats and Republicans can support either of those two candidates.
But does that mean that you're anybody but Biden at this point? And the reason I ask is you've also talked, I think, about former President Trump being dangerous historically, and so now you sound open to voting for former President Trump.
My goal right now is to have good alternatives to Trump and Biden. That's my goal.
But if those are the choices,
I'll make my decision then based on the state of the world. But I can't imagine Biden. I'm stunned that he hasn't said he's stepping aside, and that is very, very. He will lose.
Fair to think about the vote for Trump.
Trump will be our next president if Biden is the candidate for sure. And I think, as Neil Ferguson says, he says if Biden is president. We're in a very, stick with me. His view is the U.S. is at grave risk with Biden staying as president geopolitically, but the Constitution's fine. With Trump as president, they'll keep us safe, but the Constitution's at risk. That's the choice.
Do you think your politics historically, which have leaned to the left, have been a mistake? And I ask because part of the whole political prism with which the arguments around anti-Semitism and DEI and freedom of speech on campus and in bigger institutions is now seen that way. Do you think you made a mistake?
I think what the Democratic Party, what left means today, is not a party I want to be associated with. And I think that's been a big. I was a Bill Clinton Democrat, and what the party has sort of morphed to is not something I want anything to do with.
Do you want to have something to do with the Republican Party?
I don't want to be part of a party. I like being in the center, and picking the right candidate. I'm tired of the country being about right and left. I want it to be about what's right for the country.
Before our conversation was paused earlier,
yes,
we were about to talk about Henry Kravis, these accusations about Business Insider, which KKR owns, and whether you're going to sue them and sue him. Do you
not suing Henry Kravis. Let me just be clear. Business Insider put out this story. It's a rogue news organization. Okay, that's what they are. I mean, check around. You probably know this already. They're owned by Axel Springer, which is the CEO of which is a real guy. Okay, I've had 6 or 7 people close to me call me and say, Matthias, who's CEO, I think that's your computer ringing.
Yep.
Embarrassing for an anchor. You're supposed to be good at this. By the way, if that's plagiarism, you're toast.
Thanks.
Okay, small little error. Where were we?
You were talking about Henry Kravis. You're talking about Business
So my point
Insider.
is, Axel Springer, I thought was a legitimate company. Matthias is supposed to be a fantastic person, but they're the control person, right? They own 100%, or whatever management owns. They own substantially all of Business Insider. They're responsible for Business Insider's acts. And the best evidence of that is they put out this story. We've disputed it. They've confirmed that it's...
But do you think, I guess my question is, do you think
my point here is
this differently? By the way, I've written articles over the years that you have objected to vehemently. We've had disagreements about those articles, and you have felt in certain cases that they were unfair. I remember those conversations.
Okay.
Is this different to you?
Yes.
And is it different because of the facts, or is it different because it's your wife?
It's different because of the facts, and also because it's my wife. But let's put it this way. If you wrote a story saying Bill Ackman admitted to insider trading, which is the academic equivalent of what they said about my wife,
right?
I would call you. But if you didn't change the story, I would go to your editor. If your editor wouldn't fix it, I would go to the president. I would go to the ultimate control person. And that's what I've done here. First, we object to the story to the Business Insider people. And when they do nothing, then we complain to the Axel Springer management team or the board, and when they do nothing, then at the end of the day, Henry Kravis controls 48% of the vote of this company. With a phone call, he could fix this. So yes, the fact that this has gone on, it's now a week since this, more than a week. Thursday was the beginning when they said that her thesis was marred by plagiarism. Neri Oxman's thesis is marred by fraud. That's what they said. And then the second story was Neri Oxman admits to fraud, i.e. plagiarism, right? The third story is like, we found a bunch of other examples which are completely fictitious examples.
You have said that family is off limits. And that's something you took to Twitter and you said historically business people are not supposed to go after family.
Yes.
And yet there are numerous instances where you have gone after members of families as part of some of this activism, including around the universities. I want to just read you, this is Kara Swisher on X. She says, A-OK to attack the wives of MIT folks, we can get into this in a sec, of course, or talk about people being fired from jobs like it's a human hunt. And when economically attractive pals like Elon, go after House speakers or the husbands of House speakers, file all of this, she effectively says, under closeted billionaire cosplaying tough guy getting a taste of the endless, I won't use the word, that rains down here on the rest of us serfs 24/7. What do you make of that?
Well, first of all, I've not gone after anyone's wife. Like, I thought she's talking about Elon Musk.
I don't think she's talking about Elon Musk. She's talking about at MIT, one of the board members, the chair of the board. You have effectively said that the chair was funneling money illegally, at least for tax purposes.
Let me summarize. I can help you. I know the story better than you. Okay, so the chairman of MIT is a guy named Mark Gorenberg. Mark Gorenberg, so I had a MIT member of the faculty shared with me. He said, Bill, do you think this is unusual? MIT is the only funder of this nonprofit, the CEO of which is the wife of the chairman of MIT. The chairman of MIT is the treasurer of this organization, and MIT in their 990 is listed, that's their IRS disclosure, as the only funder. I said, Bill, what's with this? I took a look at it and I said, how can this be? I tweeted about it. And then a spokesperson said, well, no, that's the MIT Donor Advised Fund. And Mr. Gorenberg funded the money to the Donor Advised Fund, and the Donor Advised Fund funded the money to his wife's charity.
Now, basically, it means it's going after the wife.
No, hold on.
It's going to impact the wife.
No, unless she's involved in the business. She is involved in the business, okay? The business, by the way, and this is some little scoop we figured out recently, I haven't gotten around to tweeting about it, the business is a DEI consultant, a nonprofit DEI consultant. The wife also owns, apparently, a for-profit company. So the DEI consultant determines whether, or the nonprofit determines whether, you're supposed to sign a pledge saying you're going to keep various DEI things, a bit like companies that run around asking for an ESG pledge. And then they have a service, which is a for-profit service, where they sell you products, services, software, or otherwise, to enable you to fix your DEI problem, right? This is the chairman of MIT, and unfortunately, his wife, who's the CEO of this business. The purpose here, I'm not interested in the wife, but the wife is inextricably involved here. And the reason why this is tax fraud and has other problems is when you give money to a donor-advised fund, the donor-advised fund is not allowed to give money to something affiliated to the donor. So that's problem number one. Problem number two is that this is MIT, right? MIT sponsors a couple of donor-advised funds, and the goal is to get donors to give money to MIT for affiliated things, and then also occasionally other things. This, a Fidelity donor-advised fund, you can never do this. And the benefit to him is his wife, even though MIT DAF is the only funder of his wife's charity, he couldn't give money directly and get the same tax deduction. That's the problem. So I attacked the chairman of MIT. I thought it was fair game, okay, in light of what's going on. And he's putting at risk the tax-exempt status of the donor-advised fund.
A larger question, though, about your role as both a donor and an influential figure in these instances. There are some people who look at this and say, what does Bill Ackman have? What is his right to be involved in any of this? Maybe as a shareholder you are, but should we be listening to the quote-unquote billionaire class, right? You've seen this critique. Should we be listening to these people over these people? And should the academics have more freedom and have more freedom from the money? Okay, what do you make of that?
Sure. So,
and by the way, this is becoming a bigger issue at Harvard now. I want to get into the Harvard endowment in a moment, because that's the next piece of the campaign that you're going after.
So the answer is, if you don't want to listen to me, don't follow me. That's number one. The reason why I can speak freely, and this is an unfortunate thing about society today, if you say something that offends someone, you can lose your job. You can get blackballed. You can get canceled. It happens on universities. I'm not afraid. I'm not afraid of being canceled. I'm not afraid of losing my job. And financial independence gives me the wherewithal to speak. And by the way, I've literally gotten thousands of emails, texts, letters. I can walk you back to my office and show you some of them. I get them. They come in every day. Okay, piles of them. Okay, people saying, "Bill, thank you for speaking on behalf of all of us." And my biggest driver in life, I should have answered your question differently. This started pretty close to when I was 18. Biggest driver was independence. I wanted to be able to speak freely, live my life, and that motivated me to be successful. And I argue with success also comes responsibility. If I see something that's a problem in society, I want to do something about it. And there are a lot of people who have a lot of money, a lot of resources. You know what? They sit on their yacht, which is fine, and they live their life, and no one's going to criticize them, or maybe they catch them on the yacht or criticize them, right? In my case, I want to, when I'm 85, looking back, I want to say, you know what? I helped solve a number of important problems. If you can't tell by now, I'm a fixer, okay, right? What is shareholder activism? It's fixing companies. What is this? Helping to fix universities. It's all the same.
Let me just have one more question about that, and then I want to talk about the Harvard endowment, which is, if you go back, you have a track record in which you fix things, and sometimes you fix them and you win in a very big way. You also fail in a big way too, right? You could even argue that you're somebody who hits grand slam home runs, but also has a whole bunch of strikeouts throughout the process.
Actually, I don't think it's accurate. If you look back at our history, we've had some big losses, sure, but the successes vastly overwhelm the failures. Like the success rate is extremely high, and you should look at our record over time. So Valiant and Herbalife, disaster. Okay, JCPenney, smaller disaster. Try to name 10. Right, we've made 100 investments, well more than 100.
Let's talk about the next fight that it appears to be on your hands, which is that you are supporting. I think, at least the reports have been that you're supporting an overthrow of the folks who control the endowment at Harvard.
Not accurate. So Harvard has a board of directors that elects itself. This is the most important board. It's the corporation board, called the Fellows of Harvard. They really control who's the president. Then there's a group of alums that are part of something called the Board of Overseers, about 30 or 32 of those. Each year there are 5 or 6 seats that come up for election. In light of everything that's gone down on campus, a group of 4 alumni, a very, very impressive group, Navy SEAL, Marine, Navy, all military people, but also brilliant. I know one of them, a guy named Alec Williams, Princeton, and he did a joint degree at Harvard Business School and Yale while he was going to Afghanistan. Okay, like super impressive guy. They're very unhappy with what's going on the Harvard campus, and they need 3,200 signatures. By the way, if you're a Harvard alum, go sign up and back their campaign, and they're going to put themselves up for election to be on the Board of Overseers, which doesn't have a lot of control. But the benefit of supporting them is it sends this incredible message to Harvard. It gives them a mandate to look at things, and their platform includes one of the issues they're concerned about is the Harvard endowments earns something like a 4.5% compounded return for a decade in one of the best bull markets in history. I'm not allowed to disclose what our record has been during the period, but the Harvard endowment will probably be, 500 billion or something that they invested in Pershing instead of whatever they invested in, and so they're going to look into that.
So you think there's what are you suggesting?
Well, since we, what's interesting about being in the position we're in is we get inbounds. I'll share a couple of interesting inbounds, and I guess the world will tell you whether they're true or not. So Harvard lost, apparently, $1 billion on a fraudulent situation.
What fraudulent situation?
Apparently they bought like a forest in the Amazon or from Brazil, and they included in their returns mark-to-market gains on the forest, right? But apparently they relied on marks each year from the person who sold them the forest, kept telling them that it was increasing in value, until they, at some point, that bad things happened, it blew up and went to zero, and they had to write it off completely. At that point, it was worth over $1 billion. So the employees who were getting paid incentives based on the increased value of this forest benefited, and then Harvard took a huge wipeout. That's never been disclosed publicly. Again, I have no...
We're going to have to fact check that.
We're going to have to fact check that. I'm saying this is something I heard from a very, very credible source. That's one. The second one I heard was that a president of Harvard had a view on interest rates and decided and told the endowment to make a derivative bet on rates, and that bet lost $1 billion. So I got a couple of...
Well, I want to follow up on that. I'm a little anxious about putting that out there in the public without being able to fact check that in real time.
Well, by the way, Harvard's not a publicly traded thing. You don't have to worry. Harvard should put out a statement. Is it true that the president of Harvard did a derivative trade, in fact, caused the endowment to do a derivative trade that lost money on rates, about $1 billion or anything close to it? And is it true that Harvard had an investment in a forest in South America or otherwise that they marked to market each year? They paid a few $100 million for it, increased in value to something approaching $1 billion, and they were forced to write it off. Let's ask the question instead of presenting it as fact.
We got to wrap up, but
I have so much more to say.
I know you do. I just want to end with this. When all this is said and done,
yes.
Do you want to be known as an activist investor? Do you want to be known as something else? I think there's a real question sort of who Bill Ackman is supposed to be in all of this in the end.
Sure. I want to be known as a good person who cares about society, a patriotic person who loves his country, a loyal alum that wants to help its university, a loving husband who wants to take care of my beautiful wife, and someone who really cares about the truth and is prepared to go all in when important things show up and I have the ability to affect change.
Bill Ackman, thank you very, very much for the conversation today. Thank you. Appreciate it. Joe, Becky, back to you.
Okay, thanks. And a reminder that next week we will be at the World Economic Forum in Davos, Switzerland. Don't miss a big lineup of guests, including Bank of America's Brian Moynihan, JP Morgan's Jamie Dimon, Blackstone's Steve Schwartzman, Goldman's David Solomon, and Morgan Stanley's Ted Pick. Coverage will start Tuesday at 6 a.m. Eastern Time. We travel on Sunday. Do we get that back, don't we? Since is Monday
Monday's a holiday.
A holiday, so we're traveling on a holiday. So we need that back, do they? I'm talking my book on the air. Final check on the markets. Take a look at the futures where, compared to yesterday, not too bad, but still down about 92 points. United Healthcare is a little bit weak. The PPI number, as Rick highlighted, was less troublesome to the bond market and the participants than yesterday's CPI, but nonetheless We still are down with the S&P though, right around the flat line. We'll take a look at yields because those can usually tell you what kind of inflation number we got, and we're 3.96. We've been over 4 at different points this week. On the 10-year, take a look at oil. We've got some trouble perhaps brewing in that part of the world. And then we have Bitcoin, which is giving back a little. I think it's below 46,000. Make sure you join us Tuesday from Davos. Squawk on the Street is next.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla at Post 9 of the New York Stock Exchange. Kramer's in Kansas City at GEHA Field at Arrowhead Stadium ahead of Saturday night's wild card, which we'll stream exclusively on Peacock. Faber has the morning off. What a morning. Bank earnings, joint airstrikes in Yemen, PPI going into a long weekend and Taiwan elections. Dow futures are being pinched a bit by UNH. That begins with the bank's noisy quarter. We'll get to JP Morgan, B of A, Wells, Citi, and BlackRock. We are watching oil as the U.S. and U.K. make these strikes in Yemen. Tesla shares down as it halts some production in Berlin. And as we said, UNH medical losses have shares down about 4% pre-market. But we begin with Jim in Kansas City, where the weather is going to be a story for you, Jim, and for Steelers Bills.
Coldest game in history is what they're certainly going to happen. It's already pre-freezing here. Now, I will tell you, Carl, this is streamed on Peacock. I did come out here in part because I think that in itself is big news. I don't want to lose what the narrative is of today with the banks, with the PPI. But I'm thrilled to be here, and I'm thrilled that we are presenting the game, and I'll be on Saturday doing some pregame. So, yeah, I'm here and on to the show.
It's going to be fun to watch tomorrow, Jim. So let's dive right in. Very noisy, as we said, even with some revenue misses. Is JP Morgan the clear standout?
Yes, because you know what? They actually set the tone. The first thing they did was come out with saying net interest income is really terrific. And then that's what we decided is going to be important. I mean, it's like Jamie Dimon picked a metric, and that was the metric. I could hit on a bunch of it, like maybe earnings per share, which would make it so you like Wells Fargo. I could say headcount reduction, which is why you would like Citi. I could say that Bank of America is doing fine other than the last month of trading. But Jamie Dimon really kind of set the scene, and that's why you're seeing good numbers. He was incredibly positive about how much money they're going to make on the net interest income. And Carl, it's a tour de force call by Jamie. He delivered. Nobody else delivered anything near what he did.
Very, very true. Net interest income up 18, 19, FIC up 8, also a beat, IB up as well, Jim. Although his commentary about the economy being supported by stimulus and government debt, the concerns about Russia, Ukraine, Israel, he calls them profound.
Look, he's got the dangerous thesis. He's got to stick by that. He is saying it's one of the most perilous times for the Republic. I don't think he's going to lessen that with what's happening in the Red Sea right now. I know he's going to Davos, which Ukraine is going to be everybody's mind. But you know what, Carl? That's his. Let's say that his worldview is negative, but his view of the bank is incredibly positive. And look, as a stock person, I mean, I watched Squawk and just was amazed at all the breadth of knowledge they were talking about. But look, I'm constrained by the four walls of what I do. JP Morgan was a great quarter. Bank of America, not so good. Wells Fargo, you have to just take it as with a grain of salt. Charlie Sharp, CEO, has historically watched the company overperform, overpromise and then underdeliver. He is trying to underpromise and then he will overdeliver. And Citi is just a black box. Tangible book value is at 86. The stock is so below that. I don't get it. But there's your app. And UNH, yes, it costs a little more to be able to take care of seniors. I get that. I wonder if pickleball's an issue.
Yeah, we're going to get to UNH later in the show. Jane Fraser did call the Citi quarter, quote, very disappointing. They do expect 20,000 RIF in the medium term. Jim, the revenue miss, even amidst, I mean, you got to strip out so many things to get to a good adjusted number.
Well, you see now what I mean, they pre-announced because of Argentina and Russia. There's a whole lot of other things wrong, but when you have an executive who just says, look, we're going to get our expenses right, we're firing 20,000 people, on Wall Street, we love that. I don't know how we became so rapacious. We're vicious capitalists, but what we say to ourselves is, boy, they are really about to do what we want. They're about to get the earnings right. JP Morgan doesn't have to do that. They're already right-sized.
Yeah.
I think you'll find that Wells Fargo still feels like they have way too many people.
What about charge-offs, Jim? A little bit elevated at B of A, up about 100 million year on year. A little bit more than expected at JP Morgan, 2.7 billion. We were going into today wondering what we would hear about credit quality.
I'm so glad that you highlighted that, because I was surprised when I looked at Bank of America and you do your background calls. I didn't get that. I don't know why the charge-offs. I mean, it could be a reversal of something that they saw last year, but they're seeing spending fine. They're consistent with the fourth quarter. The number that wasn't consistent was their trading in the last month. Their trading was I'm going to qualify it as bad, and that's what I think is part of the drive down. But I think that whatever you thought was the way in the third quarter, it continued for all these guys, except for the fact that the charge was a little higher, which does say maybe, and it's particularly with Bank of America, maybe the Fed should be done tightening. Maybe the Fed should be cutting. Because if you have charge-offs, we don't want that. I mean, if you want a soft land, you don't want to step up in charge-offs. So I think if the Fed is looking at these quarters, Carl, they are saying, you know what? We don't want to be tighter. We want to be looser. I don't think March, but I do think June.
Right. And we'll talk in a moment about PPI and what that says about underlying wholesale inflation, as we say, and maybe corporate margins. But finally, Jim, BlackRock, nice beat, revenue in line up 7, and then this big deal, diving into global infrastructure.
Yeah, you know, I really like this deal. I'll tell you what, because if you want a higher income, these infrastructure deals are funded by bonds that are somewhat backed by the government that you're choosing. And one of them or two of them is going to default. If you're in the wrong one, you're going to get hammered. So why not have a pastiche of them? And therefore, if there's one or two that do default, you won't really notice it. This is a piece of paper that I want. I want a global infrastructure partnership piece of paper, because I think a lot of governments are under pressure. They need to raise money. They will do infrastructure deals. I thought that Larry Fink was terrific. He was upbeat once again. This is a great deal for people who want to have more income, even as rates come down. So I applaud him. I thought Andrew's interview with him was terrific, and I remain convinced that BlackRock is just a fantastic
Yeah, assets above 10 trillion, first time in a few years, and as Jim says,
10 trillion.
Fink was on Squawk Box. Talk a bit about the motivation behind this deal. Take a quick listen.
Our investors already have been notified. They are really excited about this transaction. They see the merits. Combined BlackRock's infrastructure team and the GIP team, we will now have over $150 billion in infrastructure. And we see more and more opportunity.
So overall, Jim, I mean, we always have this day where we talk about whether or not the bank shares went into the quarter hot, so to speak, and we're going to get more next week. But are you feeling good about this overall?
Yes, I am. I mean, just go back to Wells Fargo. There were 2 downgrades this week that really kind of prefaced this. But Charlie Scharf has to deal with the legacy of this company saying everything's great. So now he's coming with a different rap. And the rap is, look, we're not going to overpromise here. And so that's why that stock is down. My trust owns it. I am inclined to buy more if it goes down another point or two. JP Morgan, sometimes you get a quarter that is where there are no line items that are bad. This was that quarter.
Yeah. Jim, as to the broader markets, we're going to put together a pretty nice weekly gain. We got the 2-year below 4.2. That's going to take you back to May of last year. And this PPI number with the 1 handle on the year on your core, 1.8, is going to maybe accelerate the conversation that maybe earnings estimates are too low.
I think that what we're going to discover is that there was rent that was bad. And by the way, I mean, this is for CPI. We're now looking at it for PPI. It might flow through. And then you're looking at a stadium. You're looking at a stadium where the Chiefs play. And one of the things that really has crushed us, price of service, of going out. That is not coming down. One of the things, we've got $10 trillion. That's a nation, BlackRock. We have Taylor Swift. She's a nation. And what I being a little facetious, but that's the principal part of what we can't get down. The stickiest part of inflation right now is going places, travel and leisure. That has not come together. If that came down, I think we'd see terrific CPI. I will say this, Carl, yesterday's trading, it looked like the market was going to fall apart, and then bonds U-turn and interest interest rates went down. That saved the day. Can it happen again today? You mentioned at the top. The third thing you mentioned is long weekend. Long weekend usually means for traders, let's square up, let's do some selling, particularly with Red Sea, particularly with Taiwan elections. So don't expect, unless interest rates really plummet here, don't expect it to have a fantastic day.
Yeah. We do have the elections on Sunday. The China military with some saber rattling about those who want to bolster Taiwan independence. Blinken's going to meet with some senior Chinese officials today in advance, Jim. And then you got China deflation, 3 straight months of year-on-year deflation on CPI, down 0.3. That's the longest streak since 2009, as people are looking to see how they respond to those kind of macro figures.
Deflation is more pernicious than inflation, as we saw in pre-Nazi Germany. Because what happens is, if you know prices are going to come down, you have no desire to spend. Because you know 3 months from now it's...
Oh gosh, I get so tired of hearing this. When are they going to come down? They say hope, hope, hope. And he's in Kansas City. It's ice. We had a 1/4-inch hail yesterday. Thunderstorm. I couldn't believe how loud the thunder. It's been a while since I've heard thunder. Now we got a cold front coming in with a misty, so it reminds me of the 2007 ice storm we used to have. We had like, oh gosh, you could hear the trees falling down. And they quit trimming the trees around the wires around here. You know, we have a lot of trees in Springfield. So we were out without electricity for 2 weeks. I'll never forget that ice storm. I put my girl, I said, you go down, I'll put you in a hotel where it's warm, and I'll sit here and stay with the dog. So I had a blessing, I guess. I got away from her for a couple weeks. We had I'm going to go through the earnings. They're going to be in the earnings room. That's only, I'm going to just put the earnings where I think we're going to pull back, or how I react to them. I'm hearing a lot of bad news, but they write this stuff off. They shrug it off. You know, when you're in a bull market, a bull run, oh, it'll get better. You know, just like what Kramer said. No, inflation will come down eventually because consumer will see it one day. I haven't seen it at all. But the lady on here earlier says it depends what region you live in, where you live at. So it's one of them kind of, and every 4 years, we used to have a recession. It was just a natural way to pull the market back. We haven't had one since COVID, when the government was, shut its businesses down. That's why they gave us stimulus money. We had a recession, but they never did say it. And then they redefined it. So under this administration, they redefined what recession is. So you got to kind of play with it. Boeing's news was not good to me. I mean, I didn't think it was going to be good anyway, but they said, oh, the planes will be back in the air in a week. This plane was 3 months old. 3 months. So you gotta wonder. It makes you wonder. So they're going to definitely go through that whole rigmarole again and run through the whole plane and so we can go down more. I got a target. I'll show you here in a second. I shorted coin, and then we're going to look at coin. It hit my target. Called that out about a week ago. You know, there's an old saying, and it's still here today, is sell into the news. You know, something, if you're like, just like earnings, you buy into the early, and then when the news hits, hopefully you're out of the trade, and you got to see what kind of response you're going to get. And you saw how that worked with Mara and all these other riot. And so we got banks are coming out. We got UNH came out. Again, with the high cost of everything, you know, they say cost is going up. There's great knife catching opportunities, especially if you know how they're doing the numbers. More or less everything's hogwash. Just got to react to the. See, Citigroup post loss in very disappointing quarter. Now this is Citigroup. Now look at the stock. We had a bounce. It was very disappointing. And then they had Bill Ackman on here punishing him about Harvard. And he's probably one of my favorites. And they're bringing out Bill Monahan for Bank of America later on today. And you got J.P. Morgan. I expected this from J.P. Morgan because it's the best bank out there. If it's going to recover, it's going to recover. And I think we had a little sell-off here. So resistance on that's going to be right around 172.36. Let's see if we're there. Well, we're up above it. So we're going to use that as a support for it to pull back. Yeah, it's double top, 172.25. And that's right at the 200 on the 1 minute time frame. 5 minute would be 170. And I can see that happening too. Now, every moving average changes with every time frame you use. So however you trade, you got to trade within that time frame. You know, if I've traded with the 5 minute, then I got to rely on the 5 minute. If I got to trade with the 1 minute, however you set yourself up, however you build your strategy, it's important that you know what, time frame you're using. See, at 1 hour, that would be a pretty good spot, I think. That ain't down that much. It'd be down, what, $3? And retest. But this here looks even better, 169. So they'll go through the paperwork and figure, oh, well, okay, we'll mark this off and we'll write this off. And I can't do that as a business. If I could, I would be profitable all the time. I mark off my expenses, but I don't write off anything. It'd be red flagged. There's some buyers coming in on Apple yesterday. We got 20 more minutes. And Dow CEO, they're going to bring out their CEOs and give a reason So Dow, I forgot what he said. He said everything looked good. I mean, he gave the numbers. Got to look at guidance. Delta shares are trading lower at the company reported fourth quarter financial results. Now, it sounded to me like they weren't doing, the expenses were up, but they weren't doing too bad, especially with execution of flights. And they had 40 delays or cancellations, and that and I always thought Dow was like the worst of all. We definitely pulled back to a shoulder line. So we could recover off this. We got an expansion pattern on the candles. Everything's bouncing. So I'm going to have to wait for a pullback. We'll probably double top here at 47.98 or maybe higher. Yeah. Coin hit my support. I called this 136.69, and we dived down below it here at open. And then we came back and touched that support level. 136.69. So I'm going to be watching this real close. This is what I called in a way from the highs. When we hit this resistance level, I fibbed it up. And I was kind of looking for a 50% drop on the run, because I thought it felt like it was just too much, too irrational. I mean, you're down here at 69 bucks, and it runs all the way up to 180. It's a, what, 300% increase. Now, BlackRock, it sounds to me like there's something about infrastructure. They're all excited about him. I called this one out on the dip. Here's another one. What the hell's that? We had 60-mile-an-hour wind last night. It's almost like being in a blizzard. I had to go move my car. I didn't want it out there getting hit with any quarter-size hail. So I moved it under the garage. Missouri can get some pretty violent weather just all of a sudden. You got to really be prepared. I think one year we had 180 tornadoes. Becky Quick is wearing black today. Well, there goes Jimmy. You got to listen to what these guys say around earnings.
There may be deflation there, but it sure ain't a Costco. Remember, Costco is a volume play, not a price play. They're not trying to make money off you. You buy the card, that's where they make their money, special dividend coming up soon, and then you get the lowest prices. It's a fantastic model. It is a little bit like Amazon Prime. Yeah. Really, you pay more for Amazon Prime, you pay more for Netflix, and you pay more for Costco, and I don't think anyone would be unhappy.
Yeah, and some pretty good color on that last.
So if okay, Jim Cramer just said that,
doing pretty well here,
right?
Flipping to the positive.
They're buying.
Jim Cramer says you pay more for better quality stuff. So yesterday, we're sitting here listening to CNBC bash that CoinSpace or whatever they were, because their percentage was up like 1% or something more than all the others. They didn't circulate that kind of theory. Well, you must have a better company than if you're charging more. You're charging for quality. And that's the same thing with me in every business I've had. I put a guarantee behind what I do, so I'm going to charge you a little bit more, but you'll never have to worry. You'll never have to sweat it. If you've had bad experience, with cheap labor, and then all of a sudden someone comes in and say, I'm going to guarantee quality over quantity. So when you come in, your trash bag is going to be right next to where it's always laying, and you're going to be vacuumed, and all your phones are going to be wiped down, and the doors are going to be wiped down during COVID. So I issued everybody a letter. I said, hey, I'm going to guarantee that the only way you're going to get sick is if someone brings it in, and I'm not here to wipe up after you. And then you got my phone number just in case somebody does come in. I charged this one person $100 an hour just to go in and wipe down COVID one time. Took me 3 hours. So here's another one that's an all-time high cost. Nice little expansion pattern. We could get a 3 down here if you look at the daily. Costco's new Southern China store reportedly draws massive crowds on opening day. Oh man, I remember when they did that, 4 years ago or something, they opened up that store in China and they sold out of chicken and beef within hours and had to shut the store down. And China being in a deep recession right now, they're probably going to do very well with that store. China. We got 2 more minutes till the market opens. You're going to see, I'm going to be a reaction trader today. Make sure you trade companies that have cash. Walmart's got a, I don't know how to take this flag here. It's kind of bullish. We hit resistance on the QQQ. The SPY, nice little pop on the SPY here. We'll see if we are into puts right at open. I've been shorting, I think, more than I've been trading long here in the last week or two. More than I've probably ever done in my lifetime, because we're at this humongous resistance. So we go to double top, maybe 47.94. They're going to take these earnings. There we go. Right there, baby. See if it pulls back here. Sometimes charting takes a little bit too much time. Look at a coin. Coin dropped down nicely right here. I've been waiting for this trade. The 144 strike. I'm not in it yet. Oh hell, what damn? Okay, January 19th. Too big of a spread. You got to let that spread tighten up between the bid and the ask. It's starting to right now. Everything popped up too high at open here. Lotto on the SPX. The 4870, 4780 put. Okay, we're getting the bid and the ask are tightening up real good here on coin. Bam. SPX put, Lotto 4780 at 460. And set a stop. If it breaks resistance, This news on Boeing's not good. There's people stuck in this one. They've been pumping it. The Bitcoins are all down. Vital's down in one. You got the top of this Darvis box for support. $21.66. I gotta watch my SPX here. Spies double topping. $478.62. Okay, I've got two contracts. Might have to take a, we'll see how this works out. Who lies? Is she buying Tesla this AM? Swaggy stocks.
To the power of some of these financial components.
Yes, it's really great to see companies that sell at 8, 9, 10, 11 times earnings getting a little appreciation. Those stocks are cheap. Anyone who wants to own a bank stock, you're not overpaying. Let's put it that way.
That's what they say.
While we're banging through some of these, Piper does upgrade to overweight. They say not completely out of the woods, but some revenue stabilization going on.
That's painful, Paul. I mean, obviously, all of us like Jeff Lawson, one of the great guys in the business, taught me how to code, by the way. And this thing is just dripping with, it does better without Lawson. It's painful. It's kind of like Patriots do better without Belichick. It's painful, but could be true.
Yeah. On that theme, some of the layoffs going on in tech, Jim, we talked about it yesterday vis-a-vis Google. Today, B of A comes out and says maybe there are more layoffs to come. You talked a minute ago about how much we applaud our corporates for being so nimble, but B of A's view is that the influence of AI on your headcount is starting to get felt first by the companies who know that dynamic the best.
Meta new high.
I was
Apple pulling back a little.
Those of us who pressured Ruth Porat, the unbelievable CFO moving up in the ladder now, about
SPX,
how the
come on,
cost is out of
man.
line. She's listening. She's listening, and I think it's
Damn.
really terrific. By the way, Amazon, in their layoffs, they were very targeted. They talked about how we figured out Amazon Prime. We don't need as many people. I have Clark Hunt on tonight, owner of the Chiefs. I don't know if it's good to have an NFL game on constantly, but I did think Amazon was very smart to have one on Black Friday, because what happened is that you decided to order online and you didn't want to miss that game. I guess if you were David Faber, because I thought the game was quite boring, but he's a Jet fan.
Well, the
whatever
ratings,
team's doing badly, he's the.
the ratings numbers don't lie.
Whatever.
I mean, some of the numbers from that weekend were truly eye-popping. And to the broader point about how technology is influencing the innovation, the efficiency of the economy, that's one more thing that Larry Fink talked about this morning on Squawk. Take a quick listen to this.
The equity market is resilient because we have become the dominant country in new technology. I mean, the transformation of medicine.
Because it's spy hit resistance.
Drugs that that are weight reducing, that slow down dramatically Alzheimer's. I actually believe we are spending way too much time on the negatives.
Yeah, this guy here.
Not enough time on the wonders of these. Of what
He's not my best friend.
Side of technology.
Way too much time on the negatives, Jim. What do you think?
He's an idiot.
I love Larry. I think he's acting true when he was on our show. I mean, I think he imbues terrific thoughts. He gets his point across. And just like what he said, the stock was down 7 in pre-market trading. Now it's up 8. We spent too much time selling BlackRock. We then buy BlackRock, $10 trillion under management. Terrific new acquisition enables you to be able to invest in private, public infrastructure bonds. And he embodies what we want, Carl. I mean, hey, things are much better than you realize. And when I listen to him, I kind of feel better about everything. And the way, if you feel better about everything, go buy that stock.
We're going to talk more about whether or not this feeds into the results we're going to get next week. But first, let's get to at least JP Morgan's call now wrapping up. And for that, we'll turn to Leslie Picker. Morning, Leslie.
A while ago, CFO Jeremy Barnum gave some color on the call that ended about, say 15 minutes ago, about the state of the consumer and the potential inflection point in spending.
The way we see it, the consumer is fine. All of the relevant metrics are now effectively normal.
It did pull back to support.
And the question really, in light of the fact that cash buffers are now also normal, but that means that consumers have been spending more than they're taking in, is how that spending behavior adjusts as we go into the new year in a world where their cash buffers are less comfortable than they were.
Damn it.
JP Morgan management reiterating that the economy remains resilient. Jamie Dimon saying in the release, though, that the economy is, quote, being fueled by large amounts of government deficit spending and past stimulus. And he says that, quote, may lead to inflation.
Okay, we're about to resistance.
And rates
We're going to see if we break this thing. If not, I'm going to add 2 more contracts.
Of the rates regime, over-earning in net interest income by their own description there. The profitability metric.
Well, that's a spy.
NII and the firm issuing guidance for 2024 NII that was a little bit higher.
SPX did break.
Expected, with management using the assumption that the
5
Fed will
minutes.
cut rates 6 times in 2024. The firm saw growth in nearly all of its businesses in the quarter, including
God, if I still had them
banking
suckers.
revenue, that was up about 13%. Barnum said on the analyst call that the firm is seeing a, quote, pickup in deal flow, noting that he expects the environment to be a bit more supportive, guys.
Leslie, busy morning for you. Appreciate that very much, Leslie Picker. Jim, to Leslie's point, IB up 13 at JP Morgan, 15 at Wells, 7 at B of A. What does that mean for Goldman and Morgan Stanley?
It should be terrific for both of them. Morgan Stanley had a quarter that was light. It was light on wealth management. James Gorman last quarter, I hate to see him go out on that note. I do think that my Chapel Trust owns Morgan. The stock did go from 70 to 92, so let's not be too tough on him. But this is a clarion call to buy Goldman. Bank of America, by the way, did not see the same consumer spending pattern that JP Morgan saw. They saw less consumer spending. But again, I mean, Bank of America, this is a good example. Stock was down $1.50 by morons who just say, you know what? I'm just going to sell because the headline wasn't so good. If they had bought
We got the 5-day rule on Bank of America.
They would realize that it wasn't a bad
We could probably get a bounce
People
off
like to
it.
Shoot first. This is a bad group to shoot first because this is a conference call group where you should make your mind up if you're listening to the conference call, not if you read the press release.
Right. And from what I'm hearing you say, the curve is the curve, and all the banks are going to say that.
Right.
And the worst fears about consumer credit degradation are at least not happening yet.
No, totally right. And I do think that Leslie made a great point, which is they were using the forward curve 6. Everyone's kind of constrained by what the forward curve looks like, and they're making the projections based on that, which is why, once again, I'm going to say that Charlie Sharp and Wells Fargo, I would not sell it on this. He's looking at the forward curve and trying to figure out what's going to happen. And then what he's going to do, he's going to surprise you. So if look, people want to take it down to 46, 47, buy.
Mara double bottom, we're on the top of the box.
The other interesting thing, Jim,
Mara,
we sort of talked about it
2066.
more, maybe a year or two ago, but expense growth. I mean, B of A is a good example. Expenses up 1. I wonder if you think that points to the sort of discipline that we are seeing to some degree in tech as well.
Yeah, I mean, look, we've got headcount coming down. Look, a lot of the expenses that you see from these banks are one time. It's
United
spiraling.
Healthcare.
There are way too many branches. Technology's really working. Zelle from Bank of America is now bigger than checking, for heaven's sake. I just think that these banks had underspent. Now, I gotta be careful. JP Morgan spent a lot of money on tech, and they've done a great job. Wells Fargo historically had
Humana.
on tech, and Charlie Sharp has to bring up that spend.
This is a reaction, Terry.
Jamie Dimon does it. Again, no flaws in this Jamie Dimon quarter.
We got a double bottom here, close to it.
It just wasn't it.
Dang, I should have saw that.
Deposits in line, loans in line.
That'd have been a good trade.
Everything except Diamond's, sort of macro color and commentary.
Yeah, he's the opposite of last.
Coin is off the 51.
Fate tells you the good. Jamie gives you all the bad you want, and then then he dollops a little more bad.
Boom, baby.
Thesis, I criticized his dangerous thesis. He wasn't happy with my criticism.
3 white soldiers
What can I say?
with
I
a head and shoulders.
It's not a halcyon time, obviously, but if you go back to say December 8th,
That was a good one.
Of 41, I mean, that's a more perilous time. How about when we had to move all the bombers down to Florida in order to be able to counteract Russian missiles? Perilous time. There are some perilous times. The battle for the imperial city of Hue, which we lost, and Cronkite goes to Vietnam and says we're losing the war. Perilous time. There are other moments where the Republic was much more challenged. By the way, he's not really talking about a challenge that Colorado brings up, which is can you have a violator of the 14th Amendment insurrection clause still being able to run for president?
Yeah, some interesting comments on the 24 election from Bill Ackman on Squawk today as well. Jim, We'll see how much of this holds. S&P, as we said, 4801. Dow up 45. Check bonds as well. PPI we talked about at the top of the show with that 1.8 year-on-year core print. Pretty interesting. And the headline month-on-month down a tenth. We were looking for up a tenth. With all of that, yields are lower. 10-year down to 3.9 and the 2-year 4.12. Wow, sinking below 4.2 earlier this morning. Back in a minute. Ooh.
365 average on the SPX. What else, Bobby? Boeing, I got the 200 SMA is support level right now, and that's right around 215. And I got 365 average on the put, SPX, and what am Amazon, AM's Amazon. On the 1 hour, coin has to break the 9. Trying to figure out what's going to be a good price for AMC. I'm not really big on that trade at all. I'm just watching it because I'll do part 4 here soon.
S&P still on track for an all-time closing high today. We'll see how much of that holds. You can see some of the week-to-date gainers. Juniper, of course, on that news regarding M&A earlier in the week. Palo Alto, NVIDIA is up there as well. S&P shooting for 10 of 11 weekly gains.
Damn.
As we finish out.
Jupiter, a nice hold.
Stop trading with Jim in just a minute.
What's that? Black dot. There it is. Tesla just now hitting resistance. Okay, right now we're at the spot where we got to make a business decision here if we're going to turn around or move up. So I average 365. It'd be a good idea to get out of, okay, 420. Well, if I get a nice little candle down here to the double bottom retest, or I'd get out now. You got to watch this here spot right here. Just about when I got in the trade. And now you're squeezing down. There we go. That's what I wanted to see. $450. Now I'm up $400 almost. I don't look at percentage I look at money. It's going to make a business decision turn around. I should have took that. I couldn't get out at 450.
Let's get the jam and stop trading.
You want bullish, I'll give you bullish. There's a piece out by Opco on Netflix. They are saying that the street is way too low on subscriber growth. It's going to be much better. Bull thesis is strengthening. This is the one. This is the one that they're going to buy today. I would still think even up $2 you buy it.
Nope.
Yeah.
You're an idiot, Jim.
Target, from Oppie on Netflix. Pretty interesting. Jim,
Not at a 20-day high.
Authoritative.
I'd ask you about tonight, but we haven't even gotten to Schefter's scoop on Kraft with the new hire already.
Oh, God, Schefter, third youngest coach. Very, very exciting. This is a new regime up there, and I think that there is energy. We should get Bob Kraft on. He's a terrific guest.
See how the volume slowed down here?
And Schefter,
It's telling me that I need to get out of the trade now before we get a volume spike.
Really terrific. There, he'll like that. Dylan. I'm into Dylan Schefter as being terrific.
Tell us what's on tonight, and then tell me what the next 24 hours are going to be like for you.
Well, first of all, it's long underwear. I'll make that point clear. Clark Hunt,
S&P will meet resistance around the 4,800 level. We hit the 4,800 by J.P. Morgan.
I also want to talk about sports gambling, by the way. And Tony Dungy and Rodney Harrison, we have an unbelievable.
I'm going to just hold on a little bit longer.
But Rodney.
So yesterday they came out on the 10th. The S&P will continue to meet resistance around 4,800 level. J.P. Morgan, there's 490. So if there's any rookie that took this trade, make a business decision. Make a business decision. I sold 2 contracts. I'll sell them all. Fuck it. I'm out. I'm going to go home. I can go to the beach. You get the 50 SMA double bottom. That's a double confirmation. Dang, 5:30. This is going to rob me again, I bet. Jimmy likes the black dots. I've been trading a TTM squeeze for, what, 10, 12 years? $5.60. Can you? Oh my! Here I go again. Magnificent. I think I'm gonna start crying again. $360, $380 just lost. A plus. Okay, thank you. 610. Shit. Oh, please. 670. Ah. Jesus. 710. 770. Oh my God. 860. Give me a break. 950. Oh no. $2,800. Okay. Some bitch. No. I can't tell you how much money I've left on the table trading stocks. It has to be every bit of $5 million. If I can just figure it out.
Say, get cash now for your structured settlement.
J.G. Wentworth, cash now?
It's your money. Use it when you need it.
J.G. Wentworth is right. It's my money and I need it now.
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 If you have a structured settlement and you need cash now, J.G.
This is unbelievable. I mean, it's believable because I had my gut instinct perfect. So let's look at the calls now. We're at the 200 SMA. I didn't think the earnings were all that good for one. On all of them. And except, I mean, even JP Morgan. I'm just one notch out of the money, in the money right now, and I was like 4 or 5. So look at the calls, the 4,800 strike. We got 25,000 contracts on it at 370. We're bouncing off the 200. So if this thing comes back and we got a tweezer bottom, and when this thing turns yellow, we jump in the trade. Now I could have jumped in right there. We pulled back to a good spot. So the 4,800 strike. 4,800, that's the number that we got to stick with right now because that's the resistance. So VWAP traders, we're below the VWAP and we're at a pivot point. I'm going to pull up Trend Spider and see where the anchored VWAP is. There's the 4,800 strike at 360 calls. There we go. If you're in the trade, take profit. Come on, a little bit more. So 2 contracts. Oh, there we go. Now, I'm going to get out here, all of them. We're at the 50 SMA. Tesla, they shut down the Berlin factory for a couple weeks. They're having trouble getting the parts, oh darn, through the Red Sea. And we attacked Yemen last night with a warning to save lives. We said, we're coming after you. So they sent out an email. I guess we killed 5 people. It was a pretty serious attack. So I don't think that's going to make them Yemen people very happy. And Tesla could suffer more longer than just 2 weeks if they have to rely on the Red Sea to get their supplies. So they have to go the long route. That's going to cost them more money. I'd wait and look at Tesla. I think I got 510 support. I wouldn't take it right now. Not on this bad news. Now, Kathy Woods, get in it. I had the 220, 13 support, and then we got the 210. So I'm going to wait for 210. I'm not going to invest yet. I think we can pull back more. China, the BYD in China. China's pissed off at Europe. If you know anything about President Xi, he's not when he gets mad, but he's constrained. So if China invades Taiwan with this new leader, I'd wait until we figure out how the reaction is with the Taiwan new president before I'd invest in Tesla. I think Kathy jumped the gun on this, and I told her not to do it. I told her last night when we were having tea and edibles, I said, baby, I said, you're eating a little bit too much edibles here lately. It's a gap down. So it's a scalp trade, and that's it. I want to see this head and shoulder line. Once we get down to the shoulder, and we retest the shoulder on this head and shoulders, that's when I want to jump in the trade. So I'm going to wait. I don't want to take the risk right now, not with what's going on in the news. Same with Boeing. We got to wait for this 200. Once we hit that 200, that's right around 214, a little above it. Let me see I need a confirmation of some sort, and I don't get one. Now on the 200, it's under $200, and I do got a confirmation there. Right around, just a little bit under 200. I got a head and shoulders. I come back and touch the right shoulder off the 200 on the weekly time frame. Now see, SPX pulled back. I'd wait on Tesla. EV cars don't do very well in the wintertime, in a way. Same as solar. Then we had the Hertz deal. Then we got the General Motors and Ford fighting back about the EV. I mean, they're wanting to change their whole freaking factory around. Spend billions and billions and billions of dollars to satisfy an old man that can't hardly speak. I bet you GM's down. Yep. Now watch this here. The calls on the SPX. We took a good dive right here. We're out to 200 again. We got 3 black crows. So let's watch it. Watch it. Watch it, watch it, watch it. Got 320. Got to hold here. If it doesn't, it drops below the 200, we're in trouble. And we got to get straight out of the trade. It is as well. That's good news then. On what time frame? Yep. Yeah, it is. On the minute. So you got a double confirmation. The 200 and an inverse double-headed snake with a tweezer bottom. You got 3 confirmations. The 200, the tweezer bottom on a one-headed snake. Yep. This is their okay. As a day trader and a scalper, I'm going to say this. This is the last chance that it's got to break up to the upside. Because I have 3 confirmations and we're stretching it out. We've been, what? It's been 45 minutes. So we got to come up and break this old resistance. And I'm going to draw the trend line from right there to right there, and that's what we got to break. If we don't break that, that's where you want to get out of the trade. I'm using the body of the candle. If we break it, we could have us a nice $300 or $400 call here. Now, Boeing on the weekly is at the 21. So if I was trading a weekly time frame, I'd think about that 215 area. Uh-oh, here we go. We got an alert up on the SPX. Says we're finished. We are. Where's my other one? Here we go. See, this is it. I mean, we're at the time now where it's got to work or it don't work. Set a tight stop. We're at the 200 right here. Yeah, I think we got to be real careful here. It's all up to this next candle. If we get a tweezer bottom on it, that's a lower low. I don't like that. It could be a double bottom if you count it off the wick. It's not good. Randy, did you get in? I'm not in real big, so I can take a small loss, but let's see right here. I didn't like the earnings. Red T, Red C. Man, I really nailed that one. Can you believe the 4080 puts? I had 4 of them. We hit it, just almost hit a high of $1,300. That'd have been $4,000. So we got 3 black crows right here to my first support. I'm going to hold on to these babies. Finally, somebody on the CNBC, some older lady said, yeah, the market doesn't do well on or count in geopolitical tension. If I could right now, I'd say no war, no war, no more. I used to play with this guy named Bill Pasalacqua. Anybody know Bill Pasalacqua? I had a dog. We kind of got it. We're under the 200, so we're bearish. I haven't added on to my calls yet. Call. Oh.
Last year, it barely grew its top line. This year, we expect revenue growth to be less than 1%. And you're paying about 28 or 29 times earnings. For that multiple, you can buy Microsoft or Amazon, which have double-digit top-line growth rates. And ultimately, I think as good a company as Apple is, I'm not sure at this valuation it's particularly compelling.
Is there any way?
Randy, you can get out here at the shoulder line or try to take the risk of breaking it.
New category in almost a decade. That there might be a resurgence in growth just around the corner.
I think in the near term, Vision Pro is not likely to be a needle mover for Apple. It's a $3,500 product. Even if it sold 1 million units, which is sort of what production volumes look like, that's $3.5 billion. That's less than 1% of Apple's revenues. Certainly longer term, this could become a significant category. We'll have to see how much of it is incremental versus cannibalistic to consumer spending on things like iPhones or iPads.
What's that?
But ultimately, in the near term, at this kind of price point, it isn't going to be a mass market product or
cannibalistic.
For Apple.
Brian, I mean, Microsoft certainly
baby.
the consensus favor just being in the right place across many technology areas. Obviously, with the AI kicker as Copilot comes around, what do you say to an investor about why now, after we know all this and we've had the good news embraced, does it still represent a good value?
I like the parallel with Apple. Think about Apple. Was the consensus long when iPhone came out 15 years ago? Over the last 15 years, there's been a massive amount of cash flow that Apple had accrued based on that first mover advantage in the smartphone that they created. That's the point in time we are now with Microsoft now. There are very few $200 billion businesses growing double digits. Microsoft is at the point now where you could probably make an argument growth could accelerate even at $10 billion. And we're thinking about an AI business that's well-known, consensus, but only 1% of revenue, about $2 billion AI business for Microsoft today. We think it'll be north of $10 billion within 2 years. And we think it's the next $100 billion opportunity for Microsoft. So yes, it's consensus, similar to Apple back in 15 years ago. But we're at the beginning of this AI cycle. We're certainly not at the mid-cycle of a device or of a tech cycle. So we're very bullish around the long-term prospects for Microsoft. We're pretty bullish around the near-term prospects given AI and how quickly it's moving.
I'm not sure if Apple was quite the consensus long we think in retrospect it was when an iPhone came out. People thought that thing might flop, although I guess I would ask you, at this point, when Microsoft has already gotten to $2.8 trillion, I mean, where are they pulling the revenues from? Are there net losers in the tech ecosystem that are not going to be, they're going to have to forego revenue because it's going to Microsoft?
Sure. I think you have to think about the two drivers of AI that Microsoft can capitalize on. One of those is going to be incremental revenue, and we talked about this being a $2 billion business. The other is really driving down costs, right? And lowering costs for enterprises. If you just think about Harsh Kumar, our semiconductor analyst, and he covers NVIDIA, they'll do about 15 billion of GPU sales this year. In the next 2 years, they're going to do over 100 billion is what his forecast is. That's a massive amount of data that needs to be trained on these systems, massive amount of GPU capacity. That's the opportunity that Microsoft's sitting in front of, capitalizing, both driving incremental revenue for the company, incremental cash flow for the company, but also driving down costs for those enterprises to basically be more efficient. So this is the beginning of a big productivity wave. That's the real incremental value. It's not just the incremental revenue, but also driving value to the end market, making those employees more efficient, making businesses more efficient. Tony, I wonder, we're going to get Taiwan elections on Sunday, and I wonder whether or not you think either China exposure or the challenge of diversifying Apple's supply chain is a liability that other giants at that scale don't have.
I gotta wait before I invest in China until we figure out who got elected in Taiwan.
Apple, it has unusually high exposure both to the Chinese consumer. 20% of their revenues are come from China. And then its supply chain and manufacturing chain is essentially 90% China-based today. And they're trying to move away from that, but that's a multi-year process. And so China and perhaps Tesla, I think, are really the two mega cap companies that have unique exposure to China in the sense that they're both important end markets and that they're important manufacturing countries for those companies. And so certainly there is some existential risk to Apple, more so to other companies, if we had an escalation in U.S.-China tensions, if something happened with Taiwan on a go-forward basis, and that is a consideration. Now, I would say that has been a potential overhang for the last 5 or 10 years for Apple, and the cycle of concern around China goes in ebbs and flows, but that's always been an existential risk, more broadly for the marketplace, given the codependence with China, but uniquely so for Apple.
All right. We'll see what happens over the weekend, guys. And certainly the race between these two is fascinating to watch. Have a great weekend. Good to see you guys. Tony and Brent, thank you.
As I keep pointing out, Carl, in the S&P 500, Microsoft is already substantially bigger because the index kind of takes away the Berkshire Hathaway stake. And Apple, they only count the free floated shares, so over 7%.
So, like I said, I've been waiting for earnings. And today was the day to decide if I'm bullish or bearish in this market. I mean, we're going to get a lot more earnings coming out. This quarter might not be that very good for the banks, but they're going to be better in the next 3. So if we let this consolidate for a couple of days, I think we'll be getting some good entries in on the banks. JP Morgan might just go ahead and take off. But the other ones, I'd like to see a pullback, especially Citibank. Them earnings sucked. Citigroup to lay off 20,000 employees. So 20,000 employees. Very disappointing quarter. Very disappointing. $20,000? Are you kidding me? That makes me want to cry. Okay, now we're breaking out on, and I'm not, like I said, earnings are going to be the decisive matter how I wanted to trade this market. So my SPX is now at 350, and I'm going to make a business decision real shortly here. We did break a resistance. We got a bull flag. So once I hit this 50, I'm out of the trade. If we get there. Oh, hell, that's a SPY. Dummy. Yeah, it's time to get out now. Okay, 360. I'm out. Yeah. The ready set go says we could go more, but I hit my trend line and I'm not going to take that risk. See how much that's dropped already from 350? Why did I get out of that trade, Jimmy? Because I hit the 51 on the 1 minute time frame. Now if I looked at the 5 minute, I would have definitely got out at the 21. And that's right there. If I look at the 1 minute, I got out right there. So I made more money on the 1 minute in that case. I would have got out on that engulfing candle probably. But instead I got out at the 51 because I wasn't watching it.
And then if there is an upset, however, it could potentially mean that Beijing would be willing to engage in discussions more constructively with government under Ho. Guys?
Under Ho.
What is it, how do you expect it to affect some of the military activity that we've seen in the waters between the two countries, military drills, and also their stance regarding the United States. We did take note today that Secretary Blinken is meeting with some senior Chinese officials today in advance of the weekend.
Yep, yeah, right. And that is actually seen as one tactic
On
of
what
the
one?
Chinese to try
Tesla?
to stabilize the relationship between the U.S. and China, which they are very much in favor of doing at this point, at least optically, to try to move that relationship forward. But when it comes to the military intimidation, we've already seen a lot of that in the past several days. This is a very typical thing that the Chinese do and that they have done ahead of elections. And in fact, the Defense Ministry today had also said that they would smash any movements of independence for Taiwan. So likely what we would see if Lai does indeed win, that there would be a ratcheting up of military intimidation. One other thing that we could see potentially is that if he wins, that the Chinese government would freeze him out, as they have his predecessor, the current president, Tsai Ing-wen. Carl?
Big weekend, Eunice. We'll watch it closely and, of course, take stock of it when we return to trading on Tuesday. Eunice, thank you. As we go to break, take a look at some of the biggest laggards on the S&P for the week. You'll see Boeing at the top there, down 12, as we've got not just the FAA probe, but also some indications that Airbus is gaining some share. Paramount's in there as well. Tesla not far down the list on the price cuts in China, the Hertz fleet, some of the production in Berlin. Dow's down 160. Don't go away.
So tomorrow at 9 Eastern Time, I'm going to be live on YouTube talking about how to create a watch list. And I've taught this seminar 2 or 3 different times. I think it's very important to have a very good watch list and know how to create one and how to use it. Especially now that I don't have the scanner, I have to rely more on myself. Let's see, we knifed. Jimmy knew to get out of this trade. Once we hit, look at this. I drew the trend line from that body of that candle to that one. So when we had the 3 black crows, I jumped in the trade, and that was resistance. So I didn't want to wait until, ooh, look at that, double bottom. The earnings really sucked. So I'm not very bullish in this market, and I'm not going to listen to these CNBC people pump this stock market. I missed it. I could have got that at 210. I was talking. So I think we can get more of a pullback until we hear more. And we got this Taiwan election, I think, is very important because everything else is falling apart. Maybe we can get some stability with somebody that can communicate with China. Instead of being authoritarian, we could be a little bit more open dialogue. That's what Trump was good about. Biden can't speak. People look at him like, what the hell? The bureaucrats running the country right now. That's not a good sign. I do believe we have to hold this support, though, on Citibank, but I'm not going to try. I think it'll fall more. I'm not going to trust it right yet. And I could have had a nice little trade there on the SPX on that knife. We got a cup and handle. Let's see if we can get this thing down here by the end of the day. 47. Hit this right shoulder here. CRGE is up 278% with 222 million in volume. This is on the Russell 2000. CREG shares are trading what? Charge Enterprises. Chairman after investigation of missing fund. Why? Why do people trade these stocks? There's nothing good about this. Charge Enterprises sues former chairman after investigation finds missing funds. She's getting pumped by a room. There's no way I'd trade it. Now look at Mara. Mara's at my support level. Here, I'll show you. I'm going to erase everything in here. Watch Mara. Jim, what are you doing? Delete. Watch Mara. $1984 and no lower than so Mara's got to break the 21 on the 1 minute. The 9's got to cross the 21. Mara. Been waiting for this support level forever. Watch Mara. The $21 strike. Let me see if there's any bad news in here. Bitcoin, fair, everybody, the Bitcoin seal might be visiting. I haven't traded Mara for a long time, since we were at the all-time highs. Now that I've pulled back to my support level, I'm going to look for an entry here. Gotta watch tape. Right about in here. We got the shoulder line. You got a head and shoulders. You got the 9 squeezing at the 21. Get ready. Right about now. There we go. Right there. $113. Now put a tight stop on this one here. Inverse head and shoulders. Set a tight, tight stop. That's where Nile is. I hope them kids ain't buying AMC right now.
Yeah, Leslie, well, first of all, it seems like rates never stay in exactly the right spot for banks to maximize net interest income for long. You're always kind of wide of the mark. On the credit concerns, though, I mean, all the banks are showing some pretty big year-over-year increases in credit provisions, but off of very low levels. When it comes to Wells Fargo, I saw some commentary. A lot of it is skewed toward commercial real estate, but seems like the street has confidence that these banks, you know, are relatively well reserved, and it doesn't seem like it's getting out of control.
Yeah, and when you listen to the bank commentary on the calls as well, a lot of people point to the fact that they're still kind of, you know, in terms of the health of the consumer, still looking at 2019 levels. Bank of America in particular, they saw their credit loss rate move higher sequentially in the quarter, but still again at that pre-pandemic level, maybe slightly worse than where they were at in 2019. But overall, a relatively healthy consumer that they're still seeing. Same thing with JP Morgan. You know, we heard the CFO there talking about how consumers were spending down their buffers, so we may see some changing behaviors this year, but they're not necessarily seeing a huge shift yet.
Yeah, kind of hard to envision it given unemployment and claims lately, Leslie. We'll keep our eye on it. Thank you. A busy morning for our Leslie Picker. A whole lot more in the next hour on Money Movers. We will talk to Wells Fargo CFO, break down some of those numbers. First, though, we'll get some more on these results that are sending Delta shares lower this morning. One analyst who calls the stock a buy here forecasts some gains ahead. Shares have really worked their way back to the 50-day where it was about a week ago. Stay with us.
The biggest pump station out there, and they have never been investigated or arrested. Because they're all Democrats. We're at the 50 right now, so this could be an escape valve here. If you're in this trade at 113, we have a 1 tubus and a freebie off the 200. So they got two confirmations of resistance. If we break this, it's an easy shot to this here previous low at 2070. Now I've been waiting for this for, I'm going to show you how long I've been waiting for it. Damn it. I'm going to set an alert here. I'm getting ready to squeeze. I'm going to talk about sour grapes. Does anybody know anything about sour grapes? I'll probably get, well, I better not play this because I know I'll get frickin' red lighted. Anybody ever heard of John Prine? He passed away with COVID. When I was at a John Prine concert, he had Bonnie Raitt in there. And I looked at my friend Dave. I said, Dave, did you see her titty just pop out? I'm sure I saw her titty just pop out.
I think the strongest growth will continue to be international. And that's where you see a lot of the carriers, both U.S. as well as international, continue to play to. Last year, particularly Europe was on fire. I don't think one busy season is going to quench the desire, particularly for Americans, to go over to Europe. So I think Europe will still be a very healthy environment for us.
That was Delta Airlines CEO Ed Bastian on Squawk Box earlier this morning, talking about where he sees the strongest growth ahead. Delta's profit more than doubled, but shares are falling after the company trimmed its earnings forecast. Joining us now is Sheila Kayalu, Jefferies Aerospace and Defense Analyst. She has a buy on Delta with a $55 price target. Sheila, good to see you.
Thank you so much for having me.
Was the guidance that much of a jarring surprise, or would you expect something like that?
It wasn't as much of a disappointment as we expected. I think the shares are down massively today for two reasons. One, oil's up $3. Second, their cost guidance came up, costs up 1 to 3%. Think about each point of price, each point of cost being about $4, 40 cents of EPS. At 10 times earnings, it's $4 to the share price. So that's why you're seeing half the move attributed to that. So revenues came in line. The EPS guidance was modestly disappointing because costs are higher. Wages for pilots are higher. Maintenance expenses a lot higher. So that's why we're seeing that cost pressure that we called out actually prior to this print.
You favored Delta. It seems like you're kind of selective or cautious on the overall industry dynamics for this year.
Airlines are a tough place to be. We favor Delta just given their other businesses. Their Amex remuneration program we think is worth about $40 billion. They have this maintenance business that's $5 billion of revenues, of which $1 billion is external. That's growing given the GTF issues from RTX. We value that at $10 billion, so you're basically getting Delta as for free as an airline. We did upgrade American Airlines yesterday, I believe it was, because we think they're going to be the best in terms of cost.
Bullshit.
Cost constant for 2024.
She's playing follow the leader.
Anti-consensus call given the ratings there, and similar to Delta, they're not buying a lot of planes, although Delta did have an announcement this morning.
Delta is the worst company out there. And they're all pumping it right now, probably because it's cheap. We're off the 200 on the, that's probably why they're mentioning it right now. Jimmy would not take the trade until it hit 36.94. $37. I mean, we're definitely at a support level on Delta. I can't complain about that. But with it just brings doubt. I'm not saying they have the Boeing 737, but it brings a lot of doubt. And I'm going to wait for a better pullback on airlines. Now we got to 127 on my Mara. Then we pulled back some here. One, two, three. And the 9 crossed the 21. Thought we were going to get us a little boogie out of here, but When they go to pumping their stocks, I have to get away from them. I guess you didn't hear that guy. I don't know why they're pumping Dow. We're definitely at a 20-day support. Oh, gosh, 132. Mara. And if you're in this trade with me, take profit, please. If you got it. We might break out of this here. We've got a hard resistance at the 51. 51 here, and the 51 here, and the 50 on the 1 minute time frame. We do have some headwinds ahead of us. China. Spy key here by Carlocks. Jimmy's out of his mirror. Yesterday I think I went through the Bitcoin video and renewed everybody's support levels, how I looked at them supports. It's really a good one to watch if you want to learn how to use the fibbies. It's a cult-like following. You ever flown Delta? They took away my peanuts. They stopped serving liquor. I don't know if they've revitalized that or not. You have friends that are crazy about Delta? Well, Delta Dawn, what's that flower you have on? Could it be a painted rose from days gone by? I just always thought Delta was the worst of the airlines. But that could be old-fashioned too. Definitely, UAL's not really hitting the high spots if it's got the 737. Maybe that's a good reason why they're calling out Delta. Because of the 737. You know what I'm saying? So I could have a change of mind. It's more expensive to fly. That's probably why. I've flown the 737. I flew the Airbus. So let's find support on Delta. Let's go to the weekly. Let's clean this up. I definitely called Delta down here. We got a lot of garbage in our way. So you got a solid support right now off the 50 on the weekly. On the daily, you're bouncing off the 200. On the 20-day, you got support right at 38.76. So let's go back and do these again. Got it. I'll stick with that one. Damn, they're all three of them. That's strange. Huh, I've never seen that before. Oh, okay, I got it. Yeah, that's a good confirmation. 38.77. And we got 3 black crows after an extension candle. So if I was to trade Delta, I'd look at resistance to break at 39.57. If I was to jump in it on this third crow, that's a huge bearish candle right there. Okay, Delta Airlines president says he have seen some spillover benefits from grounding the Boeing 737 planes. There, see? I just said that, didn't I? I said they'd probably benefit because they don't have the 737 before I even read the headline. They lowered Delta CEO geopolitical environment behind the lower earnings guidance. So if we go into war, we're at war. And we could have started World War III this weekend. These Muslims are strong-headed people. So there's all kinds of reasons why I wouldn't want to invest in airlines right now. There's the 90-day. The 90 days even at the 200. So, I mean, you've got a lot of good reasons to want to swing this, double bottom, or trade it. But I just, God darn Mara. I just can't stand the fact that the market doesn't count in geopolitical tension when I've seen it over and over and over again before when they did. It just brings me back to how greedy these guys are right now. Dang it. I bet you Mara runs today at 138. I just missed out on $80. Probably get to 150. Another reason, if oil prices are jumping, it's another reason not to invest in airlines. Because fuel costs will go up. Look at that. That was a good call. Right to the frickin' 200 right there. Damn. Unbelievable. What did? Dow? They're pumping Microsoft big time. Do.
Humanly possible.
Bit of turmoil for Tesla to start 2024. The stock falling below its 200-day moving average, key technical level there. On several headlines, we got Hertz ditching a large part of its EV fleet, more price cuts in China, and now Tesla being forced to shut down its lone European factory in Berlin thanks to the attacks in the Red Sea. Shares on pace today for their 11th down day in 12, down double digits already for the year after having a very strong year last year, Carl.
Yeah, still trying to hold 220. Meantime, overnight, U.S.-UK coalition forces fired airstrikes on Houthi rebels in Yemen in response to these attacks on shipping vessels in the Red Sea. Despite the strikes, the rebels' military spokesman said such strikes would not deter further attacks on shipping. Obviously, Brent crude spiked on that news, touched $80 a barrel earlier this morning for the first time this year, and WTI did test 75-ish. Let's bring in former Defense Secretary under President Clinton, William Cohen, make some sense of this as well. Mr. Secretary, thank you for the time this morning.
Thank you for inviting me. Thank you, Carl.
Is it your sense that part of the market reaction led to the belief that this was pretty well telegraphed going in, that there had been sufficient warnings about this? Do you agree?
Oh, I do. I think the Houthis deliberately provoked this attack. Maybe they didn't expect this to be so severe in terms of our response, but they've been inviting this for some time now. And what they've had is an impact upon shipping, as you've been noting. As a result of that, the inflation is going to go up. All the cost of goods and medicines and other products are going to go up because the shipping costs are going to go up. So this is a deliberate attack, a tactic on their part. But you have to look at this. You have, we know what AAA means. We have triple H here. You've got the Houthis, you've got Hamas, and you've got Hezbollah. And they're all leading to Iran, to Tehran. And so there's a tactic and a strategy here for the United States to become involved to divert attention from Ukraine. By the way, Iran has a hand in all of this at several layers back. But the goal is to keep the United States occupied now in the Middle East, can't focusing on Ukraine, can't focus on other areas as well. And so it's part of an overall strategy, and I think it comes from Iran, which is supported by Moscow.
How does this keep from escalating further?
Well, I think it's going to, the Houthis are going to respond. The question is, in what fashion will they end up increasing the level of response by the United States? I think we have to calibrate ourselves here because we have the power to go in and do tremendous damage. But that carries a consequence. We have some riots taking place in Somalia. We'll have street demonstrations in other Arab countries. So this is all part of a plan to certainly keep the United States on its back heels as such, and to keep the Israelis focused on what's going on with Gaza and Hezbollah in Lebanon. So it's a plan, and it's come at moderate cost to them so far. We don't know the damage that's been done to date, at least I don't. And whether there's a lot of civilian casualties, I doubt it, because we've been so precise. But we have to really be specific, target, precision, and try to hold the line that we don't go full-blown into a conflict with the Houthis, who really are being the proxy of Iran.
Well, then why are we not more aggressive with Iran then, and more confrontational with Iran?
Well, to go into conflict with Iran means you really have started a major war throughout the region. If you're worried about oil prices going up on just what happened with the Houthis, imagine now that you've got a full-blown war with Iran and all that entails. The entire Gulf would be...
Oh, it's all about money. It's all about military spending. I hope we're getting well educated. None of this would have never happened. None of it. If we didn't elect that idiot.
Saudi Arabia is still the gas station, so to speak, that all of these other countries have to fill up at in order to have commerce and trade. So you don't go to...
I predicted it before he was even, when he was running, I said, we're in big trouble. Worldwide and here.
Tried in the beginning.
To look for a genocide, and we got it.
To stop their progress on developing nuclear weapons. And that is off the table now. We know that Iran is not interested in that.
You don't know that.
Hamas, we know that.
See, they don't know that.
Etc. So
it's just like they're saying they knew that we were going to have 6 rate cuts, and they run the market up so high. It's speculation.
We don't need a major regional war with the United States deeply involved as we have been in Iraq and Afghanistan, and now be pulled into the whirlwind in the Middle East, including against Iran. And Russia would not be sitting on the sidelines if that were to take place. China would not be sitting on the sidelines. That would impact the world economy, and everybody has an interest at that point.
I mean, we got to be extra careful because this market hasn't priced this in.
Be restored safely in the week.
And that one lady said it perfect this morning. And I've been saying it for 3 or 4 weeks, that the market's not pricing in the tension that could happen. And if you go back and watch some of them videos that we bombed Yemen, and it wasn't pretty. We hit a lot of spots.
It's back in 2.
Now that's three wars that we're involved in. Not 1, not 2, but 3. And we can barely fight one front. It's at JNPR, JN Jupiter, JNPR had a good run yesterday. People taking profit.
European markets moving higher this morning as markets digest some positive economic data out of the UK. Britain returns to growth in November after an October contraction, beating expectations. China, on the other hand, continues to struggle. The consumer price index there contracting 0.3% from last year in December, marking 3 straight months now of declines, which is the longest streak since 2009. Factory gate costs fell 2.7%, have been in the red for more than a year. And finally, exports fell 4.6%, the first annual drop since 2016. A lot of investors were trying to figure out whether they should get excited about China rebounding this year, given some of the positive commentary from leaders and the big drop in the market last year, leaving valuations looking good. So far, we really haven't seen much evidence, though, of a rebound.
Most of the notes today are titled something like, "Your move, PBOC. What are you going to do about this incredible stretch?"
And the story for last year.
Yeah. Meantime, B of A's conference call getting underway at the top of the hour. Let's get to Leslie Picker with the news alert on that name. Hey, Leslie.
Hey, CQ. Yeah, about halfway through that conference call, Bank of America shares under pressure a bit today with a focus on the firm's net interest income trajectory. That's the profitability metric from loan making. NII was down 5% to $14.1 billion due to higher deposit costs and lower balances offset by higher asset yields.
I only see one good thing about Bank of America right now,
NII would trough
that we're at the 9. And I've been talking about the 9, been teaching, doing videos about the 9 EMA, how to trade it. So we're definitely at support if you look at the 9. This is weekly candlesticks, 9, 9, 9, 9, and now we finally touched the 9. Now if this does not hold, and I'm going to look at the yearly on Bank of America, we can easily drop down to the 50, and that's right around 31.17. We have an ascending triangle right here. And that 50 is a double confirmation. So I'm going to wait and not take her pump because the news sucked on all these banks. All these costs, I don't know where they get all these. They said, was it Citigroup or JP Morgan spent $1 billion on something. One of them is going to lay off 20,000 people. AI is coming into the scene. The human factor, I mean, it won't be nothing in another 10, 15 years. You got to be well educated if you're going to have you a job. All but working in restaurants and stores and stuff. Because it's going to be all about AI and robots. Robots making your hamburgers for you. I won't be around to see it probably, but flying cars. Everybody will be taxied around because they can't afford, they won't be able to afford these expensive cars. I went out and looked at the Escape. They wanted $31,000 for the Ford Escape. And I told them, I ain't paying that kind of price for your car. So if it was a, I don't know, $31,000 for a car. When a few years back they were like 26, 25. With a discount, you could get one probably for 19.
Carl, Sarah, this is with regard to the ongoing patent dispute over watch technology and patents owned by Massimo, used in the Apple Series 9 and Ultra 2 watches. You may recall that the International Trade Commission had said that Apple did violate those patents. It was up to the U.S. Court of Appeals for a stay in that. We have gotten the court ruling from the Court of Appeals. The U.S. Court of Appeals for the Federal Circuit have considered Apple's remaining arguments and find them unpersuasive in the Massimo patent dispute. In this case here, the Court of Appeals for the Federal Circuit says the decision of the International Trade Commission Board is affirmed in the patent dispute, meaning that they have now seen that Apple has not made a case that they should be able to resell those watches again. So it's something to keep a close eye on. We'll continue to watch these legal developments. But for Carl now, it seemed to move the stop slightly to the upside. But again, not a lot of action here with regard to the stock. But it is from a legal perspective. I'll send it back over to you.
All right, Don, thanks. Keep us updated on it, too. Let's get a news update as well with our Pippa Stevens. Morning, Pippa.
Good morning, Carl. Republican House Speaker Mike Johnson standing by his bipartisan spending deal despite opposition from hardliners in his own party.
Our top-line agreement remains. We are getting our next steps together, and we are working toward a robust appropriations process.
His commitment to the nearly $1.6 trillion agreement he came to with Senate Majority Leader Chuck Schumer came as some conservative members told reporters they believed he would push for a new deal. Hundreds of thousands of people in Taiwan attended last-minute election rallies today ahead of tomorrow's crucial presidential and parliamentary elections. China, which claims Taiwan as its own, framed the vote as a choice between peace and war. And the Olympics has its first ever official beer, and it's alcohol-free. Anheuser-Busch InBev announced today its Corona Cero will be the flagship beer for the Paris Games. The Olympics have never had a beer sponsor before. AB InBev says alcohol-free beer is growing faster right now than the overall beer category. Sarah, I guess dry January extension.
Yeah, trying to dig out of the Bud Light hole as well. Thank you, Pippa. Pippa Stevens. Tilray shares are off more than 15% this week after reporting results. On a 2-year basis, losing nearly 3/4 of its value. So how can CEO Irwin Simon turn around the stock? We're going to talk cannabis when he joins us next.
She's gonna smoke cannabis? She doesn't. She hates it. Every time she used to talk about cannabis, she just did. Well, she had that smirk. At 185 is the old number I used to get in this trade at. But I'm not going to do it right now. Yeah, you're right. A war is spend. Lockheed Martin used to trade that gunpowder stock. POWW. See what happened when that war started? Let me see here. Back when, on the 7th, what is it, 7th? Right there. Right here is where the war started. I should have thought about that. Now I did. It's too late. That's when the massacre happened. Right at the 200. POWW popped up from $2 to $3. I used to trade this at a lot higher price. Between 5 and 7. Back when Russia started their shit. So I'm going to go get me some lunch going. Then I'm going to come back and go over my watch list. Facebook. I'm going to look at Meta. Meta has a new high. I'll be right back.
Netflix is on the move this morning with multiple bullish calls on the street. Let's get to Julia Borsting run through some of those. Morning, Julia.
Good morning, Carl. Well, a couple of analysts are weighing in on Netflix's advantages in the media and streaming space. Oppenheimer raising its price target to $600. That's 22% upside on an acceleration of advertising monthly active users, saying this suggests significant upside to street estimates. This comes after Netflix's ad chief announced 23 million ad monthly active users, up from 15 million in November and 5 million in May. Bank of America also named Netflix one of its 3 top media picks for 2024, noting that Netflix is the only major streaming platform that is profitable on a trailing 12-month basis, warning that subscale streamers will need to evaluate M&A options, also forecasting bundling, content licensing, and windowing content that was previously exclusive to streaming for others in the media landscape. Now, BofA's other 2 picks are Spotify on Warner Brothers Discovery, the latter in part on M&A potential, and you see those stocks moving just a little bit this morning. Back over to you.
All right, a little bit higher, all of them. Thank you, Julia. Let's talk cannabis. Turn to Tilray. The company delivered mixed results earlier this week for its fiscal Q2 and joins us now with the outlook for consumer demand and their latest push into alcoholic beverages. Let's bring in Tilray CEO Irwin Simon. Always good to have you, Irwin. Welcome.
Thank you, Sarah. Good morning.
Good morning. I was a little surprised to see the reaction to your earnings, which was a beat on the bottom line, and I think almost got to profitability.
So, listen, we were up as a company, 34%. We had 194 million in sales. If you come back, we're number 1 in market share in the Canadian market. We're the largest in Europe in cannabis. But step back and look at the growth. And I heard you're, talking about Paris for non-output ABI before. We're in the midst of doing that. So there's a lot of great things happening within our legacy beer business, where our legacy beer business was up 10% and, the beer category was down. So a lot of good things happening at Tilray. I guess some of our shareholders didn't think so. But I come back and say this here, there's a lot of unique things happening within Tilray brands. In the cannabis world, which, we have in front of us, rescheduling potentially, which would be very helpful to Tilray and bringing in, different investor group, banking, etc. And, we've only owned the ABI businesses 2 months, and we got some exciting new products happening there. And, I was in Germany not too long ago, spent time with the German government, and lots going to happen in Europe in regards to medical cannabis.
So because of the sort of exciting parts of the story, the overseas growth opportunities, the beverage business, I thought one analyst note, I always pay attention to Consumer Edge. They posed the question about whether in the next few years you're even going to be in Canadian cannabis. I know that's the bread and butter, Irwin, but because there are better growth opportunities and you're transforming the company elsewhere, what happens to that Canadian marijuana market?
So listen, I think the big thing is you got to step away for a second, Sarah. Canada is the only country in the world where recreational cannabis is legal today. It's a $5 billion business at retail. It will grow to a $10 billion business. And think about it, we're number 1 in the Canadian market. We have 5 million square feet of grow out there. We have 12 brands, so we're well entrenched. So we plan to stay in that Canadian market. The other big thing in the Canadian market is not only pre-rolls and flowers and edibles. We think the drink business, infused drinks, which we have the largest share, we just recently bought from Molson, their trust business, and you talk about dry January. Hey, if you're drinking a cannabis drink, if you're drinking a drink infused with cannabis, it's a drink in dry January. So we like the Canadian market. We think there will be a lot of LPs. We think there will be other consolidation, and we still see a good-sized market, a good-sized opportunity within the Canadian market.
I mean, I wonder how much the share price just reflects, Irwin, the fact that people are giving up on any sort of federal legislation around marijuana, which just, it feels odd because 24 states and Washington, D.C. have now approved recreational marijuana. 14 others have legalized medical marijuana. Where do you think this is all going?
Interesting, because you step back today, about 25% of our sales come from cannabis. If you look at Reddit, you look at Wall Street Bets, everybody wants to talk about cannabis. So originally, when I was getting into the spirits and beer business, I said, wow, I don't know if I want to get into that because I don't want to lose my multiple in cannabis. And, maybe I should. But I think it's just people are frustrated. There's so much money that was lost within the cannabis world. But, Tilray has done a great job in regards to market share, innovation. And listen, there is a lot of regulation that we have to stick by. In the Canadian market, we pay over $150 million in excise tax in the regulatory market that we go through. And the Canadian market, cannabis has only been legal for 5 years. So dealing with that, and by the way, we can't even advertise in the Canadian market about our brands. Something will happen in the U.S. You said it before, Sarah, 24 states legal and recreational, 11 medical. That's over 50% of the population. And, in New York City, you walk every corner, you smell cannabis, okay? Listen, I saw an interview on CNBC the other day with the Eli Lilly CEO talking about coming out with new medicines for sleep, for anxiety, for pain. There's a lot out there that cannabis is doing today, and there's a lot of research. So if you come back and look at Tilray, you can't just look at it anymore as a cannabis company. We're a beverage company, and there's a lot of great new products that we're coming out with. Montauk is coming up with a non-alc. We're coming up with a Runner's High that's a non-alc. We're doing a lot within the spirits business. So there's a lot we're doing. And I'm excited about the beer category. And yes, it's taken some punches in the face, the beer category, but you step back, there's a lot of the new innovation that's coming out behind beer, and making beer cooler again is something that we're focused on.
Erwin, appreciate you joining us with an update on the strategy and the big picture. Always good to talk to you.
Thank you very much for having me, Sarah.
Meantime, Nvidia's up double digits this week, shrugging off some China concerns. Can mega caps repeat last year's performance? We'll talk about that.
Also, we have to be watching United Health today. Top and bottom line beat, but health insurance bottom line results were pressured by higher medical costs. The stock is down. It's a big drag on the Dow. You can read more about the quarter on CNBC.com. We'll be right back.
You might have to go lay some more ice melt down. I don't like driving on this shit. Let's see here, if I find the number. Yeah, I'm not too happy with earnings so far. IRS. Mm-hmm.
CNBC. Shares of NVIDIA soaring this week after its already 240% gain last year. Is that a sign the stock could see another banner year? Our Deirdre Bosa tackling that today in Tech Check. Morning, Dee.
Hey, good morning, Carl. Well, tech as a whole, it feels like it's back after that very poor start to the year. NVIDIA leading the way, quietly up some 12% this week alone. And that is quite a change in tone from the first week of the year when the Dow, remember, it hit a fresh all-time high, but the tech-heavy NASDAQ, that lagged. Part of that was the air coming out of the NVIDIA story after a banner last year. Export controls restricting China sales and reports that Chinese customers didn't want that downgraded silicon. That is still in the backdrop, but as B of A put it this morning, NVIDIA is just NVIDIA. Huawei nor any other Chinese chip maker is going to replace it anytime soon, and there's even reports that Chinese companies are resorting to repurposing NVIDIA gaming chips for AI. On a price to earnings basis, let's look at that. It is not hard to find arguments that NVIDIA is still cheap. Consider NVIDIA versus Amazon. Amazon trades at around 41 times its projected 12-month earnings, while NVIDIA trades at just around 26 times. They are both AI beneficiaries, but one indisputably dominates its market, while the other is still making that case to investors. Let's put it another way. NVIDIA shares, they more than tripled last year, yes, but that actually lagged the fundamental growth of the business. Earnings nearly quadrupled. Now, other chip names, Marvell and Broadcom, also getting some buzz out of CES this week and helping to push up the semi space as a whole. We talked about software earlier this week as well. A new normal where valuations settle at perhaps more mundane levels, but leading to fresh opportunities. The IGV software ETF up nearly 6% since Monday. The deal chatter continues to roll in the space. You've got HPE and Juniper. That was an unexpected one. And then you've also got recent reports of private equity looking at PagerDuty and DocuSign. This week's action in mega caps and a layer down, maybe suggesting that tech and AI could continue to drive leadership this year. But what could spoil the optimism? That's upcoming earnings. Yes, we're already there. 2024 guidance, that will be key. And that is where worries could come into play and investors could start to take a hard look at these early gains. One name that I'll end on, guys, is
I can
Apple.
probably go out there and scrape my window off, put my blanket on top of my windshield.
Actually naming it a top pick going into earnings. We broke down this AI proposition in our weekly deep dive. It's about 10 minutes long. Be sure to catch that at cnbc.com/TC Weekly. Guys, I heard your conversation at the start of the show with the RBC strategist, and sort of the bear case here is that what else is there to buy, right? There could be opportunity elsewhere, and you got to take a hard look at those valuations.
Yeah, it was sort of like peak optimism she was talking about from her tech analyst. Thank you, Deirdre. CFO of Wells Fargo joins us after the break. The stock reacting potentially to the outlook on net interest income for 2024. We'll dive into it next.
I feel like you need to be really, really concentrated on the trades that you're in today. They're pumping Netflix and they're pumping Microsoft. And they've been pumping Meta. And I haven't heard much about NVIDIA. Always clean this Jim. May I help you? Hello? I'm busy right now shoveling ice. No, I've already got health care. Your records are wrong. Is this a recorded person? Are you a robot? No, no. That's all right. We're in an ice storm right now. No, but I have health insurance. I'm 62. So who? Hello? Oh, God. Damn people leave me alone. God. I'm so confused about this healthcare stuff. As I get old, I don't know what to do. I'm healthy as a button. My stitches are all fine. Now what was I talking about? Oh yeah, Leli Lily, because we're talking about healthcare. So those were the top 5. And Boeing was getting pumped real hard by these guys, and now they're sitting on a rock waiting for the seeds to grow. Boeing's going to drop more. I mean, there's no certain date now for these planes to get back in the air. We're still going to keep it at the 200. We're going to wait. 215, 214, 215. And the Tesla news is not good, so we got to wait for Tesla to pull back more. Now, I'm a bull on Tesla, don't take me wrong, but this is a bear flag here. Inverted hammer, but I still think we can have another one down there. I'll listen to a couple of my Tesla people here on their videos tonight, get some kind of anchoring. Mara's dropped a little bit more. Sue called a put on Mara. Let's see where we are on my support level. We got 1939 was my lowest support. So we're definitely at my 3rd support on Mara, but I'm not going to. I traded it earlier here out of the wedge, out of the snake. Inverse head and shoulders. Now we're playing. Now we've got the body of that candle's my next one. If that doesn't hold, we could get to the 50, right around $16. If this number doesn't hold here, Wells Fargo wagon.
Economic picture, like we
First play I ever was in was Godspell, if I remember right. That Wells Fargo wagon is a coming down the street.
cards, at least for what most people are projecting the base case is as we look for the rest of the year.
Right. There have been some cautionary notes this week about the low end, looking at credit card delinquencies and what some argue is a near complete erosion of that excess savings from COVID. Is there any question that would lead a rise in delinquencies and a huge jump in provisions?
Well, for us, that's a pretty small part of our portfolio, but you are seeing stress in some cohorts of clients, and it's just, think about folks that are down in the lower wealth and income levels. The cumulative impact inflation really has caused some stress. For
hell yeah.
You see that in credit card, balance growth. You've seen that, in other metrics there. Now, will that create some kind of cliff effect? Hard to say, but I do think that there are some folks that are more stressed than others, and sometimes that gets lost in the averages and the overall picture that you see. But it is real. It's small for us, but I do think you may see that in other portfolios.
More progress on expenses. Mike, we've been talking about this for several quarters now. I wonder where you are on this cost-cutting journey and what's left to do.
Well, first, we're really pleased with the progress, right? We started this journey a few years ago. We said we would cut $10 billion.
Years ago, Wells Fargo's CEO stepped down. They had real bad issues with overcharging the poor on some real estate, foreclosing on people that couldn't handle the housing crisis. I don't know. It's been a long time. It might have been later on down the line when he quit, and that shit hit the fan. So Wells Fargo wagon is a mediocre bank. It's not like a J.P. Morgan. Morgan Stanley's the worst. And then Wells Fargo's was one step behind them. I had a car loan with Wells Fargo and I loved it. I had one with Bank of America too. But Morgan Stanley should be down today. I mean, these earnings did not sound good to me at all. All the write-offs and stuff and the cost. Bank of America's the worst. Don't tell that to Buffett. Oh, yeah. Then you know through experience. I'm going to go make some coffee and get my lunch ready and then get back into this. I'm having a good day. But it's a day that you really got to concentrate and not kind of left around, or you're going to find yourself in bad trouble. But right now, I'm very bearish. I said I'd let today be my judgment day. And that's where I am. I'm not saying the market's going to tank. I'm just saying that's where I am. Here's Sarah. And short sleeves. I can't stand looking at them short sleeves, and it's freezing here.
Next week, it's going to get busy with earnings, but we're going to get retail sales, industrial production, existing homes, Beige Book, Waller's in there as well. Going to see whether or not he echoes his speech from a few months ago about
Beige Book.
restriction.
And more bank earnings, of course. I think you mentioned Wednesday retail sales. I think is going to be very important because the second quarter growth is not looking all that bad. It's trending around 2%, a little bit higher, according to Atlanta Fed. And now first quarter GDP growth for 2024 inching a little bit higher than expected. It all rests on the consumer.
Have a great long weekend. Let's get to Frank Holland in the half.
Carl and Sarah, thank you very much. Welcome to the Halftime Report. I'm Frank Holland in for the Judge Scott Wapner. Earnings are front and center this hour as the big bank kick off things in a very big way. And the Dow pulls back from a new all-time high. Our investment committee is standing by right here at Post 9 to break down all the moves. Joining us for the hour, Jenny Harrington, Joe Terranova, Brenda Vingello, and Jim Labenfall. But first, let's get a check of the markets at noon Eastern. The Dow down right now about 0.5%, pulling back from its record high. The S&P, we are on record close watch. Right now, the number to watch is 47.97, but as you can see, it is fractionally lower than NASDAQ. Moving to the downside, looking like it could break its winning streak. We'll continue to watch. We're also watching the yield on the 10-year Treasury. Right now, back below 4% at 3.95, something we continue to watch. After that cooler than expected PPI report, we'll talk much more.
Every one of these charts look the same on the ETFs.
On earnings and on the banks.
Every one of them.
To start, I think, might be J.P. Morgan's broad ownership here.
Every freaking one.
Record full-year earnings, record full-year revenue.
Somebody just unloading.
Banking revenue up 3% year over year. What was your take?
My take is there's J.P. Morgan and then there's the rest of the banks. And that's the story. That is the way it has been for the better part of the last 12 months. It's the reason why I own J.P. Morgan personally, and in the Joe T ETF, we've been underweight financials for the last year. It is so disappointing to see what the other banks are reporting relative to the strength that J.P. Morgan is reporting. 7 consecutive quarters of record net interest income. And there was no conversation about net interest income declining at J.P. Morgan like there was at Wells Fargo. Wells Fargo said net interest income could be down 9% in the coming year while Wells Fargo's expenses rise. So disappointing for all the other banks. I'm a little bit surprised at Citi. I thought the near-term momentum I thought, in fact, you'd see some buying demand surface. You're not seeing that. Basically, if you're stepping in and buying Citi, you're believing that CEO Jane Frazier's comments about 24 being a turnaround story, that in fact could be correct. But
if we go into a recession, it won't be.
Income 5.8%. These other money center banks are just not delivering what J.P. Morgan is delivering on.
Yeah, I think you might have a Citigroup believer down there on the other end of the desk. But I'm going to talk about J.P. Morgan a little bit longer with Brenda. What was your take on the quarter and also the comments from Jamie Dimon, kind of on one hand saying the economy's strong, on the other hand, really spelling out a lot of geopolitical issues and macro issues?
Well, I think on Jamie Dimon's comments, it's not unlike what we've heard from him over and over again, where he's expressed concern over various components of the macro environment or geopolitical event.
Now, understand that Jamie Dimon's in the hot seat only because he criticized the Jew hate that's been going on in the country, the hating the Jews. So he's in the hot seat right now, and Wall Street will beat him up a little bit.
Pleased with the commentary, but not surprising to hear Jamie Dimon's, cautious comments because we've heard that over and over again.
What did you make of J.P. Morgan and, in all fairness, Bank of America as well, saying, if not for that FDIC special fee, our results would have been this? Is that meaningful to you as an investor?
I think it's part of business in the current environment. It's known. And it's a function of the banking crisis that we had early last year. So I think we can move on and move forward. And so not terribly surprising, and certainly doesn't change our view of J.P. Morgan, although I'll say that is our only exposure to banks is J.P. Morgan.
So Jim, you own J.P. Morgan, you also own Citigroup. Revenue miss, EPS of 84 cents. Not even clear if that's comparable to estimates. In September, Jane Frazier said she's reorganizing. Now we know it's at least 20,000 layoffs, $1 billion charge related to severances. My good friend Hugh Sung from CNBC.com, litany of charges.
Yeah, but it frankly expected. And when I say expected, why do I say that? It's because the stock trades at a 40% discount to tangible book value. So the street already understands that whatever book value is, it's got to get knocked down by charges. And frankly, in that scheme of things, the size of the charges that we're talking about are actually minuscule, okay? So that if you actually got Citigroup up to tangible book value, you would see something like a 30% share appreciation from here, maybe 40%. You know, Joe, I hear what you're saying, and I don't argue against it about J.P. Morgan versus everyone else. For a few months now, I've tried to recharacterize this. I don't want to say for a second that Citigroup is competing with J.P. Morgan. They're light years apart. I mean, you can look at the wealth management business. You can look at the investment banking business. Citigroup's a different story. It's a restructuring story. And let's face it, this is a restructuring that has been overdue by almost 25 years, going back to when Sandy Weill built this behemoth and it got way out of hand. Jane Fraser is the first person who has actually taken a scalpel, or maybe it's a machete, to getting this bank to the right size. She's taken a lot of steps in that regard. I think she's making great progress. And for Citigroup, what you're really looking for here is where are expenses headed? They're headed down. That's in the guidance. Was the quarter great? No, the quarter was bad and had all the sort of charges. But the year ahead, you're looking at expenses coming down, and that's what investors in Citigroup want to see.
So are you buying Citigroup for the turnaround story, which evolves over the course of 2024, or are you buying Citigroup because you believe the turnaround is something that's going to be sustainable and you can own this the way you can own J.P. Morgan for multiple years?
Yeah, again, I don't want to make the comparison to J.P. Morgan. We're just talking about light years.
But just
different,
purely
right?
on a time, thinking through ownership time frame.
I do think it's sustainable, to answer your question, right? These are permanent expense cuts. Just the way they, by the way, some of the charges, right, were international charges because they're shutting down operations in places like Russia. In the next year, year and a half, they're going to spin out the Banamex operation. These are things that do take time. But once you do something like spin out the Banamex operation, you're not going to bring it back in. So it is sustainable. And the key here, Joe, the key here is tangible book value. You're trading at 60% of tangible book value. That's too low.
But if you're getting leaner as a...
I just love how these guys, when they get caught, I've been very bearish ever since we had the 52-week high. Okay, very bearish. And none of them, they're still pumping this market with the multiples and the blah, blah, blah. And we're hearing nothing but bad news. And it just eats me up how these guys are pumping this market. I believe they've really overpriced it. They want this to break so bad. And I've been here before, but not like this. This is extra extreme greed. But I got to keep going back to this here candle. I've never seen anything like this. I've never seen anything like it ever, ever, ever. And they don't want to drop this market because they think they can break this triple top yearly 3-year candle. They really think they can break it. They want to break it. They want to break it real bad. It's eating them alive how bad they want to break this candle. They can't stand it. SPY. I mean, they want to break that number so bad, at 4799, more or less 480. It's just eating them up. They want it bad. They want to break that 4800. The 4800 is a hard resistance. We've been told that by a few of these guys. And my number would be the body, and it can't be exact. Right there, 4,800. That's it. That's my number too. If we ever get above that 4,800, we're off to the races. They want it real bad, but now they're kind of pleading, telling you that banks are cheap. If you count their multiple, whatever they're talking about, the fundamentals. And they're right. I mean, if you go back and see how many years we've got to go back here. We're 30, I mean, if you look up here, we had the same kind of shit. 4 years in a row, we couldn't break resistance. We tried 2 here a couple times during the Trump years. But it's just real hard to break. A triple top yearly count, I've never seen anything like it. But these banks are cheap. We're down $20 on BAC. JP Morgan, we broke resistance finally. So that's our hope. They're all these other banks are cheap. Goldman Sachs. I used to trade the heck out of Goldman Sachs. This used to be one of my favorite ones. But the earnings are so disappointing. They're saying it out of his own breath. And I don't want to get caught in that bubble like I did with AI, where I could have really shorted the heck. I mean, not AI, but COVID. Tech. What else can I chop in here? Now I gotta go eat. JP Morgan, Microsoft. Microsoft broke resistance. We got an inverse head and shoulders, and we broke out of it on SPY. So if we run up, it'll be the 200 today at 476. Coffee. Okay.
when it comes to mega cap tech names?
Yeah, so we're not overweight all the mega cap tech names. We're picky in where we have our overweights, but I will say if we look at the fundamentals and their contributions to earnings growth.
The fundamentals. The fundamental traders. I can't stand them.
Cap 8 stocks earnings expectations are actually for a negative year-over-year growth rate for the Q4. So I think, we can't ignore that these stocks are really huge contributors.
If I was a swing trader and I didn't want to worry,
also, many of them are tied
but still yet, I'd be worried.
The evolution of AI, which is important. We can't ignore it, but that is a new wave of innovation coming our way. And
this is week 2 now that we've hit week 3 maybe. They want it so bad.
As like small and mid cap. But I think we can't ignore that the strength of tech and the need to, in our view, continue to have some exposure to that part of the market.
Jenny, agree or disagree? I know you only have a small position in Meta, but what do you think about the Mag 7 and tech going forward? Do you think they continue or show leadership in this brand new year?
Well, I think it's magnitude of leadership that we're talking about. So I think if we think about their actual businesses and the role that those businesses play, not just in the U.S. but globally, like from that business perspective, they'll maintain their leadership for the rest of our natural lives. From the stock market leadership, I think it's impossible for me to make any case where they would maintain, and this is a really important nuance, the magnitude of their performance leadership that they've had in the past. And so Steve and I were getting into it last week, right? Because he was talking.
Finally, someone with some common sense.
What do you think is behind it? What do you really think Microsoft could return next year? And he's like, it should be at the market or better. And I was like, you know what? Fair enough. I'm not going to keep arguing with you on that. And so I think as we think about the Mag 7 overall or the Mag 8, I think that's probably how we should reframe and think, okay, it's not likely that they're going to be up 62% again this year like they were last year, but if they perform kind of in line with the market, that's great. And there's a really important thing to think about here too, which I bump into with a lot of my clients. So while you all know I don't own any of these except for Meta in our disciplined growth strategy, we have tons of clients who have very large positions in Microsoft, Apple, Google, Amazon. Why? Because they've owned them for years. When they moved their accounts over to Gilman Hill, they had like zero cost basis. So if you're thinking about selling Microsoft or Google or Amazon, and you've got, say, like $1 million worth of these stocks, which people do, and the cost basis is essentially zero, you need to say to sell that stock, I need to expect it to go down by 23.8% because that's what the capital gains tax rate would be at that point. And so that puts this incredible foundational floor under the continued ownership of these for a long time. So when we think about them going forward, it would be very, very hard to envision a mass sell-off. But at the same time, when we think about our portfolio, the thing I used for my final trade last week was Aptiv, right? A small cap company mid kind of small cap company they make the harnesses for wires for EVs, right? But it trades at 14 times earnings with 25% earnings growth ahead. It's hard for me to imagine that doesn't have performance leadership in the coming year. So that's where I'm struggling. Like Mag 7 can be fine. It's probably stupid to sell them if you have huge capital gains, but the magnitude of leadership on a performance basis, I can't get to anything that would justify it.
Joe, I know you on Microsoft. You're saying don't move too far away from these mega cap names. We got to keep moving on the show, though.
Everyone has a specific discipline. I run an equally weighted strategy. We're all looking for a broadening out of the market, right. But you have to acknowledge it has not happened so far year to date, and it's a reason why the market is so choppy, allowing the algos to be in control.
It's not going to happen, you idiots.
Delta, United Health, and DocuSign. We got ownership in all of these names.
I'll tell you why it ain't going to happen. I'll run it right through you. It's just plain. They've said it over and over and over again, kind of hidden. Meta is a good example. Double top all-time high. We had a huge sell-off. It's called a V recovery. It's one of the hardest resistance to break. V-shaped recovery. Definition. A V-shaped recovery refers to the type of economic recession and recovery that resembles a V shape of charting. It involves a sharp rise back to the peak. Sharp. Irrational exuberance. A V recovery. The economic has experienced a strong recovery with unusual high wage and inflation growth. Inflation. We believe this makes the Fed's job difficult and creates market uncertainty. So it's an uncertain market when you have a V recovery. For Riverfront, this underlies an importance of being agile, be on your toes. None of they're not saying it. They used to say it. They're extremely greedy right now, and they're not satisfied with a 300% gain. They're not satisfied with a 200% gain when most hedge fund managers are satisfied with 20%. We're at a triple top, 3 yearly candlesticks. I can't be very, very bullish at this point. I sold 3 of my swings at 200%. I've never made that kind of money in the 20 years that I've traded. In a year. So I just got to be extra cautious. I hate to be a Debbie Downer, but I don't want nobody to lose money when we got maybe a breakout of a world war. If the geopolitical was different, I'd have a wholly different attitude about everything. I wouldn't have any worry about breaking that triple top at all. None. Microsoft's always been an underperformer. Now they were doing this to Apple. They were pumping Apple. They were at the end of the year, Apple's going to break and we're going to move up and the market's going to move. And a bunch of bad news came in on Apple. And the same thing could happen with Microsoft. The same thing could happen with Eli Lilly. They're saying this new drug, well, you might lose hair. But the benefits is, and now they're throwing in Alzheimer's on a weight loss drug. It'll cure Alzheimer's. Next thing you're going to say, it's going to cure gout.
$42 a share. And this was one where we sifted through the rubble kind of the fallout of 22, sifted through those Zooms and the DocuSigns. And when you looked at it, you're like, wow, this is just really cheap. It has real earnings, it has real cash flow. The shares should not be trading at $42 a share. So it's interesting because when we bought it, we didn't think that this was going to be the catalyst to drive shares higher. All we thought was there's tremendous free cash flow generation, unbelievable barriers to entry, and that just says there's value in the stock that's not being appreciated. But then when you think of that, right, high barrier to entry, lots of free cash flow, like of course.
If these earnings were better than expected on banks, this market would be breaking out probably today, but it's not.
The question that I have, I don't know, Jenny, you might know the answer, is what type of premium do you think this company will be acquired at?
Oh, I don't know.
Well, that's a big question.
That's the huge question. And also, what if they join forces? Then obviously will lower the premium because you won't have two competing bidders.
Right, correct. And that's important to understand where we are now. How significant is that premium? What is that going to look like ultimately? And that's going to allow you to determine what you're going to do from it.
From here.
From here.
All right, stock's at what, almost 64 right now? Jenny, what did you get into it at?
42.
All right, so
So
for
it's
you.
like, right. So when you say like, what's the premium? Like, wow, it's already exceeded what we thought our 1-year price target would be so dramatically. And that's tricky work, I think, to go back and say realistically, what are like you're going old school value investing in a way and saying like, what's the private market value that this thing should trade at? I don't know. Like I could wing it and just say 70, but I think it's closer to where it should be right now.
All right, DocuSign up over 4% on news.
She can say 70.
Time now for headlines. We're going to toss it over to our Pippa Stevens. Pippa.
I agree with her.
Frank, the Biden administration is pushing the Supreme Court to step in on its border fight with Texas. In a filing today, the administration accused Texas of adding walls and wire to the border in an effort to keep the Border Patrol from doing its job. The filing also claimed Texas's actions were limiting agents' ability to respond to emergencies. It argues the changing conditions show the court needs to intervene quickly. The IRS collected another $360 million in overdue taxes from the rich as a result of modernizing the agency using funding from the Inflation Reduction Act. In a call with reporters, the agency said in addition to taxes recouped in October, nearly $500 million have been recouped from rich tax cheats. And the highway to the danger zone just got a little more crowded. According to Puck News, Paramount is bringing back the team behind Top Gun Maverick for a third installment of the franchise. The series has been successful for the studio, with Top Gun Maverick bringing in over $1 billion at the box office. Frank, back to you.
All right, our Pippa Stevens back at CNBC headquarters. Pippa, thank you. All right, coming up next, our calls of the day. A lot of analyst action this Friday, including a price target hike for one of last year's big tech winners, plus upgrades in materials, biotech, and much more. The committee debates it all when halftime returns. Stay with us.
I figured they brought up that Maverick movie, said bringing in some money. I had to go look at AMC. This has a cult following for sure. I think it's going to go down more, but all it takes is a Reddick bunch to get in here and pump it. Every day I keep saying it's going to drop more, and it's dropping more every day since. Pretty soon it'll be beyond help. Oh, that's another one I want to look at, Zim. Coin's about to my 50% pullback. I haven't took the trade yet, but I want to see if it holds that 50%. It could drop more though. Hit this peak right here. We're at the on the yearly we're at the 50 SMA.
BC.
Oh, I bet you that's a good one.
The halftime report. Let's get to our calls of the day. Uber touching a new record intraday high today. And Wells Fargo thinks it can go even higher. The firm boosting its price target by $2 to $76 a share. Jenny, you own Uber, but you've actually been trimming it lately.
Right. So we bought it a year and change ago, 2022. We paid $22 for it. Put it in as a 3% position. So if we were still holding that whole position, it would be way over 7%. And that's just too much. This is in our disciplined growth strategy. So we always employ a lot of discipline. It's actually the third time we trimmed it. So we trimmed it at 47, 50, 58, 59 last week. And I think that's just responsible. So here we sit with a 3 and change percent position. I think their price target is a little too aggressive, for the next year or so. I think maybe like high 60s is more realistic. And that's where you get into, okay, if we get to the high 60s, there's 10% upside between here and year end. That is excellent. I love 10% upside, but I think there's other things in the portfolio that could easily return more than 10%. So let's take that nice return they've given us, diversify a little bit, reinvest into things with more than 10%, and maintain a balanced portfolio. So that's all that is that selling. Look,
So
the
Joe-
prospects are still amazing for that company.
Joe, you own as well. Still bullish on this name?
Absolutely. I think today at one point the intraday high is an all-time high for Uber. I see the stock clearly going into the 70s. I did a little trimming in Uber as well, but this is an industrial growth story. And to get the type of revenue growth that this company delivers, the type of balance sheet that you're owning and in owning this company, and then just the overall necessity for the consumer and for professionals in the utilization of Uber, I see this stock clearly well into the 70s.
All right, Uber shares fractionally lower right now. We're going to turn to Cleveland Cliffs. Upgraded to overweight at JP Morgan. The analysts there citing greater focus on shareholder returns. Jim, you own this one.
Yeah, and the analyst is returning to the stock from an unrated position while JP
Goldman
Morgan is
Sachs
advising
maintains a buy on Uber at 78.
But he's coming back, and it's a fresh voice to say what we all know.
So
There's
it's a
a
Wall Street
tremendous amount
pump.
of cash flow generation going on at Cleveland Cliffs. Hot rolled coil prices are very high. They were $700 a ton just a few months ago. Now they're almost $1,100 a ton. You've got good volume picking up from auto demand picking up. CapEx expenses are low and going lower, at least for this year, because they front-loaded last year and the year before those expenses. So the cash flow generation is going to be tremendous. Their debt level is already so low. So what can they do other than just give it back to shareholders via share buybacks that they announced would be sizable? We'll see that when we get the fourth quarter earnings report in a few weeks.
All right, so Cleveland Cliffs is also a read on commodities. Brenda, I know you own a commodity fund. What's your take on commodities in general, the whole complex, especially with what we're seeing in China?
Yeah, so we maintain an overweight in commodities in our allocation back in 2022. This last year, we really spent a lot of time trimming back the commodities exposure because we felt like there was more opportunity in traditional stocks and bonds. So we're still about halfway. I think it's important to have a little bit of exposure, but when we think about where overall appreciation really lies, in our mind, it's much easier to get our heads around making a story for traditional stocks and bonds from here rather than the commodity complex, especially in an environment where China's growth is slow.
Moving over to Regeneron, RBC calling the company one of the most dynamic all-around stories in large-cap biotech. It also says there's more than meets the eye when it comes to this stock. Regeneron is trading at a new record high today. Joe, you own this one in the Joe T ETF.
Yeah, clearly that analyst report identifies all you need to know about this company fundamentally. It is a very well-diversified, large-cap biopharma with delivering on significant revenue growth. But this is a classic example of how momentum in markets actually does work. This is a name that has been in the ETF since January of 2022. The momentum is incredibly strong, even in an environment where healthcare was underperforming.
All right. Moving on, Citi is bullish on Qualcomm, upgrading the stock to buy and boosting its target to 160 from 110. Back over to you, Jim. You're in this one.
Yeah, well, let's admit there have been a lot of false dawns in terms of the mobile phone market bottoming and picking up. Hopefully what I'm about to say won't add to that series, but it does look like the mobile phone market has bottomed and is slowly going to pick up this year. Obviously, that helps Qualcomm, which provides chips into mobile phones, but also the automotive industry, which I mentioned before, is producing a lot of cars, restocking inventory. That's a key growth area for Qualcomm. And as the economy continues to expand, their Internet of Things business should be going well. Last thing on Qualcomm, besides the valuation, eventually AI applications are going to take place.
Okay, QCOM. We've been above the 9, for 2 months, and then we broke below it. We got the 9 crossing the 21, which is bearish. Very bearish. We got to hold the 9. If we do not hold the 9, yeah, we got 2 reasons to hold the 9. Let's see if this number held. 138.53. I wait. I'm not going to fall. I'm not going to fall for it. TSM had earnings. Let's go over the banks. Let's go over the earnings trades. Well, we broke out of my channel today. I'd rather buy this down at $100. Being we didn't break the 4th time up. I'm going to set an alert right here. Okay, I got my soup in. I'm about ready to get back to work. Have a couple chips with some salsa. And then I'm going to go over my watch list. So everybody on YouTube, tomorrow at 9 a.m. Eastern Time, Jimmy's going to do a watch list preview. I'm going to give you reasons why it's important to have a good watch list.
Now in oil is back to 72.50 as we speak. 75 and a quarter, I believe, was the high earlier today. The price action is just not correlating with what we're seeing surrounding the geopolitical tensions in the Middle East. It's somewhat discouraging as someone who is overweight energy. Quite candidly, I'm more excited and believe the better investment opportunity resides in natural gas. Certainly, as we heard about the deal yesterday with Chesapeake and Southwest. And you're seeing all these deals over the last 4 months, $130 billion worth of energy equity deals. So is it really translating, though, in terms of performance for the energy equities? I'm not necessarily sure that it is. And it seems as though these deals are happening because obviously companies are trying to utilize the cash that they have on their balance sheet that they're not reinvesting into the wellhead to actually go out and buy the production. So it's really, there's a lot of complexity right now going on in the energy space, and it's very difficult for those watching the show to try and make a decision based on what the spot price of oil is doing, because the spot price of oil is acting in a very erratic way.
Yeah, exactly. It seems like it would be higher with so much geopolitical tensions. I mean, military action. By the way, Jenny Harrington right here, just waving. Come over to me. Come over to me.
What's the matter?
I just want to educate everybody.
No,
Energy
nothing.
transfer,
I like
Kinder
talking
Morgan,
about energy.
Pioneer, Shell, some of your holdings.
Right.
Go ahead, go ahead.
So I actually don't think it's any mystery at all that they haven't performed, but you need to take a 3-year, almost 4-year now, look in the rearview mirror to understand why they're not. Because go back to 4 years ago, right? Energy actually traded negative. The stocks were completely in the dumps, right? Nobody believed we'd ever see $70 to $90 oil again. Share prices run up. So we had that plus 50% move in 2021, plus 60% in 2022. They had their move. You know, stocks have their move. And what they did during that time was they incorporated what $70 to $90 oil looked like. Like, yeah, it got a little higher for a while, but the reality is...
Well, here we go with that hypocritical thought. If she believed that, then she'd be looking at tech and saying we're way overpriced.
Supply demand is simple, right? And OPEC has lost its control over some amount of it. So, you know, the suppliers are just going to pump a little more. They're going to ignore that they want to keep it closer to 90. We find that around 70, that's where it starts. If it gets below 70, it starts to hurt. So you've got an actually very high functioning supply demand relationship keeping oil in that range. And in 70 to 90, that's where the free cash flow modeling, you know, to get to the prices that they're at today works. So as you guys know, I sold Chevron about this time last year at about $178 a share. Haven't looked back on that.
So I look back at OXY, and I look at the 10-year weekly, we're still way underpriced. Maybe that's why Buffett liked us so much. If it goes down to 42, I guarantee he gets out of this trade. XOM's definitely up there. I can agree with her on that one. And Shell. Shell's out of resistance also. This is when I called Shell off the 200. With the double bottom boom. The 50, the 50, the 50. I kind of like this girl though. She's got them wrinkles in her eyes. She's a thinker.
Right after this.
So let's say I want to do a little preview on watch list. This is my watch list. I want to go to the top 10. I want to look at NASDAQ percentage gainers. What darn, this thing's up. EFTR is up 2,515%. Trading halt status question quotation assumption news announced a 1-for-25 split on the 9th. Woo! That's why it's up, and it's up more than it should be. 25 times a buck. No, it ain't. So this is a pump. This is a stock that I would not trade. The only good thing about this is it lowers the float. It lowers the float and it gets the pumpers interested in the stock. So AUVI so they've got news. Announces launch of its Fighter FLEX LED solution opening up this is AUVI.
And we are back on halftime. Senior markets commentator Mike now with his midday word. Hey, Mike.
Hey, Frank. Yeah, so, this prolonged pause continues. We're sort of tantalizingly close to the S&P 500 all-time high. But it's tough to find too much fault after the sprint we had in late fourth quarter. So I'm looking at, the median stock is down a little on the year, even as the S&P has kind of more or less held in there. And I'm trying to find fault with what's happening. Maybe there's still some unfinished business. We have seen the small caps roll over against everything else. And I think the big story today is the increasing conviction that disinflation is fully in train, and we have some confidence around that. The bond market is getting pretty aggressive as it's rallying here, and is going to invite the Fed to have the Fed funds rate catch down to things like the 2-year note yield. So I think that's a little bit of the drama that we go into the weekend with.
What did you make of today's PPI report? We had Steve Leisman on earlier saying, it could lead to this, it could lead to that. Just very quick, what's your take?
I think in general, it checks off the box to say that wholesale inflation is going the right way, which feeds into the Fed's PCE measure of inflation. It's hard to get too alarmed about it. I think the burden of proof is on people who think inflation is going to stay high and sticky.
All right, Mike Santoli with his midday word. Mike, thank you very much. All right, coming up, to set up for more big earnings coming our way next week, we're going to hit one key semi-stock plus some transport names. Halftime will be right back after this break.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
This is where I have a real hard time with these guys. That meat. The meat. 3 years ago, I was paying $9 for that stuff. I went in there the other day. They had it for $22. $15.50, $18, $19, and I think it's the one in the back says $22. It's doubled in price. Last week I went in there, it was $11. The week later I go in there and it's at $20. I cannot understand how the store I'm in used to be cheap. I told the guy, I said, I'm going to go back to eating bologna, man. You guys are running me out of business. A steak, what used to be $12 is now $30 in 3 years. A premium, nice looking steak. They keep talking about inflation. I don't see, I don't know. My supplies are just enormously high right now. If I want to go out and buy me a nice sockeye salmon, it's going to cost me $33. And I used to eat salmon every week. Now I eat whatever's the cheapest I can find on the shelf. But I don't know. I should probably pay more. Not be such a... But if I did that, my grocery costs would go from... Just for eating one single guy, would go from $300 to probably $7 or $8.
Figure close to 30% as well. So it's a stock that I recently purchased personally while it is in the Joe T ETF, and I'm comfortable continuing to own it given the improvement in sentiment and the capital market environment.
I think we also got to talk about Taiwan Semi. I know nobody owns it. Jenny, you used to own it. But any thoughts about Taiwan Semi? So there's some macro issues, the Taiwanese elections, and also Taiwan Semi, one of the biggest foundry chip makers, a big read on the chip sector.
I know, it's such a hard one, and we were actually talking to a client this week on the phone who owns Alibaba, and so we own Taiwan Semi, way back I actually owned it in the dividend income strategy, then we owned it in the international strategy for years, sold it, the return was unbelievable when we eventually sold it, but it's one of those things that we reflect on now, and we're just so happy to not be invested in that region, because it is pretty scary, and it is uncomfortable, and for as phenomenal a company as that is, and their management board leadership is
Jimmy called the inverse head and shoulders.
To some degree, you just can't get away from the political risk there, so I don't want to be part of it.
Speaking of that political risk, Brenda, what's your thoughts on Taiwan Semi and also the possible impact to the broader tech sector?
Jimmy called the inverse head and shoulders. Tony called it. Linzoid, I did look at I was going to make me some hog jows and lima beans this weekend. I come real close to buying them hog jows. Anybody ever had a hog jows and beans? I've been wanting to cook them in my Instapot. Hog jows, beans, and cornbread. Magnificent. I did call the SPX to the 200 SMA, didn't I, Tony? Tony called the double bottom. But I didn't trade it. I was eating. Give Tony the award. He's called it out. But don't give him an A+. Okay, it's time for a song. I'm going to play a song that I used to sing with this guy.
I had a dog, his name was Jack Rabbit. you see Rabbit run, say give me Jack. Count to 10 and then bring him on back. He could run a death sprint through a hollow log. He was half blue heeler and a half hung dog. Well, I had a dog. His name was Jack Rabbit. Throw him a stick, throw him a bone. He'd jump right up and grab it. Run like the wind, jump like a deer. There you have it. Best damn dog a man ever had. His name was Jack Rabbit. My first boy we named Red Jimmy. He'd throw up a stick and say, Jump Jack, gimme. And that dog would grab it out of the air. He took first place in a county fair. Well, I had a dog. His name was Jack Rabbit. Throw him a stick, throw him a bone. He'd jump right up and grab it. Run like the wind, jump like a deer. There you have it. Best damn dog a man ever had. His name was Jack. Best damn dog a man ever had. His name was Jack. Best damn dog a man ever had. His name was Jack Rabbit.
Bingo. Man, that felt good. Woo! That felt real good. Oh. I can't tell you how good that
In a
feels.
little bit. Thanks very much. Today's economic data has investors squarely focused on the March Fed meeting. That is when they price in the central bank's first rate cut. They think it's coming. Steve Leisman has the details. Steve, welcome. You know, as I look at today's inflation number, I guess it's a little more encouraging than yesterday's, which another network characterized as, quote, skyrocketing inflation. I didn't see it that way. Did you?
No, it was a miss to the upside, but it was really interesting, Tyler, to see the way the market traded it. A little spooky at the very beginning yesterday after the 8:30 number, but then it kind of calmed down, and I wonder if it was sort of looking forward to this. Now, if you look at the story, the producer price index came in below expectations at minus 0.1%. Why all the focus on it? Well, it suggests little inflationary pressure up the supply chain. It prompts economists to estimate the Fed's preferred inflation indicator, the core PCE, will come in at 2.6 to 3% year over year. But wait, there's better news: 1.5 to 2% on a 3-month annualized basis. That is, it would hit the inflation's target. Before PPI, the probability of a March cut was 69, and shot up to 80%, where it's trading about now. Ian Shepperson from Pantheon says, actually answers Tyler's question, says, the PPI is far more important than yesterday's slightly disappointing core CPI numbers. Core PCE is what matters for the Fed, and these data will increase the pressure on policymakers to ease soon. The 2-year saw it, felt it. You saw yields decline by up to, what do you want to call it, 15 basis points at one point, now down about, I don't know, 13 or 14 from where it started before the number. There's still 2 PCE numbers, 2 CPI numbers, 2 PPI reports to come before the March meeting, and there should be, or could be, some upside risk to inflation if supply disruptions and higher energy prices and shipping costs linked to the conflict in the Middle East. But if current inflation numbers do continue, it's going to be hard, I think, Tyler, for the Fed to either not cut in March or at least guide in March towards a rate cut that would be coming in a future meeting.
What is the incentive for the Fed to cut in March if the economy's doing well, employment is fine, inflation is okay, but still maybe a little above the target range of 2%? What's the real incentive?
I think that's a good question. I think, Tyler, there is a window for the Fed to pivot and get this right rather than remain too restrictive for too long. I think you're right that there is some momentum to the economy that gives the Fed some time here. But there's a whole lot of loans out there and refinancings in corporate America that are going to be coming due, and companies are going to be laying off people, shutting down, otherwise having to sell if they have to refinance into the highest possible rates. The Fed has an opportunity to offer some relief to the economy. Think about it. If you consider that there's a long-run funds rate of 2.5 and the Fed is at 538 or 540, it is very restrictive right now. So there is room for the Fed to offer some relief and secure that soft landing, because that's not a given either.
All right, Steve, thank you very much. Have a great weekend. Appreciate it, my friend. Alrighty, our next guest says the Fed is unlikely to deliver the cuts the market is hoping for, but that doesn't mean there is not opportunity to be had. He's bullish on two sectors in particular. We'll get to them in a moment, both in the news today: energy and banks. Joining us now, Cole Smead, president at Smead Capital Management. Cole, welcome. Good to have you with us.
Good to see you, Tyler. Thank you.
You heard what Steve just said, and that is that there's a high, the market is pricing in a rather high probability of a rate cut in March. You say that the Fed looks unlikely to be able to cut the way the markets are hoping. I don't know whether that means throughout 2024 or just that March number. Why don't you explain your position and why you feel the way you do?
Yeah, it's a great question, Tyler. So to Steve's point, he was just mentioning, let's say refinancings are coming up, okay? Let's ask ourselves what kind of businesses would be impacted from those refinancings at higher rates, okay? So let's just use commercial office as an example. Are there commercial office buildings?
If we respect the 200 SMA here, we're going for a Boeing. We got a 1-up, 2 bits, and a freebie right here. I already had a triple top, 1, 2, 3, and it broke down. So it'll come up and retest that triple. And I'm going to put... Oh, what's going on here? What's this? 1, 2, 3, and... Count to 3 and trade with me. Yes. Count to 4 to make much more. Exactly. Exactly. $47.84.42. Now that we're above the 200, we can't lose respect. And Jimmy's looking at the calls again here. And did Microsoft pull back? Yep, she wants to do it. Tony? SPX Lotto 47.90 at 310. Should hear what this rookie's got to say.
Capital impact. I think the particular reason why is because the index doesn't. The benchmark hugging and the index world hasn't really fallen in love with it. Therefore, the active investors have not. So the fact that we can wake up in a world today where we can make, say, 20 to 25% return on equity in these businesses, pay very low PE multiples, and pay very low book multiples versus the market, which is making, in many cases, maybe somewhat higher return on equity, but far higher multiples for that return on equity. It's just a great place to be. And use the Houthi, your colleague was talking prior about the Houthi rebels this morning. You get a hedge on geopolitical risk that you just don't get in other parts of the market. And I think that's something that as we wake up to what is this new world we're in, where a major former power like Russia can go in and do direct conflict, not proxy wars, that's a different world than my childhood. And therefore, we have to think about that risk very differently. On the banking side...
Yeah, let's get to the banks, because I think it's interesting that you are... We're going to talk about the bigger banks in just a moment, but you highlight some of the more mid-sized regional banks. Why?
Yeah, because there's catastrophe that's taken place there. In other words, the idea that every regional
No, I did
bank
not.
had trouble
I was
is
looking
just
at
not
them.
True. Obviously, we know who already disappeared, and it doesn't mean that every regional bank is going to deal with the circumstances appropriately going forward. There, like I mentioned, there's going to be commercial buildings that are going to go empty, and
What did I
need a new
call
owner,
that?
and the bank's going to be holding that.
I can't remember
I think
what I
the
called it.
question, we looked a lot at the insider buying in the banks. That's what attracted us to some of the names you see there, like Fifth Third and M&T.
ETF something. I had to call
we
it an
also bought
ETF.
Western Alliance, which was really at the
Bitcoin
heart and
ETF.
center of that bank run back in the spring. And what we think they have is they have a history of producing great return on capital in a bank, and they're not a retail bank. It's a commercial bank. They're dealing with commercial customers, and so we admittedly come to people and say, listen, we're going to lose a third of the banks in the United States over the next decade. But what that produced in the past was higher returns, and this environment looks good for banks because they can just charge more for the risk that they get today versus in lower rates, they got paid less for risk.
We have to leave it there, Cole. I'll see you soon, my friend. Thank you.
Yep, see you soon. Thanks, Tyler.
Cole Smead. All right, big banks under pressure after some very, I guess they call it noisy earnings today. Most of them taking a hit on one-time charges related to special assessments from the FDIC and other areas following the collapse of Silicon Valley Bank and Signature Bank. Next guest says he still sees opportunities in financials this year. Joining us now, Chris Katowski, Senior Research Analyst at Oppenheimer. Chris, welcome. Good to have you with us. Why, of the four banks that reported today, Morgan, Citi, Bank of America, and Wells Fargo, why is Citi the only one that's higher, and it is the only one that reported a loss? The others all had profits. Explain.
Well, the Citi loss was driven primarily by some of those special items that you highlighted, the FDIC.
Who is this guy?
And then they also had some kind of.
Does he not know how to read a chart?
Russia and Argentina that they disclosed earlier in the day. Overall, I'd say the core fundamentals for all the banks that reported today for the fourth quarter were actually pretty close to what we were expecting, certainly. So I don't think there were any real.
Sometimes I get really annoyed with these people. They ain't no all-time high.
These four banks, with the exception of Citi, are all trading lower today. Not by a ton, but a little.
Yeah, I mean, I guess I'd say there was a range. I would say J.P. Morgan's guidance.
Citi had the worst numbers
for the year ahead was slightly better than previously expected. Wells Fargo's was slightly worse.
I gotta go watch my
If I
call.
look at Citi's guidance specifically, they had given very vague guidance about 24 previously. Previously, what they'd been telling people is that, the expense curve is going to bend late in 2024. But how much is it going to bend? From what baseline is it going to bend? And stuff like that was unanswered before. And, the guidance they gave for 24 today was kind of, our estimates are slightly above consensus. And the guidance they gave today was that, our revenue estimates were kind of at the low end of their range, and our expense estimates are kind of at the high end of the range. So, they're...
This guy got me upset. I could answer why. This is unusual candlestick move right here. It's not like everybody's piling in there to buy it. You got a few people in here pumping this stock right now. This is called a parabolic run. They're going to come in here and take profit. they're looking for any avenue to make the bank sound like it's a real good deal. And I more or less knew that this is going to be the worst quarter for the banks. The next three will be a lot better. So I could have answered that question. I mean, that's... you don't want to make me mad.
Pushing assets out of the banking system and over towards the alternatives. And, you know, we can debate all day whether that's right or wrong or good or bad. But what it has done is it's made the banks less risky. It's created a lot of opportunities for the alternative asset managers. And what's interesting is that last year, the average of the alternative asset managers, they were up by roughly 50%. And the banks were down 8 or 10% on average, you know, in a market that was generally up. So, you know, it's to, you know, what your prior guest, Cole, said, you know, you have to also be sensitive to valuation. That you know, these stocks are an extraordinary value relative to the market multiples. And again, they've been de-risked, but I will tell you, I think there are a lot of institutional investors that just don't want to hear about banks because they just don't. And that's kind of what creates the opportunity. But you know, there are so many times when I've gone into a meeting with institutional investors, and then you know, our salesperson comes to me beforehand and says, you know, here's their exposure to financials, and you look at it, and it's MasterCard and Visa and Schwab and Blackstone and, you know, companies like that. And the upshot of it is, oh, gee, they don't own any banks. And there are more and more accounts that have fallen into that category in the last couple of years.
We shall see what 2024 holds. Thank you so much
for your insights. Forgetting about my call.
Thank you.
Chris Katowski with Oppenheimer. And don't miss our exclusive interview with Bank of America CEO Brian Moynihan. That's at 2 p.m. Eastern today on Power Lunch. Coming up, from the Red Sea to Yemen and this weekend's presidential election in Taiwan, geopolitical events front and center for investors as we start the year. Up next, we will ask our panel of experts what those geopolitical items mean for the U.S. Plus, the long-awaited approval of spot Bitcoin ETFs. Finally here, Robinhood's chief brokerage officer will bring us new numbers on their popularity, with Robinhood shares coming off their best month on record, though down 5% today. The exchange is back after this.
Okay, I'm going to get stopped. If we don't hold the 21, I'm going to get out. Mara's back at the 200. I had a 1939, and I think Sue had the 50 SMA. Well, that could drop a lot more. And that's a good spot. That's a good spot. If it decides to pull back more. SPX, it got stopped out. They could stop right here too. That's a good spot right there. Let's see if it holds it. I'll get back in it here. Perfect. 4779.41. You see that, Tony? Dang it. That could have been a good add-on right there. I wasn't even thinking. FEMA.
Welcome back to the exchange, everybody. Geopolitics front and center today as Houthi forces vow to retaliate for last night's U.S.-led coalition strikes in Yemen. It's raising the risk of a broader conflict in the Middle East, but it's not the only geopolitical event investors are watching this weekend. Tomorrow's presidential election in Taiwan is another, and it could become a key test not just for relations in the region, but for U.S.-China relations as well. Here to discuss is former NATO Supreme Allied Commander Admiral James Stavridis and AEI Senior Fellow Derek Scissors. Let's begin with last night's strike, Admiral Stavridis, which sent oil prices higher by 3% overnight. This was something, by the way, that you, admirals, called for about a week ago in an op-ed. So tell us why this was the way to go now.
Look at, I'm going to show you the chart here.
Choices, right?
I should have saw this. I didn't see it.
Number one is just allow the Houthis.
The Houthis. So I didn't see this right here. This would have been a great support system, right? We pulled back there, resistance, support. So yeah, I should have held on to that. That was solid.
Reduce their capability. I think the administration is in the right page, even recognizing the chance that this could escalate further.
What do these strikes say to or about Iran?
First of all, they are a direct signal to Tehran. And by the way, it's not just the Houthis, it's all of the H's. It's Hamas, Hezbollah, and Houthis. They all have different agendas, different geographies. What they have in common, they're all creatures of Iran. So striking significant Houthi maritime infrastructure, it's proportional to these maritime attacks. It's well within the range of international law. It sends a signal to Iran that we're going to start at the low rung on this ladder of escalation. Pay attention. Let's hope Tehran is listening.
What if these attacks don't do the trick and the Houthis come back and keep misbehaving in the Red Sea? Then what is the next step up?
You can go up that ladder, still in Houthi land, if you will, in the country of Yemen, which they own about half of. They're in the middle of a civil war. They have land assets. Their tanks, armored personnel carriers, their fuel, their ammunition. We could go after the means by which they are fighting this civil war. If that doesn't work, which would be your next question, then I think you need to look at going after some Iranian assets. Boy, let's hope we don't get there, because down that path, a wider conflict exists. I think at this point, the Houthis will probably come back another couple of times. Then they'll probably stop. That's what happened last time we went through this cycle. In 2016, we struck Houthi targets ashore. They backed down. Let's hope we see that again.
Let's pivot, if we might, to Taiwan and the elections there this weekend. And
a lot of that word's been said a lot.
On what may happen there, if particularly, I guess I would say confrontational candidate William Lai is elected as president there. What does that portend, not just for Taiwan-China relations, but for U.S.-China relations?
Yeah, this is the right question. I mean, we're all absorbed with what's happening in the Middle East. In the end, those are pretty much likely to be tactical. This is the big geostrategic amphitheater, the arena, U.S. and China. I think that William Lai probably will be elected. He's a follow-on to Madam Tsai, the current president. Their policies are not exactly anti-China, but they are further away from China than either of the other two candidates. The thing to watch as investors is immediately after the election, if Lai is the candidate, how high, how hard does China go at Taiwan? They're not going to attack, of course, but are they going to put in a partial blockade? Are they going to open up additional maritime capability around Taiwan? Are they going to shoot missiles that just miss Taiwan?
Is the Red Sea international waters?
Taiwanese Strait. We're all going to be watching those reactions after Saturday.
That's interesting. So look for a variety, potentially, of provocative actions on the part of Beijing. Admiral, it's always good to see you. Thank you for joining us today.
You bet, Tyler.
Admiral James Stavridis. And as we're waiting for that election in Taiwan, we just got more data out of China on its economy. The country's annual exports dropped for the first time in 7 years, even as shipments in December beat expectations. China's consumer price index also declined, down 0.3%. Wouldn't we like to see that here? That was less than 0.5% the fall seen in November. For more here, let's turn to AEI's Derek Scissors. Mr. Scissors, welcome. Good to have you with us. How healthy is the Chinese economy based on what you see out of these numbers? First time exports have fallen in 7 years.
Yeah, it's not healthy. I want to start by saying there's no crisis here. People have been using the word crisis a little loosely as applied to 2023, and there's no crisis. But that doesn't mean the Chinese economy is healthy. You have disinflation, meaning that you have falling inflation to the point where people are starting to worry, well, are we going to get outright deflation? So far, that's only in the property sector, but if it spreads, that's harm to Chinese growth. A little bit of a nerdy statistic, narrow money M1 only rose 1.5% for the year, according to the People's Bank.
I'm going to go make some coffee. Tea. I think I'm going to have tea.
With that kind of narrow money growth. That suggests when China announced 5% GDP growth, it's an exaggeration. And on the trade side, I think the thing to look for is China's exports fell, but they still ran an $800 billion goods trade deficit.
Yeah.
They really can't push that. If they push that for the sake of their own growth, they're going to get foreign retaliation, and that is a risk for the market. They haven't done it yet, but $800 billion should be as high as they go. If they try to stimulate exports, I think the U.S. and other countries will respond.
Let's talk a little bit about whether there is stimulus in the pipe. You sort of hinted at it right there, that they can't push their export economy because of the risk of retaliation from the U.S. and others. But what about trying to stimulate the domestic economy in one way or another? Is that in the pipeline, and what form might that stimulation take?
Well, they have two, if they don't just target exports, and again, I don't think they will, they have two basic kinds of stimulus, fiscal and monetary. On the monetary side, they've tried. They've cut borrowing costs, and it just hasn't worked. Loan growth is slowing. It's still pretty fast. It's over 10%, but it's slowing. And as I said, narrow money M1 is very slow. So you'd have to try a sort of bigger monetary bazooka, which is something they haven't wanted to do because of debt worries. And on the fiscal side, China has never really had effective fiscal stimulus. People think that's what happened in 2008 and 2009, but it was actually monetary. So that would be sort of an experiment. I think you might get an experiment in fiscal stimulus, and there the challenge is, are you stimulating consumers, which is what you want, or are you just stimulating companies? Because that just means more production that nobody wants, more
production that nobody buys. Yeah, exactly. If you just stimulate the company, then they do what they do, which is make more, but if there's no buyers there, they're not going to make profit, I guess. Could we turn back to what we talked about with Admiral Stavridis there, and that is your perspective on these Taiwan elections over the weekend? What are you watching there?
Well, I just, this is maybe a little bit too optimistic on my side. This is the most likely outcome, as the Admiral said, is a continuation of the current government under the Democratic, the DPP. And China knows that. Xi Jinping has been, of course, in power for 11 years. We know there are going to be threats. We know there are going to be demonstrations of force. But we've kind of seen this movie before. And I don't think you're going to get an escalation by China because they've spent the past few weeks really emphasizing that there was a new understanding between Xi Jinping and President Biden in the San Francisco meetings.
Oh,
It would be
bullshit.
very odd if they took an expected political outcome in Taiwan and upset that new understanding they've been emphasizing by going beyond what they've done before. They're going to act. It's going to make people nervous, but it's not setting up right now for the Chinese to take a big step further and really scare markets and
Who is this
everyone in
punk?
the region.
And be excessively provocative. Derek, thank you so much for being with us. We appreciate it. Have a good weekend.
You too.
Derek Scissors with AEI. Coming up, NVIDIA trading at a record high and on pace for its best week since
The
March.
guy has a short memory span. What happened? We had, after the meeting, we had them spy balloons go over the country. That's a new understanding. I understand, yeah. Yeah, I really understand it, you dip. Could have made money on that trade. A little bit. But about that dip, added on to that dip. It was down 365. Or 265. I could have bought a couple more and made $100 out of 1,000. Less than 1,000. 900.
Welcome back to the exchange. I'm Kate Rogers with your CNBC News Update. Federal prosecutors will seek the death penalty against the white gunman who killed 10 black people in a racist shooting at a Buffalo supermarket in 2022. In a court filing today, the Justice Department said the
Off with his
shooter's
head.
intentional killing was enough justification to warrant the death penalty. The shooter was already sentenced to life in prison in a New York State court last year. NASA says 2023 was the warmest year on record. The Earth was about 2.5 degrees warmer last year than when record-keeping began.
And it's going to be
in the
20
late
below here
1900s.
Sunday.
Extreme temps also set off costly weather events for the year. As NASA's administrator says, it's the latest evidence the world is facing a climate crisis. And the canopy that hangs over the main altar is...
So it's going to be 20 below here, ma'am, Sunday. We had 40 below last year. Global warming.
Kate, thank you very much. Coming up, Robinhood benefited from last year's boom in Bitcoin prices, but will the approval of Bitcoin ETFs spark a similar rally? We'll get the latest trading data from Robinhood's chief brokerage officer next. And as we head back to break, here's a look at the worst performers in the S&P 500. United, American, Delta.
Some of you people probably weren't around back during the 60s. We were heading into an ice age. We were going to freeze to death. Everybody was going to die. And then they come up with global warming. because we had a couple warm summers, and now it's climate change. It's one of the biggest scams you could ever want to know, ever want to hear of. Should have got my tea glass. It's too hot. It smells good. Me member. I think this is German tea. I don't know if it's French or Kummel.
Welcome back to the exchange, everybody. Bitcoin ETFs had a big first day. More than $4.6 billion worth of trades were made yesterday across almost a dozen U.S. Bitcoin ETFs, marking a historical first day of trading. But SEC Chair Gary Gensler reminding investors
Dang, look at that.
today,
360.
be cautious.
Well, look, the Bitcoin itself, we did not approve, we do not endorse. This is a product called an exchange-traded product, a way that investors can invest in that underlying non-secure
Disclaimer right off the bat.
called Bitcoin. But yes, investors, I think, should be aware that the underlying asset is a highly speculative, volatile asset.
For more here, let's bring in Robinhood's Chief Brokerage Officer, Steve Quirk, along with our very own Kate Rooney. Kate, take it away.
Hey, Tyler, thanks so much. So, Steve, it's great to see you first. Thanks for being here. We appreciate your time today. I do want to start on Chair Gensler's comments you just heard about Bitcoin ETFs, and then Vanguard saying, look, these ETFs, they don't align with a balanced portfolio. They're just not going to allow it. Do you have any of those same fears around investor protection?
We don't, I mean, we always want to ensure that whatever we're offering our customers is suitable, but I think they've made it very clear that they think this, there's a segment of our customers that feel that this is an important technology and asset class that has a future, and as a result, they want it to be a portion of their portfolio, and they've expressed that. Yes.
Oh, sorry to cut you off, Steve. This is maybe more of a philosophical question, but do you think there's a time and a place for a brokerage firm to step in? Is it ever a point, or is there a role of a brokerage firm to come in and say at some point, hey, this might be too risky, we're just not going to allow it? Would you guys ever do that?
Well, I think if something is not suitable for a person, you know, we will make that determination, and they will make that determination. But I think our place largely is as a self-directed platform for investors is to provide them the choice to make the investment decisions that they choose to do, provided that they are suitable to them it's their money after all. So I think they have
It's their money after
the latitude to make those decisions, if assuming that it's a suitable investment.
And Steve, what is demand
my
look like
money.
so far? Can you share any of the statistics you're seeing around these ETF flows so far?
It's been really interesting and kind of exciting. And look, the approval of these is, I think, very beneficial for not only retail customers and traders, but also for the industry as a whole. If I could generalize what our customer base looks like, a third of the people are very passionate and very invested in crypto, whether directly or through ETFs. A third are curious and they continue.
Money and I need it now. It's my money and I need it now.
It's my money and I need it now.
It's my money and I need it now. It's my money and I need it now.
It's my money and I need it now.
In a very cost-efficient manner, which is exactly what they're looking for. And so from a behavioral standpoint, here's what we saw. A third of the people that participated in buying one of these 11 new ETFs actually sold some equity. So basically what they did is rebalance their portfolio. 20% of these purchases or
double
sales
bottom, baby.
happen in a retirement account.
BITO.
And I think that's quite interesting. And finally, the other thing that was quite interesting was GBTC, the grayscale one, was a net sell across Robinhood, both in retirement and self-directed. And what those people did was rolled into one of the other ones. And I believe that was just a direct result of just trying to be more cost efficient, because from an overall cost standpoint, the other 10 are probably much more cost efficient, and they have a better tracking record.
So, Steve, I want to come back to the word that you used several times in your answer to Kate's first couple of questions, and that was suitable. Whether this investment is suitable for your customer base, whether it is suitable for individuals. And clearly, you must believe that it is suitable for retirement accounts, because you said, I believe, that 20% of people's trades in these ETFs were in retirement accounts. So you see it as a suitable thing. My question is, how do you determine suitability? Who determines it? Do you?
The government.
Does the customer discern by sort of self-definitionally? Oh yeah, this
He's
is
over
suitable
there
for
very-
me. Hey, I'm great. I'm good, man. Let me add it. How does suitability
His answer would be the
work
government.
in the real world?
Suitability, well, I mean, obviously suitability amongst different asset classes is different. You know, like suitability among equities, options, crypto is very different. But in the case of crypto, the suitability there is determined by the user. So they determine whether this investment is something that they have the confidence in making part of their portfolio, whether that's in self-directed or in a retirement account.
So it's basically a self-test.
Exactly.
That ain't suitable.
All right, Steve, thank you very much. Appreciate
That's
it.
not
Kate Rooney,
suitable.
Thank you as well for bringing
That's
Steve
risky.
to us. We appreciate it. Coming up, NVIDIA up 12% this week. Just another week for NVIDIA. Shrugging off China concerns, so could the stock and the rest of mega cap tech deliver another big year? That's the topic of today's Tech Check when we return in 2.
So YouTubers, yesterday I talked about, this week's about watch list. Tomorrow I'm going to have a seminar about watch list. Yesterday this was an example of how to create a watch list. You had the ETF Bitcoins come out, and so these are a list of them ETFs. I have a 3-day rule. 3-day rule. When something like this comes out, I usually let things consolidate for 3 days, and then I'll take a real good look at them. If I think we're going to start to reverse to the upside after the 3rd day, it's like an earnings play or any big knife. But this is on news. Sell into the news. So these are just pulling back. It's called sell into the news. So come Monday or Tuesday, Martin Luther King's Monday. So we're going to have Monday off. Tuesday, I might be very interested in starting to load these things up. Anything could happen over the weekend. The war could escalate or something like that, so I don't want to take a big chance, but come Tuesday, we'll see what happens. Even if we hit the 50 SMA, I'd probably take it, or we hit the bottom of this here Darvis box. So I'm going to set an little alert right on the bottom of this Darvis box for BITO. And that'll be day number 2. Then 3 comes into Tuesday. That's how I'm going to trade this trade. And the option go a few months, I don't know about a few months out. February 16, I'd get in the money at $20. And I'd buy 5 of them. I want to just put $1,000 in it. So I'll buy 5. And I'm going to be watching this in here. If it accidentally knifes on me and I get maybe a sale today, I might just go ahead and jump in them right now. But I want to trade it in the money February 16th, 2024. And that'll be 6 days before the Pacquiao Mayweather fight. So I have enough money to cash them in and go watch the fight. If that is if Mayweather don't chicken out. Because he chickened out on me. I had a fight lined up last year, 2022. Mayweather didn't show up. I think he knew he was going to get his butt kicked. That was last year, year before last. Oh, there's my girl.
NVIDIA, other chip names, Marvell and Broadcom, getting some buzz out of CES and helping push up the semi-space. Software, too, settling into that new normal that we talked about earlier this week. And new opportunities emerging. The IGV software ETF up nearly 6% since Monday.
What's this?
And the
IGV?
deal chatter that continues to roll in. This week alone, we had HPE and Juniper. That was an unexpected deal. And there's now reports of private equity looking into PagerDuty and DocuSign. Now, of course, upcoming earnings, we've got to mention those. That could derail all of this optimism.
Trading a watch list, there you go right there. You'd have a nice little watch list for runners that are in the semiconductor or whatever it is.
Look at some of these early gains that I just outlined. One name that I will end on, guys, Apple, after perhaps the roughest start to the year of all the mega caps. It also got some buzz this week. Goldman actually naming it a top pick into earnings.
Oh, God. After another downgrade?
Tech Check Weekly. Tyler?
All right, Deirdre, thank you very much. Have a good weekend. Coming up, our next guest calls it one of the most transformational moments in time. She's talking about AI and its impact on commercial real estate. This is one of the names she sees positioned for big gains in that area, and she has 2 more. We'll give them to you next.
No, we're not trading Mira yet. We got to wait, Florence. I want you to pull up Mira on the we're still selling into the news. So our target is the 50 SMA. My support was right here. It has to hold 1939. And so far we've held it. 1939. But we got a real serious weekend coming up here, and we might get we got the Taiwan election coming, and then we've got what happened in Yemen, if they're going to attack us back on Yemen. We got to hear what Iran has to say about it, if they say anything, because they're all linked, the Triple H, to Iran. So I wouldn't want to add anything until Tuesday, when the market opens up. It'd be too risky. Too much on the table right now. I'll send you the chart and show you this 50 SMA. Here, I'm going to clean this up. I said 1939. So we're looking around 1670 for a strong buy. My first one was 1939. I don't want to get away from that, because if you look at 1939, it brings you right to the top. That's what I called that peak when we were up here. You have an expansion pattern, and we only have 2 hits on the expansion pattern. Well, thought it was. It kind of is if you sell.
Possible.
Welcome
I was
back to
looking at the
Exchange, everybody.
red.
There are about 2,500 data centers in the U.S. powering the internet and enabling digital communication right now. But with the rise of AI, that number is expected to grow significantly, and there's a way to trade it. Digital Realty and Equinix, I hope I'm saying that right, are the 2 biggest players in the space right now. But our next guest, who is going to be able to tell me whether I was right, says others in commercial real estate are poised to benefit, and she's here to tell us which ones. Let's bring in Laurel Durkee, head of global listed real assets at Morgan Stanley Investment Management. Laurel, welcome. Good to have you with us. In all of commercial real estate, all of it, is this the place to be? Data centers?
This is absolutely the place to be. When you think about the trends that are unfolding within artificial intelligence and the impact that's going to have on demand for data centers, the growth is going to be more robust than anything we have seen over the past 2 decades.
So how much, quantify that for me, how much growth are we going to see? If we're at X now, we're going to be at X times by when?
Over the next 5 years, I think you're going to begin to see what I will call a transformational moment for data center demand. This is ultimately going to require billions and billions of dollars of new capital investment into the space that will transform the market and really grow the cash flows of these companies in a way that we haven't seen before.
So, and this is being driven by AI. So who are the big players in this area, and which ones do you favor?
So a pure play data center company that really is in the bull's eye of artificial intelligence development for data centers is Digital Realty, ticker DLR. Digital has grown significantly over the past 20 years. They IPO'd back in 2004, and since their IPO, they have grown at about an 18 to 20% CAGR.
Whoa.
That is significantly in excess of other REITs and even in excess of the broader S&P. So this is a company that now, at a moment in time, has a refreshed management team, new CEO, new CFO. They have new chairman of the board. They have new joint venture relationships that they have been able to raise additional capital to develop these data centers.
Is this kind of all they do? Digital data centers. This is a pure play.
This is pure play.
It's a pure play.
And they have the bullseye of hyperscale demand, which is exactly the type of data center that the artificial intelligence servers need to be in.
You just told me something fascinating while we were on the break. And I guess the broader question is, are there constraints to growth? And you pointed to one, and that is that in Northern Virginia, my old stomping grounds, the largest cluster of data centers in the country, Dominion Electric, the company that supplies power there, said, we don't have enough power so you can't build any more data centers.
That's right. So what you're seeing is that demand is growing at a significantly robust clip, yet new supply is challenged right now, and those challenges are stemming from this power availability issue, which is why the underlying need for infrastructure and transmission of power is so important when thinking about really delivering upon these AI goals.
How do you measure scale in these facilities? Is it by the number of gigawatts, or is it by square footage?
No,
what is
it really is about megawatts and gigawatts, right? Megawatts.
And megas and gigas,
what you've seen happen over the past, call it 10 to 20 years, is the power densities that is required in these data centers is increasing significantly. And so the megawatts that you need in a data center, significantly more than they had been historically. Just this year, or last year, in 2023, we saw one of the first 200 megawatt deployments for a data center. The largest data centers used to be 20, 30 megawatts. Now we're talking about 200 to 500 megawatt data centers.
That's crazy.
This power availability challenge is absolutely going to be an issue that we need to address and solve going forward.
You mentioned Digital Realty as the pure play here. Are there other players that are on your radar screen?
There are. Another one that is very interesting that I'm sure you are aware of and all the viewers here are aware of is Iron Mountain.
Oh, yes. I think of them as a paper company.
Yes,
paper
exactly. Record management is what I like to say.
Yeah.
But what they have done is evolve their business and really capitalize on their core competencies to get into digital storage, to get into data centers. And so right now, Iron Mountain has about, call it 10% of their revenues that are tied to data centers, and it is growing. And the most interesting part about that is that they trade at about a 6 to 7 turn multiple discount versus that of a pure data center company.
That was a big pop off her mouth right there.
Back, Laurel Durkee. Thank you so much.
Thank you.
And that does it for the exchange. Coming up on Power Lunch, an exclusive interview with Bank of America CEO Brian Moynihan. That's ahead on the other side.
Three-eyed soldiers.
And quirky break.
CNBC pump, no volume, all day. Hardly any volume at all on this thing. Let's see what it does for a year. Yeah, it's got volume. Not much, but it has it. What is the average volume? I've got a chart in here that says it somewhere. Or did I take it down? It might have been that one that kept shooting out alerts. I think I took it down. IRM. That's some good tea. I like that tea. That's real good stuff. I have to get me a bunch of it. $1.5 million. 3-month average volume. Elevate the power of your work. We solve customers' real business challenges.
Welcome to Power Lunch, everybody. Alongside Dom Chu, I'm Tyler Matheson. Welcome, Dom. Good to have you here. Let's take a look at the Dow. It is down at this hour, as you see, by 100 points or thereabouts. The S&P 500 and the NASDAQ with modest rallies. And check out the moves in the bond market.
Paper shredder?
This morning's inflation
Are you
numbers
kidding me?
less than expected. The opposite of what we heard yesterday, though mildly opposite, from the CPI.
But Ty, inflation and the Fed are not the only things affecting the markets right now. We have to go to the earnings story to worry about some of those issues. United Health accounting for nearly the Dow's entire losses on concerns medical costs are higher than analysts had previously projected. Several of the big banks also reporting. JP Morgan Chase slightly lower, you can see here. Now it's actually swung to a gain, 0.25% higher. The rise in net interest income could be starting to slow down a bit there. Citigroup was also down right now, though now up 2%. 20,000 jobs are being cut there as part of its restructuring plan. And Bank of America is actually down today, truly down, 2/3%. And by the way, CEO Brian Moynihan is about to join us with more on those results.
You get ready for the bank to pop.
On this hour, Ty.
All right,
Bank of
Don,
America.
let's start with the markets. Our next guest is sticking with a new year, new bull market stance and says the biggest risk is a turn higher in inflation next year. Joining us to talk markets, the Fed, inflation, and earnings, Hugh Johnson, Chairman and Chief Economist with Hugh Johnson Economics. And joining us throughout the hour, happy to say, is CNBC contributor Courtney Garcia, Senior Wealth Advisor with Payne Capital Management. Courtney, good to have you with us in studio. Good to see you here on this side of the Hudson for a change.
Yes.
At NASDAQ. Hugh Johnson, welcome. Good to see you. Happy New Year.
Thank you. Happy New Year to you, Tyler.
You keep doing this, Hugh. You keep doing this year after year after year. I keep trying to catch you. I can't. So, you think a new bull market began back in October, and you think it's got legs?
Oh, yeah. It definitely is. Bull markets go, you know, if you look all the way back to 1890, you've got the average bull market being 47 months. And if you look back to the post-war period, post-World War II, you've got essentially 63 months. So we're at the, let's call it the 2-month mark, maybe 3-month mark. And when you've got markets bull markets that last that long, on average, this one's got a lot longer to go.
What was the demarcation point that you think set this bull market off and running?
Well, it's a number of things, Tyler. I think the number one thing is the performance of the financial markets generally, not only the decline in interest rates, but the most important thing is the performance of different sectors of the market. You saw the so-called bull market sectors like consumer discretionary, industrials, and technology stocks doing well. And I think the real tip-off, at least for me, was that for a long time, small capitalization stocks were lagging large capitalization stocks, and that all changed. And that changed in October. And I think that's the signal that a new bull market has really begun. There's a lot of other things that tell you that basically when you look at cycles all the way back to 1890, it's starting to shape up as being a very somewhat normal cycle.
Hugh, it's Dom. One of the big things that we talk about, speaking of that cyclical.
Here's that pump. It's got $500 million, 400 million in volume. So when I used to trade pennies, that volume, that's a lot of volume. That's on after a split. No, it ain't. I don't think this was, no, this wasn't the one that split. This had no news. I mean, if it pulled right back to this channel, and if I wasn't looking at that other stuff, you got a flag. So this are probably right in there. Why I say right there? Because that's where you have the most consistency of the candles. 23.89. Oh, didn't do it. So let's see if we got down there. It went below. It hit that bottom part right there. So that's about right. Double top. Boom. Then we had to pull back right here. So it found support. Then it found resistance. And then it broke out. See how you got the higher lows right here? So it was kind of telling you that it was getting ready to break out. You got inverse head and shoulders. Left shoulder, right shoulder. These guys are bullish. All of them are.
I think, yes, interest rates are going to be coming down. The Federal Reserve is going to be reducing interest rates, although quite clearly the markets are over-expecting when we start talking about 6 interest rate reductions by the Fed. That's not in the cards. I think it's going to be 3 in 2024, maybe 5 in 2004, cuts in 2025. That's one thing. The second thing is interest rates will be coming down. This is all what Courtney said, and I think that the yield on a 10-year treasury will come down from the 4% level to the 3.5% level. I think and inflation is going to be coming down steadily throughout the year. The big risk, in my judgment, is as we get to the second half of 2024, I think people will start to see, including the Fed, that there's a real chance that interest rates or inflation and interest rates could turn higher in 2025. The consensus now is clearly that inflation and interest rates are going to continue down through 24 and 25. I think that's wide of the mark. I think we're going to see somewhat higher inflation, somewhat of a turn in Federal Reserve policy in 2025. In other words, they won't cut by 4 times in 2025. You'll probably only see 2 cuts in 2025. It's going to take a little bit of the edge off of the new bull market. It's not going to end it. It's not going to derail it. It's just going to take a little bit of the edge off the new bull market.
And Courtney, we're going to give you the last word here on this topic. The volatility picture in the stock market, it's been trending near-term downside, but it hasn't been horrific. And volatility generally still remains low. Is this a setup for more elevated levels of volatility throughout the course of the year?
I don't think necessarily. I think, especially when you look at last year, we had such a concentrated market, and I think that's really why you're seeing the volatility hasn't been so strong. I don't think that's a good or a bad thing for the markets. I think everybody kept waiting for the VIX levels to get to a certain point to call this an end to, markets going down previously. I don't think that's necessarily something we need to focus on. I think it's the broader picture here. And for example, when you look at the S&P 500, there's over 150 companies in there that are trading below 15 times earnings, and generally things are still attractive and still cheap when you're looking at a diversified portfolio.
All right, Courtney, thank you very much. You'll be back joining us again later this hour. Glad to say that. And Hugh Johnson, always good to see you, my friend. Appreciate it.
All right, let's turn now to oil, which is bouncing back above the $75 mark today. It did hit that point at one point. The U.S. and the UK carried out military strikes against Houthi targets in Yemen. Those Houthis have been attacking vessels in the Red Sea, now targeting both U.S. and Israeli ships as well as others. Let's bring in Pippa Stevens for more on the impact on the oil markets. One, you could argue, Pippa, has been a direct, at least perhaps, view having taken shape because of what's happening in the Middle East.
Yeah, that's right, Diamond. We did see Brent crude briefly topping $80 per barrel earlier in the trading day after those U.S. and U.K. strikes against Houthi targets in Yemen. Now, the oil market is on edge as traders evaluate what an escalation could mean for supply, which so far has not been disrupted. And RBC notes the key wild card is Iran, adding the country seemingly fired a warning shot about its willingness to come off the sidelines when it seized an oil tanker yesterday in the Gulf of Oman. But in the Red Sea itself, attacks have so far largely avoided oil tankers, and that means crude vessels are still transiting the waterway. Kepler's Matt Smith telling me we have seen a slight decrease in volumes going through the Red Sea, but that's not thanks to diversions. Rather, it's European refiners importing less from the Middle East because they're hesitant to take on any risk. Instead, they're looking elsewhere, including to the U.S., with U.S. crude exports to Europe now at a record, but you can see really off the highs of the day from earlier today.
Yeah, $75.25 the high for U.S. benchmark WTI. Pippa, I'd like to turn to another supply issue right now. The world's biggest uranium miner is warning of a shortfall over the next couple of years. What can you tell us about that mineral and that supply?
So uranium stocks are surging on that warning from Kazatomprom, which is the world's largest miner. The Kazakhstan state-owned company has long-term contracts that they need to deliver on. And so if their production falls short, which they warned about, they'll have to turn to the spot market where supply is already really tight. Spot uranium prices surged above $100 yesterday, hitting a 16-year high amid this global, resurgence in nuclear power. And there's also growing calls to sanction Russian uranium, with the House passing a bill to ban imports back in December. So that could create an even tighter market. And right now we're seeing this ETF up about 7%. Tyler, Dom?
All right, Pippa Stevens with the latest there. Thank you very much. Coming up on the show, a power player. Bank of America's shares in the red, although off the lows of the day following its results. Our own Becky Quick is sitting down with CEO Brian Moynihan coming up next. Keep it right here. We'll be right back.
I love you, Becky. I love you. If anybody out there on YouTube's wanting to trade AMC, I beg you not to. Unless you want to get involved in a pump. I'm going to do part 3 tonight. And watch this video here and you'll learn something new. Did you see that? Yeah, I already put that in there. Let me try something here. I'm just going to see. If we get down here and we touch this trend line, I might think about it. But I think this is going to drop a lot more unless the Reddick bunch gets involved in it, or some kind of pump station. Or it has to have some kind of news about the share structure. And then if it has another split, I'll be shorting it again. Zach Morris made a ton of money on this by shorting it. That was years ago. That's how crappy this stock is.
We call this segment More Time with Courtney. Welcome back. Courtney.
This is the best segment on here.
It's the best segment ever.
That's awesome. Yeah.
We were talking in the last hour about the idea that an awful lot of last year's gains in the market came from an expansion of PE, the valuation quotient of return. Is that likely to be repeated this year? And second, is what we've seen here to start the year, as the market has kind of retracted a little bit, is that not collapsing, but a deflating a little bit of valuation?
No, because I think where most of that PE expanded,
here's a nice looking snake.
Concentrated the markets to just really your big tech firms, right? A lot of the other areas are actually still undervalued. Like take energy, for example, trades at like 11 times forward earnings. Yeah, by far the cheapest out there right now. And I think there's a lot of opportunities that investors can look at where you don't have these largely stretched valuations. So I do think investors should still own your Apples and your Googles, your Microsofts and your NVIDIAs. But I think there's a lot of other areas that are cheaper valuations that you can consistently add money to, maybe even take profits and be rotating out into those.
You know what's interesting though, Ty, about that, if you look at the way that it moved in terms of the market in the last half of the year.
Bronson.
A lot of that
There's
multiple
SPWR.
expansion
Just to
about
trade
was
that
because
one.
of these lower interest rates, as people either saw interest rates go lower or had the expectation that the Fed would
Golly.
cut as soon as March.
Unbelievable.
That played into the multiple discussion, which is why you could justify higher multiples. What if that gets
Sun
derailed?
Power.
Is there actual multiple contraction this year if interest rates don't play along? Or is there something that has multiples moving independent of what that narrative around interest rates will be?
I actually
FSLR.
wonder though if that was as much of a play into some of the multiple expansion as all of the speculation with artificial intelligence and what that's going to lead to in future earnings. And that is where I think some of that's going to come in. I think you're already starting to see that where suddenly everyone is so excited about what this is going to do to productivity in the future, and I think there's something to that. But now this year they're saying, okay, how much is that actually going to affect earnings here in the short term? I think that was actually a bigger effect to a lot of the earnings multiples than interest rates coming down, which I don't think has been fully realized yet. And I think that's what we're going to start to see here.
You mentioned banks being really remarkably cheap at this point.
Blink.
Let's talk a little bit about that and whether you see that as a sector that is
FSR.
highly investable, moderately investable. And of course, we're going to have Brian Moynihan on here in just a moment. So if you've got any thoughts on Bank of America.
God. Okay, now FSR is at a very
I think it's
important
fascinating
spot.
to hear what he has to say. And I think especially what they're saying on the
Okay, this is how I look at FSR. Now, I know that the company's in real bad shape financially. I know that the CEO is a nut. I think 4 or 5 years ago, I talked a guy out of wanting to buy this thing. When we were up here around 20 bucks. He thought this thing was going to fly, and I said, don't even think about it. Don't even think about it. But that was when it was at 20. 19, 17, 18, 19, 20 bucks. He was wanting to go long because all these other stocks were going long. You had a Nile went from $2 to 65 bucks. At the same time. So you had a big run on these stocks. And they've all kind of simmered out because of the... You heard about Hertz. And that's not the only story. That people don't want to... I mean, I want to get in a car. And I want to drive to Memphis. Or I want to be in that car 8 hours. 10 hours maybe. To get to my destination so I can get the next race. At Southland, Arkansas, going to Southland. That's a dog track. I used to go there every summer. Now, I used to live in West Memphis. Anybody know anything about West Memphis? It's one of the toughest cities in the country. And I'd go over there and play dogs. It's outskirts of Memphis, Tennessee. On the other side of the Mississippi, where the mosquitoes will eat you alive. And I can do that trip in 5 hours. I don't want to have to sit there and try to find a place to plug this stupid car up. Because I know the hotel ain't going to have a charging station. And that's where they need to be. They need to be in hotels. Hotel parking lot. Or they need to be here in my apartment. There's hardly any charging stations at all in Springfield, Missouri. So it's a real bad. I mean, it's being forced upon us, and it's not. The car industry is the big thing. Used to be the biggest thing. Market, okay. As long as they're selling cars, everything's good in the economy. But it ain't like that anymore. They don't mention that anymore because they're destroying the car industry. For me to have an electric car, I'd have to go out and buy a house. And I don't want to buy a house right now. I just sold my house. I gave my other house to my girlfriend. My ex-girlfriend. So if I want a car, I want to get up and go and not have to worry about charging that stupid thing up. That's why these things are dropping like that. I won't invest in them until maybe Nile gets back to $2. XP was one that I really liked back during when the market was running good. Had a nice little run on XP from 18 to 74 in a month. Then we double topped and now we've come back down. So I still like this company, but maybe if I get down here to $7, $7.28, make it $7.50. At the mark at below. But after winter's over,
in Chicago. Hi, Rick.
I think it's a seasonal trade coming up. When spring comes in, we'll see if these things start to run again.
There were some pops, especially core year over year, but investors looked right over it, and they continued to monitor a couple of the big moves that we saw, especially that headline number on PPI. And the moves, well, let's let the pictures speak for themselves. Here's a 2-day of 2-year, Tyler, and look at what the high yield was intraday yesterday. 439. We're trading 415. Where did we close last Friday? 438. Huge moves. Now contrast that with the long end of the yield curve. Look at a 2-day of 30s. Right now, 30s are higher in yield than yesterday. They're up a couple of basis points, and they're virtually unchanged on the week, which of course leads to the notion, what have the yield curves done? I'll tell you what they've done. What traders have told me since early December, that 2024, we've said this many times, is the year the yield curve steepens and probably moves dramatically in positive territory. Let's look at that 2s to 10s curve, shall we? It's hovering around minus 19 basis points. It hasn't been at this level since Halloween. That's how big of a move we've had. And as you look at that chart, let's go back a year and a half on 2s to 10s, because we are very close to levels we haven't seen since July of 2022. What does that mean? What's the translation? Why is that important? I'll tell you why. Because the market is gravitating towards easing. The Fed's going to ease, and they're going to do it rather aggressively. PPI helped fuel that. So short maturities are going down. And even though longer maturities haven't been immune to some of the pressures pushing yields down, for the most part, traders don't play these naked positions. They play the spreads. And the reason they're playing the steepening spread is because, unlike history,
I trade naked.
they think that we could see a slowing in the U.S. economy, and that slowing is still going to be followed by a debt level to service that's going to keep global longer-term interest rates higher than many anticipate. Back to you.
All right, Rick, thank you very much. And several of the big banks reporting mixed fourth quarter results this morning, including Bank of America. Shares of BAC trading a little bit lower after the nation's second largest bank reported a lower profit because of a regulatory charge. Let's send it over now to Becky Quick, who has an exclusive interview with Bank of America's CEO. Hi, Becky.
Hey, Ty. Thank you very much. Want to welcome Brian Moynihan, who is the chairman and CEO of Bank of America. Brian, big day for the banks. We've heard from a lot of reports, and there have been a little bit of confusion as people try to look through these numbers, because there are some big charges that have gotten handed out to every one of the banks, FDI assessments and other things that have been included. On the earnings per share, you came in at 70 cents. That was above expectations, but it was down from last year. But why don't we dig beneath some of these charges and try and really get at what's happening with the bank? Why don't we walk through segment by segment? Maybe we could start with sales and trading, because revenue there was up by about 3%. What's happening?
3? That's
It's
it?
good to be here, and we'll see you next week over in Switzerland. But if you look at sales and trading, Jim and the team have done a good job. For the year, 23 versus 22, up 7%. This quarter,
7. That's still bad.
We were down a little bit in fixed income this quarter, but year over year, it's up 11%. So things ebb and flow. They've made money every trading day. They've done a great job. They've gained market share. The equities business came up stronger in the fourth quarter, but year over year is relatively flat.
I don't think anybody in here has made a trade under 7% in here.
Grew in that area. And then importantly, our investment banking fees, it seems, performed better than some of our peers. And Matthew Coder and team have done a good job there of running the whole commercial bank, the global corporate investment bank business, and also helping on the investment banking side. So we feel good about our markets-based businesses.
In terms of consumer banking, revenue there was down by about 4%. What was the pressure? I think part of this may have been having to pay up to keep some of those consumer deposits.
Yeah, largely when you look at the company overall, last year's fourth quarter of 22 was a high net interest income, and like all the companies, it's come down as rates paid to consumers have gone up, and the Fed has quit raising rates. And so if you look at that, that affects consumers most of all, because they got 900, the consumer segment, they have $950 billion of deposits, of which they pay 40, 50 basis points for them. It's a great business. The deposit base in that business is stabilized. Credit card loans were up. The rest of the loans are relatively flat. Credit costs went up and affect them a bit just because we're building reserves for the credit card growth. But the team's done a great job there. And importantly, 600,000 net new checking accounts, billions of $40-some billion of flows into the Merrill Edge side for the investment side of that business. And we feel very good. And they've opened 50 new branches last year and basically finished our remodeling of all the branches. So they're absorbing all expense, and expenses are relatively flat year over year.
In terms of net interest income, down 5%. You mentioned the reasons why, just higher deposit costs offsetting those higher asset yields. $13.9 billion was the number that came in. What are you anticipating as rates potentially will come down? Federal Reserve may lower rates. What are you anticipating in net interest income for the current quarter and the rest of the year?
Yeah, so for fourth quarter last year, it was $14.1 billion, and then what happens is fourth quarter of 23 to first quarter of 24, you have one less day, and for this, believe it or not, that's like $100 to $150 million. So we're saying next year it'll be $13.9 to $14 billion, which is consistent with what we said last earnings call. And the interesting thing about that is since the earnings call in October till now, you've had the rate cuts in the market go from 3 to 6, and so that's a major change in interest rates for 2024, and we still think we have the same trajectory. We come down a little bit in the first quarter, we bounce around a little bit down in the second quarter, and we start to grow out from there. And that stability is really the power of the deposit franchise starting to actually grow. We actually grew deposits quarter to quarter, the third to fourth, and it's very stable. There's just some seasonality in that, but we feel very good about that. And that's all advantage funding, which helps us grow the NII. But it's just a matter of basically getting loans to grow, getting deposits to grow, but also just taking the effects of the squeeze from the Fed. Fed quit raising rates, and the deposit pricing gaining for those deposits are more rate sensitive.
Brian, that's a lot riding on the idea that the Fed will actually start cutting rates in the first half of the year, and that's certainly what the market seems to think right now, but there are issues that could complicate that. Part of that is what we saw with CPI earlier this week. Obviously, PPI today showed that producer prices were down, but CPI was a little hotter and more stubborn than had been anticipated. And there are some headwinds out there, things like higher transportation costs. When you look at what's happening in the Red Sea, you saw oil prices up 4.5%, maybe better than that today on some of those concerns, too. If that starts to trickle back through into the inflationary costs, and the Fed does not actually lower rates sooner, what does that mean?
From our company's perspective, that actually helps a little bit because the vast amount of short floating rate instruments we have on the asset side and the cash, the $500 billion, almost $600 billion of cash we have that we put with the Fed overnight in very short treasuries. But let's back up and talk about what we see in the consumer maybe and how we think that the market moved heavily. Really, the Fed just stopped. They've said they stopped. Everybody said they stopped, and then they started putting cuts in. And the market has, as I said, 6 cuts in, and the Fed dot plots have 3 cuts. Our team has 4 cuts. Candace Browning-Platt's team. So if you mix that all together, at the end of the day, rates not coming down actually help us. But the reality is that everything's setting up for them to be able to normalize the rate environment, given that you're seeing consumer spending, which for the first part of 22 to 23 was up like double digits. It's now down to 4 or 5% growth. In the first part of 24, it's about the same. And when you think about that, we've been watching that for years and years and years. And as you look at that, that is more consistent with a lower growth, low inflation economy. If you think about the consumer-driven economy in the U.S. in terms of the amount of impact they have, if they're slowing down their purchases, that's not inflationary. Now, we have to get through the housing rollover and the inflation statistics. You have the issues you're talking about. If gas prices kick up, the consumer feels that. The consumer's expectations have stayed in line. So I think there's still some tenuous ground here where we've got to make sure we get a short footing. But I think the consensus view, what we see in our customers, what we hear from our commercial customers is they are basically planning for a soft landing, which is still a major step down in growth from the third quarter of 23 to the first quarter of 24. You're going to see growth from 4% plus to about 1%. That's a major downdraft in growth. And so the Fed at some point has to be careful it doesn't go below that. And these external factors could hasten them to do more faster, i.e. cuts, or cause them to hold on a little bit longer to make sure the inflation doesn't kick back in.
Brian, Bank of America's stock was up, I think, 1.7% for 2023 versus a gain of about 10% for the financial sector overall. You all have been facing some headwinds, and a big part of that is that low-yielding, long-dated securities that you really loaded up on during the COVID pandemic. What can you say about where that stands? I think the paper losses at this point on those securities are something like $98 billion versus $132 billion that you've been looking at before. You've been talking about how it doesn't matter, you're not going to take these losses, you just let it write off. But when do those things actually write off, and when does it give you more freedom to do other things with that money?
So why do we have to invest is that we have $1 trillion of loans, $1.05 trillion, and we have $1.9 trillion of deposits and other cash and other sources. We have more than $2 trillion. So we have $1.2 trillion we have to put to work every day. Less than half of that is in the held-to-maturity portfolio, and it has run down $80–90 billion from the high and just keeps running off. And that was the plan. We haven't made investments since 2021. But back then, when rates were predicted, we had to start to extract value. And so that just keeps converting. $8 or $9 billion last quarter will continue to be that, and will continue to be converted over. Now, meanwhile, as deposits grow, we're building up more and more cash, and we're just putting it short term as we did back then. So we barbelled the portfolio, it's still there, and that is earning 5. And so if you look at our materials, you'll see that the yield of the combined portfolio of $1 trillion is actually continues to rise every quarter because you have the runoff in the lower yielding held to maturity and an increase in the asset AFS and the shorter term stuff. So we'll ride that through, but it gives us a stability in NI even as we go next year. And if you think about what people are saying, they're down a lot next year. We're basically saying, if you do all the math, we're down a couple percentage points for the year, which is outperforming others because we have the stability, the earnings power driven by the deposit franchise. At the end of the day, we've got $1.9 trillion of deposits, which all in cost is 160 basis points or something like that. It's really fantastic base, but it's our customers, and we do a great job to get it.
Are you frustrated by how the street has been grading it all, just based on the stock price itself? Has it been a frustrating situation for you?
I'd never get frustrated because at the end of the day, if I go out and look at what our company does for our clients, our teammates, and our shareholders in society, we generated on an operating basis $29 billion plus earnings, 15% return to tangible common equity, 90 basis point return on assets in a year which had started with people thinking there'd be a recession. It turns out a soft landing is a completely different environment predicted, as your colleagues are talking about, bank disruption, all the things that went on, and yet we started the year with about 1.93 trillion deposits. We ended the year with 7 billion less. So all this idea that deposits are going to run out of the system for, as rates got normalized, all that stuff, none of it's proved true. And I never get frustrated. We just go out and do what we do is deliver good core earnings, and we let the market take care of itself. And if the stock's cheap, we keep buying it.
What's your outlook for the housing market, just given how mortgage rates have come down?
Well, I think we're in a process. If We have 15 years of no rate environment effectively, and people thinking that was normal, and we barely got normalized. Pandemic came and rates fell again. So I think it's just going to take a while for everybody to get used to a higher mortgage rate, but you're seeing that start to happen. You're starting to see that as it even gets down a little bit, you start to see the kick up in activity. It's not going to be robust. It's not going to be a big refi activity, but we're basically getting on home equity loans a constant amount of production, and on the mortgages, we're sort of running the same place. i.e. we're producing the amount that's being paid down every quarter. But it's not something, I think it'll be okay. I think the beneficiaries of the half the households don't have a mortgage in America, so they are renters or own outright. The other half that do, are benefiting by fixed rates. We have 40% of our mortgage portfolio in our books is all floating rates, so those rates are starting to move up, and we'll see all that play out.
SPX, watch SPX right here.
Either have more children or something like that, or they retire and they become empty nesters, or unfortunately,
SPX, run, dude.
Because people pass away. All those things are still true. It's just the refi activity is lower because people have low nominal rates, which is basically a good thing for American consumers and provides their ability to stay in the game and spend because they've got their mortgage rates by and large aren't shifting much.
Brian Moynihan, I want to thank you for your time today, and we look forward to seeing you at the World Economic Forum in Davos on Tuesday. We'll be talking with Brian Moynihan again Tuesday morning on Squawk Box, and we'll see you then. Thank you.
Thank you, Vic.
Tyler, we'll send it back over to you. Again, when we get to Davos, it's going to be a lot of other things we're talking about, including the loss of trust in institutions, what happened, and how you build that back.
Very interesting and very topical. Becky, safe travels to you and your team.
Thanks,
Appreciate it. Thank you. And
Your
Mr. Moore
team?
as well. As we head to break, a quick power check on the positive side. Cognizant higher. Jefferies raising the price target on the IT services firm. On the negative side, United Airlines down 9%. Delta's weak guidance, along with oil prices, dragging the entire airline area down. That is your power check at 37 past the hour. We'll be right back.
Welcome back to Power Lunch. We just heard from Bank of America's CEO Brian Moynihan on the bank's fourth quarter results and, of course, much more in the macro picture. So let's get an analyst take on that big interview with Becky Quick and the other banks that were reporting today. David Conrad is Managing Director of Equity Research at KBW. He has a market perform, more neutral rating on Bank of America. Also a 30.
Today's a big day. You can hear, and I've said it too. I said it too. This is the day where I'm going to decide if I'm going to be very bullish or bearish. And I am not bullish at all. Not for it. I'll know more Tuesday. I want to see if Yemen strikes back. I want to see if there's going to be a reaction with Iran. And I want to find out who the president's going to be in Taiwan. They're definitely going to vote for the guy that wants peace, that wants to talk to China, that negotiate with China. China wants Taiwan real bad, and we have a very weak president. And that's why the world's in the mess that we're in right now, because of appeasement. We gave Iran $5 billion to blow up Israel. We gave Iran $5 billion to shoot our warships 131 times in the Red Sea. We more or less paid for this war. Now we're giving money to Israel. We're giving money to Ukraine, and we gave money to Russia. We bought oil. We gave our reserve to China. All that makes me very bearish. And we're at all-time highs. I can't listen to this hogwash on here some of the time. When we had 911, I sold everything I had. I was at a bluegrass festival, and I called my broker up and I said, hey, I want out of everything. Then when we figured out what we're going to do, and we went in, and there's already a declaration of war signed by Bill Clinton to go into Kuwait. So once they attacked us, we went to war with Iraq and got Saddam Hussein. Then when we caught Saddam Hussein, I started putting money back in the market. The worst thing that Wall Street does is they don't take this geopolitical stuff serious. They took it serious there after Biden gave the permission slip for Russia to go ahead and invade Ukraine. He said, go ahead, just have a small excursion. It's been 2 years later and they're still killing each other. Over 600,000 people dead in 2 years. Then we had another genocide in Israel, and the market ain't taking it into consideration. Now we've got the Red Sea on fire. So I got to be very cautious with my money. I don't want to be blowing it. That's just the way I'm trading. I'm trading on geopolitical worries right now. And I don't want to have any money in the market. I don't want to listen to these people screaming and whining because we have broke that triple top 3-year candlestick. Because I've never seen anything like it. It's unprecedented. And I'm not going to take, if there was maybe 2 candlesticks or maybe one, maybe a harmony, but not at a triple top. I've never seen candlesticks look like that in the 20 years that I've traded. So I don't know what's going to happen. I'm going to be cautious. I have no money up there. It's all out. I'm just going to keep day trading and scalping these knives. We've had a lot of volatility in the last 2 weeks. We had too big of a run. We had that big gap. That's scary. Big gap. I'm just not going to take the chance unless we break that all-time high. $48.18, $48.20. Then I might jump in the market and start throwing stuff in here. But I'm not going to be throwing anything in here unless we pull back to this here shoulder line. If we pull back to that shoulder line, I'm going to load the boat. I guarantee I'm going to load the boat. Anywhere in this channel. That's where I'm going to load the boat. So I keep saying that, you know, these guys are looking for anything to make this pump this market. Then we got this Bitcoin thing in here. So I just can't take the risk. I've never seen anything like this. It's unprecedented to me. And I just got to wait and see. I don't want to be a Debbie Downer. You can find someone else that would rather pump it up. But I just can't take that chance. Not at these resistance levels. I'm not going to throw away money when I'm the master of the triple top. This I would have definitely loaded the boat. That's a huge hammer. The only thing that's these three candles has got going for it is this one's a little bit higher than that one, and this one's just a smudge higher than that one. Not much. Not much at all. They want it to break, and once it breaks at 48.1862, or we even get close to it, I'll start loading the boat again, but not until then. My game plan is if we dip down here and hit the shoulder line, or this previous high, if we hit that previous high right there, we get hit, or we go to war with Iran, which I don't think, everybody says they don't want to, but right when Biden got into office, they were over there trying to make some deal with Iran. And you don't hear him talk about that anymore, but we gave him $5 billion to blow us off the map. At 46.0765, or of the 9, even if we pull back and hit the 9 on the weekly time frame, I'd start a position somewhere in there. But these CNBC just pumping the market real hard right now, and they're bringing in all these experts. It's all about the Fed rate cuts, which they overblown. And I just can't take that big risk. I just can't do it. I ain't gonna do it. I gotta wait for something to break or something to pull back real hard. And there's just too much tension geopolitical. I've been trading here for 20 years. This is the scariest I've ever been when it comes to geopolitical worries, ever. Even when Obama in Syria, when he had that genocide, I was pretty skeptical. When we were told Russia not to cross the red line, and he did, or when Hillary gave him the cup and it was misspelt and it meant something a little bit worse than what she wanted it to say. So I can't take big risks. I can sit here and scalp these and make 2 or 3 grand a day. You've seen it. I mean, the options on these SPXs. Yesterday, that one that went from 270 to $1,000, or is that today? Then the other day, $370 to $3,000 on an SPX trade. I make more money on trading the SPX and the SPY and Tesla than any other stock that I've ever traded. And I'd rather be safe than sorry. And I can't hold any stocks that doesn't have any cash. They got to have cash. There's some kid here pumping AMC. And I got in the room and I said, I ain't trading this piece of crap. Not when you got the only headlines you got is a streetwalker. And that was when it was at $6. He was pumping this stock. Up in here. And I said, no, we're going to knife. Because they're not making any good movies. This thing's going to end up being at $1. Maybe $1.50. And then I'll go ahead and take it. Unless, so you got people buying this stuff and it's still dipping. I'm watching the tape. I want to watch this tape on this stock because I get some kind of inkling in who's pumping the stock and who's not. Now, I traded with a bunch of guys that started out with $1,000 trading these stocks. 10,000, 5,000, and they became millionaires. And they didn't know how to read a chart or nothing. They were just in a big station, pump station. And I got away from it. I couldn't deal with that. It wasn't my kind of way. I didn't know, anybody knows when you got a stock that's $5 billion in debt, it's just not worth trading. You got to have money. They got to have money. The safest ones right now are the ones that they mention every day on CNBC. The top 7, Meta, Microsoft, those are the only ones that we should be watching right now. Apple, Amazon, Google, they all have billions and billions in cash. So if things get real bad, and we get hit, or we get into World War III or whatever, I mean, they're cutting the shipping. They're having to move. Tesla's having to shut down because they're not getting their parts to build cars in Germany. They've got to go all the way around and burn more oil, burn more gas, and the shipping costs are going to fly through the roof. BYD bought their own ship to save money in shipping cost. Huge tanker that can ship hundreds of cars. Instead of them costing billions of dollars to ship a car, they can do it for billions less because they own the ship to ship them to China or to Australia or wherever they got to go. I just got to emphasize. I know I've been a broken record for 3 weeks. Ever since we hit that all-time high, and I called it out way in advance. Way in advance, and it's been nothing but downhill ever since. And I just want to emphasize that people shouldn't be taking a big risk right now when we're at all-time highs and we got all this turmoil going on. We could have a 911 event. In one of these football stadiums. The game that Kramer's going up here to Kansas City this weekend when it's going to be 20 below. It don't take much for that tension. I didn't predict 911. I was at Bluegrass Festival playing music in a band, back in. And then I went to, that next year I went to Washington to visit the mall. I bootlegged, I think, 5 gallons of homemade brew, and we had a big party with the Shiners in Richmond, Virginia. And I recorded an album over there in Richmond. Even when I went over there, before I even got to Richmond, I stopped at a rest station. I run out of the car without my shoes on, and I was going to have lunch, and I stepped on a big black bee. My whole foot swelled up. So you never know what's going to happen. Anything unexpected could happen when you have these Muslims pissed off at us. I have nothing against the Muslim people. I have nothing against any kind of religion, as long as you're not wrapping a snake around your neck, or you're a Jim Jones or Charles Manson. We're at these all-time highs. I just can't take that risk. I'm not going to take that risk. I'm going to wait until we break that resistance level. When we break 479.98, then the game's on. If not, we're going to pull back here, and then I'm going to load the boat, or I'll load the boat off the 9, because it respects the 9. But these people are speculating on CNBC. They don't know. They overprice everything. Then they've been wrong every year. They're never right. And the charts tell me everything. I don't care about the PE ratio. I don't care if to me, the charts are always right. We bounced off the 200. I called that out. We bounced off the head and shoulders, and I called that out. We bounced. We hit the head and shoulders up here, and I called that out. Now we're at a double top. I'm calling that out. We're at a very hard resistance, the hardest one I've ever seen in 20 years. Why is that? Because of the run we've had in 1 year. This at the end of the year was scary to me. It was very scary. I've never seen anything like it. As long as if we got to break that before I get relaxed again and get back, or we got to pull back to this previous high, or we got to bounce off the 9. It's either the 9, the previous high, which is the shoulder line of this head and shoulders. If you look at the wick on this here candle and draw a resistance line, that should take you right straight to the 9, to that body of that candle. And we're just trading these things today. I mean, the SPX and the SPY, just the spreads are so beautiful. And you don't get this often. I mean, we have 3 or 4 times a year where I say, God, like Tesla. 2 years ago, I traded Tesla. I got a $10,000 trade on an option that went from $300 to almost 10 grand. And then these things here, we witnessed the $300 or $400 to 5 grand. That one couple weeks ago, I said I could have had a $70,000, $50,000 day, and I sold way too soon. And I only had like $3,000 altogether in them 2 trades. So it's just very good to be patient and wait and look for the setups. Look for the chart. Charts hardly ever lie, in my opinion. People do. People exaggerate. And it's just don't want to take them big risk, because we pull them back already here. We've been told that the 48 4,800 is the hard resistance. And I don't think we're going to break that. The earnings were, to me, the earnings weren't what I wanted to hear. You've seen the doom and gloom on all these faces, but probably J.P. Morgan. They're not really excited. I think next quarter, when the banks come out, they'll be a lot better because they're writing all this stuff off. They do it every year. They do it all the time. They're lucky. I mean, if I could write off my taxes, I'd be filthy rich. I pay a lot of taxes. So I'm just going to be very, 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 very cautious. And I'm not going to take big risk. No, I'm not. These guys are pumping Uber. I mean, today they did. Guys, that some of them sold their Ubers.
Stock market.
They probably should have sold their Ubers because of the what Hertz did with their EV cars. They dropping 20% of their fleet and going back to combustion engines. General Motors and Ford are complaining. Said they're just not going to be able to do it. They just can't do it. That or that we're going to be bailing them out for trillions of dollars.
Some of the big growth stocks still kind of protecting the index. And Christina, I wonder if you, I think the market has it correct in terms of taking heart in the inflation data this week. You know, the bond market yesterday.
So the market has it correct. The market has it correct. The market doesn't. The charts have it correct.
So do you think that we're okay here in anticipating what the Fed's going to do, or do you think we have a little bit of a check on that belief?
Well, I think markets are right in assuming that the Fed is going to start cutting soon, but I do believe that we should be prepared for some volatility because we're going to hear from Fed officials.
The markets should have it right, but then I think we should be looking for some volatility. It's so mixed messages. The easiest thing to see is the chart. It's telling you that we're at a all-time high. That's all you need to know. And it's just not, it's just too much. It's got to pull back.
Market on financial conditions, or do you think that there's genuine disagreement about the ultimate path of inflation here? Because it feels as if the market, it almost wants to call the Fed's bluff here. It's saying, the 2-year Treasury yield is now, 120 basis points below the Fed funds rate. It seems like it's kind of dialing ahead to that moment when the Fed needs to get moving.
The market wants to call the Fed's bluff because I do believe it's all about tamping down and easing of financial conditions. Let's face it, the Fed has been wrong before, and terribly wrong. If we go back to December of 21, the dot plot indicated an expectation of 90 basis points for the Fed funds rate at the end of 22. And it was about 433 basis points.
Yeah.
So the market has some experience with the Fed, and it's calling its bluff, rightly so.
Certainly at inflection.
I want to disagree with both of you. The market is calling the Fed's bluff. I mean, credit spreads are at extremely tight levels.
One of my YouTube guys
IG spreads, investment grade spreads are
said this.
100, which is a really.
You don't mind if I
tight
share
level.
that, do you, Parge?
High yield spreads, not exactly a spread product, but are pretty tight as well. And the stock market is, as you mentioned, basically at a high. So clearly the market is, both the equity and the credit market is telling you something here about the economy, about earnings, and about the Federal Reserve. It's not a theoretical thing, it's actually happening.
Well, I don't know if we have to characterize strength in risk assets as, believing that the Fed has it wrong. If the Fed is saying, we think there's room for a few victory or peacetime rate cuts, right? So they're saying, we're going to allow a soft landing to happen if we get that level.
Of course, I just mean in the context of Fed members coming out and giving hawkish. Well, clearly that's not working.
Oh, it's not working.
In terms of tamping
down. Still try, for God's sake.
Oh, they are trying. It's just not working.
The right ones have to say the right things at the right time.
Also true. Also true. But again, with the stock market at high and spreads at tights, it's not fully priced in, and we can argue about how one would do that. Sure. But clearly, the soft landing is what investors are betting on.
So the line that I have been returning to is that just because you have the S&P 500 around 4,800 and you had the Fed funds futures market anticipating 100+ basis points of cuts this year, doesn't mean that we're at 4,800 strictly because we expect that many cuts. Do you think that's the case, Christina, or are we that dependent on an aggressive easing cycle for equities?
The stock market has been incredibly dependent upon monetary policy really since the global financial crisis. So I'm of the opinion that this is a lot about, not entirely, but largely about monetary policy and expectation for rate cuts.
Dan,
I disagree with that also.
Yeah.
It's Friday, let's have some fun. The idea that the stock market is where it is, and I don't want to fully characterize what you just said, but largely because of monetary policy, I totally disagree with. I mean, you could look at trailing 12 months earnings and the growth since, call it 2008, 2009. It explains a huge chunk of the market move. Now, you could argue that the Fed has taken what would have been a bigger problem in 2010, what would have been a bigger problem with Silicon Valley, and ameliorated those problems, thus laying the groundwork for the higher earnings. But at the end of the day, let's not pretend that earnings haven't done exceedingly well over the last 15 years, thus justifying a huge portion of the market. To be clear, we are trading at 20 times.
Yeah, we went from like 12 to 20 times.
But that's what bull markets do.
No, I understand.
That they go from low single digits or high single digits or low double digits to teens, or in this case, 20% earnings. That's not totally unusual.
Where does it leave you, Christina, just in terms of trying to set up an investment strategy for this year? We had this nice move from the few leaders into a broader list of stocks late last year. Some of that is backslid.
Now everything's starting to freeze up on me now. It does it every time this time.
What does it mean for whether we can believe the earnings estimates that are on paper right now?
So my expectation is we will see a deceleration in the first half. It's not going to be dramatic.
So we got a snake.
It won't be landing because of tighter credit conditions, but it's going to be brief. And then I think we're going to see a reacceleration in the back half this year. Stocks typically discount 6 to 9 months out. So what we're seeing now, I think what we'll continue to see is a discounting of that reacceleration, that mid-cycle reacceleration.
Come back to the 9.
So I would anticipate a broadening where we'll see small caps perform better, cyclicals perform
right
better.
There.
And because long rates are coming down, tech's likely to hold up quite well in addition.
So it seems like not exactly an either or type market. I mean, I guess, Dan, I also keep coming back to the idea that pretty much everybody wants to see the market broaden out. I mean, there's sort of this sense out there. There's a discomfort with 7 stocks kind of being the whole story, even if it wasn't really fully the case last year.
47.85.
Well, if you're a money manager, and we're again, for the 100th time, we're a hedge fund. We take single stock risk. But if you're a closet indexer or a broad money manager, and a majority of the gains are being generated by 7 stocks, you can't keep up. This is a point Joe Terranova has made on the show repeatedly.
He's saying the same thing I'm saying.
Weighted towards Apple or Nvidia or whatever it is.
You can't keep up with. He's a single stock trader.
Manager to perform. Again, that's not what we do. But
you can't keep up with 7 stocks. I couldn't either. Not in this market.
Overly reliant on those 7 names.
Not when there's so much volatility at all-time highs.
I don't think I made this point again. These are not just 7 stocks. Microsoft owns 10 stocks that used to be public, LinkedIn, Twitch, obviously Amazon owns MGM and Whole Foods and all of, a whole bunch of really large companies. So it's not just 7. But listen, you want to see the market broaden out because it's better as an investor to have a broader market. But I don't think it necessarily means something negative on its own.
I mean, I defy you to locate the portion of the $1.6 trillion in market cap of Amazon that's attributable to MGM at this point. But I know what you're saying, that these are kind of corporate nation states, essentially, and they kind of run on their own rules. Christina, what about the rest of the world at this point in terms of opportunity or where you would look? Incredible move in the Japanese stock market, feeding off of some of its own dynamics. Obviously, China's a complete opposite. And then, I mean, a kind of a muddled period in Europe at this point.
So I think this is...
We got a 3-day weekend coming up. And I don't want to be invested just until I find out what's going on with Taiwan and what's going on in Yemen. Right now I'm going to scalp this baby. The 47.85 calls. I'm going to try to get 120. Here we go. Got it. 120. We broke out of the snake. We got the snake. break out, pull back. We've got the 9 getting ready to cross the 21. We break the 21, we're going to come up here and hit the 50. Now we got a head and shoulders right here. And that runs right into the 50. Oh, there's 105. So this thing kind of this is a wedge. So I would say look for a pattern. That's called a wedge. It's a thick wedge. And we're getting ready to squeeze any second. That or we come down for the third time, and then boom. We got 1, 2, 3. 1, 2. We break the 21, we're definitely going to shoot up here. Or we come down and hit the 3, and then come back up for the third time, and then boom. And if we don't hold that 4777777777777, I get out. But I'm not happy with the earnings. This was the day.
Pledging retaliation after the United States and the UK launched strikes against the
Now I'm getting messages on my phone.
A wave of attacks that have destabilized trade routes in the Red Sea. Names like Lockheed Martin and Northrop Grumman are among the gainers there, but you can see we've switched on to Boeing. Boeing is down right now, sitting out the rally as scrutiny over last week's door plug blow continues. Several passengers now from the impacted Alaska Airlines flight are now suing Boeing over the incident, citing physical injuries and emotional trauma. Separately, the Federal Aviation Administration says it will audit the plane maker's production line and could bring in an independent third party to oversee inspections. Boeing says it's going to cooperate fully and supports actions to improve safety. You can see shares, though, are heading for their worst week since May 2022. Right?
Christina, thank you. We are just getting started. Shares of Citi volatile today. They are now in the green by about 0.6% on the heels of its earnings report and some big announcements. Citi CFO Mark Mason joins us exclusively after the break. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC.
Okay, this is it. 1, 2, 3. I'm probably going to get stopped out if we don't hold this here 3. So I'm at $1. Now we're going to come up and hit the 200. Boom! Or we get out at the 200. so don't seem like we're going to do much. What was that? Okay. Yeah, I'm going to get out. If we built below this here candle, there we go.
Deals today. Welcome back to Closing Bell. Citi shares up slightly after reporting earnings this morning. The company also announcing it will lay off 20,000 employees over the next 2 years. Let's send it over to our senior banking and finance reporter, Leslie Picker, who's sitting down with Citigroup CFO, Mark Mason. Leslie.
Hey, Mike, thank you. And Mark, thank you very much for being here and for hosting us here at the Citigroup headquarters. Let's get right into it. You said in today's call, quote, "We're not satisfied with the performance and returns in our businesses, and therefore we are laser focused on executing against our strategy, simplifying the organization, and right-sizing the expense base." So how confident are you that you'll be able to achieve it all?
Well, first of all, Leslie, thank you for joining us here at headquarters today. Today was a very important day. We announced earnings. And to answer your question, I'm very confident about achieving it all. And I'm confident about it because we set a new strategy at Investor Day to be the preeminent partner for institutional clients, to be a leader in wealth, to be a valued player for U.S. personal banking and our customers here in the U.S. And we're making great progress on that. I was disappointed in the quarter, but I really want to talk about or think about the quarter in the context of the full year. And we've made significant progress throughout 2023, and we're well positioned to continue that into 2024. And it really is about being a simpler bank.
Yeah, the stock price reaction would indicate that the market is looking past the quarter as well. But in terms of executing on this strategy, you have a situation right now where you're cutting expenses while also trying to grow the top line and really refocus and reprioritize the growth of the business. How do you do that without sacrificing growth in the area you're targeting as you're doing this all kind of simultaneously?
Look, it's about balance, right? And we've got these 5 core businesses that we're focused on. They all are businesses that over the cycle will produce top-line growth, and over the cycle will produce strong returns. And so it's about ensuring that we allocate enough resources to those businesses like our Treasury and Trade Solutions business, like our Security Services business, while at the same time investing in our infrastructure, our transformation, our risk and control, and making the appropriate recalibrations as the cycle evolves. And so you've seen us make investments in services. You've seen us make investments in our investment banking business. You've seen us make investments in wealth. And in instances where that hasn't produced revenue, our wealth performance was less than we would have liked, we've dialed back that spending. But what we haven't compromised and won't is the investment in our operations and our infrastructure, in our risk and controls. But it is about striking that balance. We've got these 5 businesses through the cycle produce very strong returns. Our services business produced a 20% return on tangible common equity in 2023, right? And our wealth business through the cycle will produce high teens, low 20 returns as well, as Andy Sieg, who's joined us, starts to turn that around, starts to drive top line investment fee revenue growth, and really starts to streamline that expense base. So it's about that balance.
In terms of resources where you are extracting from different areas, of course, you announced today 20,000, in terms of a reduction in headcount at Citi. Can you share some color in terms of where those will come from, where you see the most reductions taking place in terms of how you're thinking about allocating those resources?
Sure, and I think it's important to put that into context.
Oh,
because
boy.
that 20,000 reduction, which
That
is
was a good
intended
one.
to happen over the medium
Out.
term, is directly linked to the strategy that we talked about at Investor Day and we've been executing against. And what I mean by that is we talked about exiting 14 countries.
We
talked
it
about a
bounce off
simpler
this trend line.
organizational structure, and just a couple of months ago, we eliminated 2 segments, and we eliminated the regional construct.
First
and
loss
those
of the
2 things
day.
in particular, along with the benefits from the transformation over time, are what's going to allow for us to be a simpler bank and allow for us to take those headcount and resources out of the organization. That's going to take time, but we've made significant progress on that in just the org simplification announcement that we made a couple of months ago and the significant restructuring charge that we booked this quarter. And there'll be more of that in the first quarter here in order to drive those saves out.
I know that Jane said on the call that $2 billion was the cost savings that she anticipates from those headcount reductions. In terms of additional expenses we can see tied to severance, any ballpark there?
Well, so in 2023, we booked about $1.5 billion of severance and restructuring related costs. In 2024, we're estimating somewhere between $700 million and $1 billion of severance and organizational simplification related costs.
Let's talk about the consumer. Net credit losses were just shy of $2 billion in the quarter. That was up 22% sequentially, 69% annually. Although the losses are still relatively low by a historical standard, do you think we're starting to see a deterioration in the quality of the borrower at this point in the cycle?
No, look, we haven't compromised our underwriting through the cycle at all as it relates to our card customers. What we're seeing is that if you think about what happened in COVID, spend levels were down, loss rates were down, and as we've come out of that, spending has picked up. We've seen good purchase sale activity. We've seen payment rates that were high start to come down a bit. We've seen loan growth start to materialize. This is what drove the 12% top line growth in our U.S. personal banking business, which is also 16% for the full year. So we've seen that top line growth, but we've also seen the loss rates mature and materialize through 2023, and we expect that to continue through 2024 and peak in 2024 before starting to normalize. So in some ways, this is a maturation of a portfolio that has come out of COVID, combined with new acquisitions that we've done since then, maturing at a more normal pace. And that's what's driving the increase that we've seen.
Interesting. Thank you for that clarity, too, on the 2024 peaking. Lastly, I want to ask you about geopolitics, because we're in just such an increasingly complex world as it pertains to geopolitics. There are dozens of elections globally this year, and Citi is the quintessential global bank, as it's been built up over the past few decades. This quarter we saw significant losses as it pertains to exposure in Russia and Argentina specifically. How do you navigate through this, and how do you handle and deal with the risks associated?
We bounced from here. I could have got
all these markets? I know you were streamlining to a certain extent, but in this
70 cents where I stopped
world,
out.
How do you grapple with that?
I think what's important here is to really recognize that our strategy is about being a global provider of services to our institutional clients. So we're in over 90 countries because that's where our clients are. That's where they do business, and that's where they need us to be to help facilitate that activity. When you mentioned Argentina, and you mentioned the reserves that we booked there, those were not credit reserves. That was not about loans that we have in that country or in Russia for that matter. Those were reserves around transferability of capital risk. And that's very different. That's not an exposure that's tied to credit.
It's the devaluation of the currency.
Well, the two things. You have the devaluation of the currency that flowed through and hit our top line, and then you have the reserve that's tied to transferability of capital, which is in a way linked to that devaluation. So it's important to point out we're well reserved in both of those countries, in Argentina and in Russia, against that risk. And importantly, when I look back over the 100+ years that we've been in Argentina, serving over 1,300 multinational, or clients I should say, and 700 multinational clients, we've lost $5 million in the last 10 years. $5 million, right? So we're very careful about
fraud charges on Baidu.
A lot of these clients are multinational clients. A lot of the loan exposure that we do have is backed by the parent company. And this is, again, part of our strategy. When I look at the returns that we generate, if you think about our TTS, our security services business, 20% returns in TTS. That compensates, if you will, for the risk that we take in many of these markets. And so we're in these countries because this is where our clients are. We've been in them for a while. We know how to manage that risk. And the returns make sense for us when we think about the business we do with those clients.
So certain markets you will stay global.
Yes.
Mark Mason, CFO of Citigroup. Big day for you. You've got fourth quarter earnings. This transformation strategy. We appreciate you coming on CNBC to help us make some sense of it all.
Happy to be here. Thanks for having me.
Thank you. Mike, I'll send it back to you.
All right, Leslie, thank you, and thanks, of course, to Mark as well. Up next, glass half full. KKR's Henry McVeigh is back. He's breaking out his playbook for 2024 and telling us where he sees some big opportunities ahead. He'll join me here at Post 9 right after this break. Closing bell, we'll be right back.
Damn it. Well, let's see who he is. He's smart. There he is. Mark Mason. And there we go. Dadgummit. Don't do it. Okay. Oh, I'm tired. Now maybe if it comes back down and hits his shoulder, I ain't gonna trade no more. I'm too tired. There it goes.
BC and Peacock.
Major averages slipping just a bit here as we head to the end of this this week. Earnings season is, of course, getting underway. Joining me now, Post 9, is KKR's Henry McVeigh. Henry, great to have you.
Thanks. Great to be here.
Coming into this year, I mean, the markets have almost gotten to the point of trying to sound some kind of an all clear, you know, whether it's on the policy front, the soft landing front.
Yeah.
What's your assessment of whether that's correct or not?
Look, I think, you know, our view is that the market actually bottomed in October of 22, and so we're long-term investors, typically on a 1, 3, 5 year basis. You stick with it. I think we are above consensus this year in growth, and we're actually calling for a mild recession. So that should tell you where sentiment is.
So the idea being, yeah, growth is universally considered to be like 1% or something like that.
Yeah.
And so you think it'd be better than that, but with a little bit of a dip.
And I think where KKR would differentiate is around the labor market. I think we're seeing a totally different behavior pattern from employers with their employees. You know, Citigroup aside, is generally people are keeping their employees on the payroll, and there's some real demographic issues where we do business in areas like Japan, Germany, even the U.S., where when you find quality labor, you stick with it.
one of the elements of, if you look back to that, famous soft landing I keep talking about in the mid-90s, was the Fed sort of allowed the labor market to be stronger than they thought it could be, with inflation staying tame. Have we stuck that landing here? Central banks around the world seem to be making the turn.
Yeah, if you think about in 2022, almost 90% of the top 25 central banks were raising rates. Today, that's zero. That's an incredible
There we go.
Do you want to be rolling the rock up the hill in terms of headwinds or rolling it down? And our view is
that's a hard resistance to break.
We're less, I'd say, bullish and averages going up.
I could have done well. I could have added on more.
The message, though, is that the cost of capital, the difference between the bid and the ask will
But I didn't want to take that risk.
That's going to lead to more activity in the deal front and issuance front. That will be what's different this year. You saw that today with BlackRock. You've seen more deals in Chesapeake yesterday. We think there's going to be more activity. Obviously, we are both a deployer and a monetizer of capital around that, and things are getting busier on that front.
Yeah, obviously been a completely absent factor last year, even though it looked otherwise in many ways like a bull market. Interested about the thoughts around the world, paying a lot of attention to this breakout in Japan. The stock index is there anyway. Seem to be feeding off of some specific dynamics in that country, but how would you approach it now?
Okay, I'm going to come back and say the same thing we've said the last two times. Buy Japan.
Yeah, that's right. So you've been there. Yeah.
So we're still very active around the private equity side. I think the new tool in our toolkit has been real estate. We made a big acquisition there, and so we've been active on that front too, and even in infrastructure. So we have a dominant presence there. We continue to want to be active, and I think you really see this in government policy that they want corporates to do more and become more efficient. That's a big deal. Second, India continues to be an active market for us, in Asia. I would say switch to Europe. What's interesting in Europe is the periphery is actually growing faster than the core, kind of the UK and Germany. That, to me, is an opportunity. I don't think long-term that Greece is going to outpace Germany and Spain has not done as well. To me, you go find the good companies in those markets that are maybe having a cyclical downturn, come back to the U.S. U.S. continues to defy people. Look, innovation is a major differentiator here. We were most active on our private equity front last year in the U.S. in private equity around corporate carve-outs, public to privates, and other acquisitions with existing companies.
You didn't mention China. Is it remain just kind of a problem at this point? Or?
So what's interesting to me doing this 30 plus years, Japan's having inflation, China is having some form of deflation. We're still active in China. I do think this housing market story is going to continue. I think there's more to do that. That's the cautionary tale. The offset is there are two areas of focus that people are underestimating. One is around digitalization of the economy on the industrial side. Most people talk about China technology on the consumer side. We're much more focused on the industrial side. And then second is they are decarbonizing very aggressively, and given the size of their economy, that has ripple implications, implications that ripple throughout the world. So you have to know what's going on in China, whether you invest there in China or the rest of the world around this decarbonization thesis.
Certainly seem ahead on that front. Henry, great to see you. Thanks so much.
Thanks,
Have a good weekend.
Always. Absolutely.
Up next, we're tracking the biggest movers.
God darn it.
Close. Christina standing by with those.
Thanks, Mike. Well, more margin pressure for Tesla and a possible smartphone revival.
Dumb.
I'll explain all the details after this short break.
Dumb. Dumb. I would have got out at 110 right now. It just never fails. It never fails with me. Never fails. I have to give you all credit for making me a lot better trader. If I just hold on to them instead of look at the red, my accuracy's got so much better with you all. Mike, Randy, Sue, even Linzoid, Tony. magnificent. I sit there and I mean, I've hardly ever had any losing trades anymore until I sell them at a loss. If I just hold on to them a little longer. I remember taking $1,200, $1,500 losses. Martin Luther King's coming up on Monday, so I think I went to 15 parades in a row, and then I quit going. I always thought things were getting better, and then Obama got elected, and we had all them riots and stuff. I said, I ain't doing this shit no more. And it was a good walk. Especially ain't gonna be doing it this year. Too cold. So I'll sit here and watch a Martin Luther King speech or Malcolm X. When I was a little child, I walked with King in Portland, Oregon, at the Rose Garden. I might do a little video on the not that one. What did I do, lose it? Might have. Bounced off the double bottom.
Playing that space and what he thinks could be next for crypto. And don't miss the NFL's first ever exclusively live stream playoff game tomorrow night on Peacock at 8 p.m. Eastern when the Super Bowl champion Kansas City Chiefs host the Miami Dolphins. Closing bell. Be right back.
Kansas City.
NFL.
Bitcoin ETFs tumbling today on their second day of trading. The top funds saw more than $4 billion in trading volume yesterday. That was a day after the SEC gave approval for their launch. The move seen as a crucial step in cryptocurrency's broader acceptance. Let's bring in Miller Value Partners CIO and Chairman Bill Miller IV. Bill, it's great to have you on, and certainly we'll get your take on legacy financial assets in your portfolio. But as an owner and believer in Bitcoin, what does the advent of the ETFs mean, if anything, for the fortunes of the asset class?
I think it represents an enormous step forward for institutional capital accessing the asset class. But I think there's actually something out there that's already exposed to Bitcoin, which we've owned for quite a while, which is actually better than a Bitcoin ETF, and that is MicroStrategy. MicroStrategy is better than, in my assessment at least, is better than a Bitcoin ETF for a couple reasons. Number one, it's more liquid. So it's the largest owner of Bitcoin in the world. Not only that, there's no fees attached to it. And so you think about the optionality of owning a new technological asset and being the largest owner of that asset. It provides enormous optionality over the long term. Not only that, you've got a CEO who owns $1 billion worth of stock, who owns $750 million worth of Bitcoin personally. He's a technologist. He's got 31 patents to his name, so he gets it. So, you know, we can talk about the ETFs, but there's already something that's more liquid out there already, and it's really interesting to consider that.
Although isn't MicroStrategy, I mean, it's perhaps more liquid at this point for sure, but its value is also going to deviate from the value of the underlying Bitcoin. Of course, there is also a software business in the public company as well.
Absolutely, and that's one of the things that makes it super interesting to me, in that if the value deviates from the intrinsic value, so if the price goes above intrinsic value, Michael can sell more shares into the open market and use that cash to buy Bitcoin. That's an enormously value accretive thing to do. If you think about the history of fiat currencies, always debasing themselves, right? And then you've got something whose supply, Bitcoin, is completely independent of the demand for it. That's a very value accretive thing to do, is sell something in dollars and buy something in Bitcoin.
I guess that's good if you already own the stock, but maybe don't be one of those buyers of a new equity offering at a big premium to intrinsic value if it's just, you know, essentially an arbitrage.
Well, selling shares at a premium to intrinsic value benefits ongoing shareholders, so we don't mind that at all.
No,
you know, on the other hand, if the value dips well below, right, the intrinsic value of the software business plus the Bitcoin, you can always buy back shares. So, you know, having somebody at the helm of what is effectively a closed-end fund, allocating that capital is enormously value accretive longer term.
Gotcha. So as somebody who, you know, who looks at individual, you know, equity and bond opportunities out there with a value orientation, how are you finding the markets right now in terms of whether there's, you know, a rich set of opportunities or it's picked over after this big rally last year?
No, I think the backdrop right now is enormously positive for equities if you look at what's going on. Last quarter, one of the things that was really interesting to me is that long-dated government bonds were up double digits. Not only were they up double digits, the stock market was also up double digits. That's a really interesting combination. Historically speaking, at least, when bonds are up double digits, equities are tanking because people are buying safety. In this case, when you see both of those things move up at the same time, it probably suggests the market believes inflation is reined in and very much under control, which is supported by today's PPI numbers coming in a little light. So now the bond market, the Fed funds futures market, is predicting roughly an 80% chance of a cut from the Fed by the end of the first quarter. And that's really interesting if you think about GDP annualizing at 4.5% for the past 2 quarters, with the Fed looking to cut rates. That hasn't happened in 40 years. So that's an enormously positive backdrop for equities. So we're really bullish on the environment right now.
Yeah. I guess that would suggest that, you know, you mentioned the trailing GDP growth rate.
I've been through the period where they cut rates, and the market loves it. Well, I think we were at like 7% at one time. And then they cut the rates, and I mean, the market just flew under the Obama years. It was all about the rate cuts. We were in stagflation. We had stagflation. They were trying to get us out of stagflation. And it never did happen, but Wall Street made a killing. But yeah, the market, they know these guys are smart. When that first rate cut comes in, boom, baby, and we'll break that triple top. I want to see us pull back and hit that resistance, that support, and that would be such a blessing. That's what I'm thinking going to happen, but I've been right on every pullback and every high, so we're going to find out. If we pull back to that spot, I'm going to load big time. Somewhere in that channel. If we do, we might have to change that. Might have to change that idea. Let's see what this does. I think I just found the first support. Why does that look so much closer? I gotta erase this. I might have found something new here. What am I doing? Think. My brain is fried. And this is the weekly, so let's take it to that wick. Take it to that. I don't see it pulling back here. And take it to the yearly. Yeah, I think it could be here. Nine crosses over. That or the 9 could touch the 21 and kind of have a squiggly. I don't want to second guess myself, but now that I saw that, I didn't think about that. That's an expansion pattern. It's a 4,700. Yeah. Jimmy likes that better. That's only, I mean, that wouldn't be much at all. That'd be like an $83 dip. $46.96. We got to bring that up. 4,700. It's the body of that candle. Yeah, 47.04. That's going to be my new support. I like that. I don't know why I didn't notice that earlier. because these guys are real bullish. And I might be asking too much for it to go down here and hit the 51. Do.
Atlantic traffic being under pressure this summer, not so much because of Delta or United where they're just restoring seasonal capacity, but because the industry is adding more than 8.5% capacity to the North Atlantic, and we're expecting pricing to come down from last year's very elevated levels. So that's sort of the bad news for North Atlantic, and they also have very tough comps. Now, the good news for Delta in our view, and why we still can have an outperform and have it be our best idea for 2024, is the Pacific region, where they're adding a lot of capacity. Traffic into Incheon is improving, and really traffic in the whole Pacific region is improving, where we have relatively easy comps. In the fourth quarter, we saw capacity up 44% for them, and we saw revenue up 45%. So we think that will carry into 24.
And how are we to view what's going on, with Boeing, with these reviews, with, the potential prolonged grounding? I know it's not a lot of aircraft and all the rest of it, but is that part of the story of why investors are taking a half step back?
Probably yes. For Delta, it's not as big an issue because they're not as big a Boeing operator as they are an Airbus operator. And they did mention on the call this morning that they're not really seeing a benefit in Seattle from Alaska Air's issues, primarily because Alaska's canceling flights days in advance and is able to reaccommodate passengers. If this happened last month, it would be a disaster, but happening in January is not the end of the world. This is after the first, I would say, week. It's a seasonally weak period, so W-E-E-K versus W-E-A-K, and then business doesn't pick up again until mid-February, and then continues, and then of course we have the benefit of one extra day, which adds 1%.
I'm going to put her on the dingbat list.
And then Easter, March 31st, you have, yes, the return traffic going home April 1st.
She made the dingbat list today. Okay. Well, it's been one good day, all but that last trade. And then you seen what happened. They said to hold it out, but I had too much of that political stuff going over the weekend. We definitely got a 3-day weekend coming up. So I want everybody, tomorrow I'm going to be doing a little seminar on a watch list and go over some stocks, what my top 5 picks of the year and where I think they're going to do or go. I've had a pretty good 4 days. I sold way too shy again. That's the big. I had one good hit. So there's a lot of volatility, and we're going to see a lot of volatility. We're going to see more volatility, I think. There's too much uncertainty out there now. But the interest rate, when they go to cut the first one, and we'll know in advance when they do it, because it'll get out. Somebody will slip. That's going to be a big day for the market. And that could be the day where you could just trade that one day and be done for the year. The spreads are so wide right now and so beautiful. and the patience is what matters. It's all about I think it's all about the chart patterns when you're catching the bottoms. You don't hear them talk about charts too much on CNBC. I think we had one girl get up there this week, and I had to message her, say, wow, finally somebody actually knows how to chart. They used to have this guy come on at 3 but they don't do that anymore. The chart guy. They used to do little option thing there at the end of the day. They don't do that anymore. They'd call out these option plays and you could take trades off of them sometimes, but they don't do that anymore. Have an option half hour or option thing, I don't know what to call it. So I'm going to get me some rest, watch some videos, my little movies. I'm going to do a couple videos on stocks. I'll probably do my top 5 of the year, where I think they'll go. And then I'm going to do, in the earnings window, I'm going to chart up the banks and UNH and Dow. Someone asked me about Dow, and I've always heard, people talk bad about Dow, Delta. We had just a huge sell-off here, big snake, bounce up, pull back to this previous channel. Now we pulled back there again today on earnings. We'll probably bounce off the 50 SMA. That's this one here is the 300, I think. The 200 EMA. So it's either the one or the two. We'll bounce off the 200 EMA. We didn't hold the 200 SMA. So it's either going to be the 50 or this one here on Dow, and it's in a good spot. We bounced once before off that 200. This could be just because it's a 3-day weekend, and we'll bounce back above the 200 maybe. And if that happens, I'll run it up and take it longer. But they've all been upgrading Dow. I mean, yeah, the traders have. Probably taken sympathy of Boeing because of the they want to put their money in airline. That's one thing about creating a watch list, is you want to trade stocks you like, that you enjoy trading, and you want to, if you're an athlete, you might just want to trade Nike and Lulu and apparel or sporting goods. Or if you're a construction worker, you might want to just trade in stuff that like Toll Brothers or the Buffett. That's what Buffett does. Buffett made most all of his money on infrastructure, building homes, real estate, Coca-Cola. He never did like to trade tech. He was totally against trading Tesla, and he could have turned $60 into $2,200. He just wouldn't do it. He didn't believe in EV cars. He didn't believe in Elon Musk. Elon went to him. He just wouldn't do it. He's bearish on crypto, Bitcoin. He won't trade it. He doesn't even know how to use a computer. He made so much money on the Obama era. He made like $40 billion in that 8-year period. He tripled his income. Tripled it. It was amazing. And it was all had to do with infrastructure and things like that. Then he got into oil this year. That really shocked me. He was into the railroads. Had IBM for many years, and it didn't work. He probably made money on it. He's a scalper. They scalp. He's got a team that scalps trades. He's got a team that buys puts. So he's well diversified. That's why I've been trading more puts, because we hit that 52-week high. I know that we're at a hard resistance and we're going to get a lot of volatility because I've never been here before. This is the first time. I was here when the market pulled back from 12,000 to 6,500. I watched every bit of it. And it was really, listen to these guys on CNBC. When's it going to stop? These, Jim Cramer, don't know how to trade. They were throwing their fists down. And then Mark Haynes came in and said, we hit the bottom. And all of a sudden, everybody started, the market turned around. He's not around anymore. That was back in 2008. I think November, October, the market really started tanking once Obama got elected. And then he didn't take office until January, so he rolled up, got all this stimulus, bailed out General Motors. Shovel-ready projects went straight to the unions. They didn't have any shovel-ready projects. He passed this big stimulus bill for shovel-ready projects, and it never did. It never got there. It went straight to the unions. And then Solyndra came, and he put $600 million in that in solar, and that went bankrupt. And Nancy Pelosi and her gang were all involved in that. Their family. But we had a real good run. You know, the market ended up running. So I was there watching all that. I haven't stopped since 2007 and 8. And I was watching the market before that. I had one of the first chat rooms on the computer. We called it the penny play. Then me and these other guys branched off and from Canada and Texas and had this little thing, kind of looked like a money, black box where we had computers and algorithms set up, and I didn't know no computers, you know. That was back in 2008, 2009, 2007, when I bought the house on Edwards. So I've been a moderator for ever since then. I had Washstock Watch, Washstock Talk. There were two separate chat rooms. And then I can't remember what we called that name. Then I got in Ascend, and that didn't last very long. Then I moved to United Traders, and then I got in with Vegas, and we opened up with Leo, and he paid us to moderate in there, and then her and I opened up one chat room. Then I got miserably sad once we broke up. I didn't know what to do, and then some guys in here said, Jim, let's form a room. I'll put it together. And that's about it. Martin Luther King Day on Monday. Be careful, we got ice out here. I'm going to go out and scrape the ice on my car and put my little cover that I got over it, so I don't have to deal with it. Misty, man, I hate misty stuff. Misty. It creates just a layer of ice, and it's going to get 20 below here this weekend. So it's not going to be fun. I got to get all my plastic out of my car so it won't crack on me. Last year it got 40 below. So I kind of ranted off about the all-time highs. I just don't want people losing money thinking that we're going to break, and I'd rather wait to break and then maybe jump in, but I can't tell you what to trade or when to trade or how to trade. I just see the signs and I say, okay, I'm not trading much. I don't want to lose money in very volatile times. Once you hit it's unprecedented times to me. I can't emphasize that enough. It's like I'm not certain because I've never broke an all-time high. At least in the run that we had into it was just over. They say the street, the market's the dictator of how they trade. I never can. I can't grasp it. I just can't do it. I can play follow the leader, but when your charts say something different, it's hard to. I mean, it was easy to call. The market was too easy to call when things were cheap. And things ain't cheap no more. And when we hit the moving averages, or when the market was really cheap down here on the weekly, come on. I swear to God, it's got to be this monitor. When we hit that 200, that was cheap. And we had the 3 black crows. Then we had the hammer, or the spinning top, the rolling pin. It was cheap when we hit this one here. It was cheap when we hit the head and shoulders. But we're up here at all-time highs. And they want it to break. It's going to break. Just like NVIDIA did. They wanted NVIDIA to break last year. And I said, we're not going to do it. It ain't going to happen until the end of the year. And we went months. Once we hit this big gap, it was already priced in my book. And then they just couldn't shut up about it every day. Every day. And the same thing with Lilly. And then we finally broke that resistance. And guess what? It didn't do it on the third time. It had to do it in a new year. So Kramer's going to get us 650. Now this Eli Lilly thing, that's going to help Alzheimer's. It's going to help diabetes. Well, yeah, if you lose weight, you don't have all that pressure up against your organs and your head's not swelled up. And I don't think you need a drug to lose weight. Just change your eating habits. Eat a little less. But that's hard to do. It's hard to do. It's a psychological thing. I used to box. I had to fluctuate my weight up and down, up and down. And I used to play baseball. I had to always keep in good shape. Until they found out I had epilepsy, and then my whole world fell apart. So every day they told me that you'll be lucky to live past 20, Jim. We think you have a brain tumor. And I lived with that for a couple of years. Then finally someone found out what was wrong with me. And I'm 60 now. 63, to be 63 soon. So I lived it up when I was younger. I fell through a glass-plated window, had a seizure, and fell through a glass-plated window and punctured my lung and come within, they said, real close to cutting my jugular vein on my neck. I had like 157 stitches in my head. And that's when I kind of stopped partying, and that or I was going to end up killing myself. So every day I wake up in the morning, I'm just happy to be here and happy to share and talk and teach and share and learn. And I'm going to go ahead and call it a day and watch my little videos. I like to watch the Black Conservative, and I like to watch fishing shows, and that's where I get my entertainment. That's why I keep telling these people that are wanting to trade AMC, you're fools, until Reddit comes out and starts pumping it. It'll get to a certain level, and all of a sudden you'll be reading headlines. We got a new low today. It could be any moment this thing could run, and I'm going to load the boat. So I watch it every day. I'm waiting. I'm going to do another video on it tonight. The reason why I don't like this stock, because of the way society is, and the way they're politicizing movies, and I don't want to watch a movie and be preached to, about politics. And I know a lot of my generation that don't even bother with watching TV anymore. I haven't turned my TV on in 3 years, 4 years, maybe longer than that, since they took cops off. It sits up there just black as could be, still plugged in, but I haven't turned it on. I ain't gonna turn it on. There's nothing to watch on it anymore. I got YouTube, and I got you all. You're my entertainment. So thank you, everybody. And I'm going to close with a song from someone that I used to play music with. I don't know if you ever heard of Split Lip Rayfield. I could do the Shiners, but I'm going to do Split Lip. Oh, I got to go to YouTube. There was a teacher. His name was Rayfield. He had a split lip, so they named his band. They named this band after him. And the guy, lead guitarist, died of throat cancer. Get this off in case we have any buzzing. I want to hear that ding, ding, ding. Living on the easy street.
Living on easy street with a dog and a Persian cat. Living on easy street, we don't need to say that.
Bills are gonna be due, and the baby will soon be too.
But we draw our welfare check this week. Living on easy street.
saying that?
Bills are gonna be due, and the baby will soon be too. But we draw our welfare check this week. Living on Easy Street. Living on Easy Street. Living on Easy Street.
Bingo. One day you'll all be living on Easy Street, and you won't have to rely on that welfare check. Hallelujah. And Martin Luther King weekend.